We're now on the record. This is the Kentucky Public Service Commission. My name is Michael Schmidt. I'm chairman of the commission. Seated to my right is Vice Chairman Robert Cicero, and to my left, Dr. Talina Matthews. We are here today for the purpose of receiving evidence in case number 2018-000281, the electronic application of Atmos Energy Corporation for an adjustment of rates. The parties to this proceeding are Atmos Energy Corporation and the Office of the Kentucky Attorney General, who has intervened in this case. At this time, would counsel for Atmos please identify himself and those with him here today?
Jack Hughes, attorney for Atmos. With me is Randy Hutchison, Atmos' local attorney in Owensboro. Kevin Frank, who is the company's in-house counsel from Dallas.
Thank you.
And we also have here Kevin Dobbs, who is president of Kentucky Mid-States, and Conrad Gruber, who is vice president of Atmos for strategy.
Okay, thank you. Mr. Cook?
Mr. McNeil will introduce us.
Larry Cook, Justin McNeil, on behalf of the Kentucky Office of the Attorney General.
Okay, thank you. And for staff?
Angela Gold and Ben Bellamy on behalf of commission staff.
I haven't had a chance to check this morning, but as of yesterday, I didn't see the notice of the hearing had been published. Has that now been filed,
No,
Mr. Hughes?
It has been filed.
I probably missed it yesterday. Has it?
I believe it's been
It has
filed,
been
yes.
filed? Okay, thank you. As I understand it, there are maybe one or more confidentiality motions which have been filed but have not been ruled on. Is that correct,
That's correct,
Mr.
yes.
Hughes? All right, so we just want to make sure that in the event questioning gets to the point where it might compromise your position on a confidentiality motion, that you please let us know, so we'll go into confidential session and protect your position on the record.
Just as a preliminary matter, we have some maps that we intend to use just as a visual aid for one of our witnesses, not as an exhibit. Those maps are confidential, so when we get to that point, we might want to turn off the...
If you'll just let us know, then we'll take care of that.
Okay.
Are there any other pending motions that need to be considered before we begin?
No, Your Honor.
No, sir.
Staff?
No, sir.
We always have an opportunity, or give an opportunity for members of the public to come forward and comment on any matter pertaining to this rate case. So at this time, if there's any member of the public present, a customer of Atmos who would like to come forward and make an oral statement of his or her position to the commission, or provide a written position, please do so at this time. There appears to be no one here, so at this time, we can move forward with the case. Mr. Hughes, if you want to present a witness.
Call Dr. Vanderwide.
Thank you. Please raise your right hand. Do you solemnly swear or affirm under penalty of perjury that the testimony you're about to give will be the truth, the whole truth, and nothing but the truth?
Yes, I do.
Please be seated.
Would you state your name, your business address?
Yes, my name is James H. Vanderweyden, and my business address is 3606 Stony Brook Drive, Durham, North Carolina.
And what is your profession?
I am a retired professor of finance at the Fuqua School of Business at Duke University.
Have you pre-filed testimony and rebuttal testimony in this case?
Yes, I have.
Do you have any changes or corrections to that testimony?
No, I don't.
Do you adopt that today as if you were under oath?
Yes.
Thank you, that's all I have.
Mr. Cook?
Mr. Chairman, at this time, we have no questions of Dr. Vanderwide.
Ms.
We
Gold?
have questions. Good morning, Mr. Vanderwide.
Good
Am I
morning.
saying your name properly?
Yes, you did.
Thank you, okay. So since Atmos's last rate case filing in case number 2017-349, has Atmos's business or financial risks changed significantly so that it would impact investors' perceived rate of return?
The risk is relatively the same, and my estimate of the cost of equity hence is relatively the same as it was in the previous case.
Okay. And are you aware that Atmos has asserted in this pending application that the company is planning to file annual rate cases?
Yes.
And would annual rate cases remove any of the regulatory lag that is inherent in utility regulation?
It depends on what data is used in each annual rate case.
So in Atmos's case, they use a forecasted test year. So would that not reduce a lot of that regulatory lag?
With regard to their accounting data, yes, it would reduce the regulatory lag. On the other hand, if there are other aspects to the case, such as using historical data on rate base and capital expenditures rather than forward-looking data, then that would in fact increase regulatory lag.
Can you explain the benefits of reducing regulatory lag?
Well, if one actually reduces regulatory lag and uses a forward-looking test period, that would give the regulated utility an opportunity, using the best available information, to actually earn their required rate of return. However, if there is either regulatory lag or one uses historical data that doesn't reflect the future year in which the utility is actually operating, then there would not be an opportunity for the utility to earn their required rate of return.
But once again, you do confirm that in the pending application, Atmos it is using a forecasted test period, correct?
They are, but it's my understanding that the interveners are recommending not adopting forward-looking capital expenditures for the company.
And if much of the regulatory lag is being removed by Atmos coming in annually to file these forecasted test period rate cases, why is a return on equity of 10.4% appropriate?
Now, I didn't agree with that, with your statement that most of the regulatory lag is being reduced. I suggested that an important part is that when one looks at the data to determine the allowed rate of return and to determine the allowed recovery of capital, that one looks at capital on a forward-looking basis. That is, the capital that's actually going to be expended during the year in which the rate is in effect. And if one uses historical data, then one won't necessarily have an opportunity, will very likely not have an opportunity to earn the required return, and so there still is regulatory lag.
Well, let me rephrase my question and see if that changes your answer. So I initially asked if much of the regulatory lag were removed by these annual filings. What if even some of the regulatory lag were removed? Why is a return on equity of 10.4% appropriate?
The return on equity of 10.4 is appropriate because that's the best estimate of the required return in the marketplace for companies of comparable risk, and hence for Atmos Energy.
So do you agree that it is this commission's duty to allow for recovery of prudently incurred costs and expenses?
It's my understanding that the commission should allow the company to have a fair opportunity to earn its required return on investment during the period in which rates during the forward-looking period when rates will be in effect. And if the company does not have an opportunity to earn the required rate of return, either because one is using historical data that doesn't reflect the future, or because there's regulatory lag, then the company won't have an opportunity to earn its required return in the future.
So do you believe that this commission should allow for recovery of an ROE that is significantly above other companies in Kentucky's recently approved ROEs?
I believe that the company should be allowed to earn the required return on equity that I'm recommending, because that is a forward-looking return that is based and estimated based on the latest available information in the capital markets that other companies of comparable risk are earning and are required to earn by their investors in the marketplace.
Are you aware of the awarded ROEs for the other Atmos operating companies in the other states?
I don't have that information in front of me.
As a post-hearing request for information, the commission staff will issue a request for Atmos to provide the awarded ROEs in the most recent rate cases for the other operating companies, as well as the year of the award.
I'm sorry, would you repeat that question, please?
I can repeat it, but we're going to draft discovery and issue it to you, so you don't have to note it down right now. But we're going to ask for Atmos to provide the most recent awarded ROEs for the other operating companies in the other states, and then the year that they received that ROE award.
And is that a question for me?
I don't think so.
Since you
It's
said-
just a request.
Oh,
It's
okay,
not
I'm
a
sorry,
question
I
for-
misunderstood.
I asked him the question, but since he doesn't know it, we'll issue the post-hearing request for information.
Yeah, I don't know.
Okay, that's fine. Mr. Vanderwater, can you refer to your rebuttal testimony, Exhibit JVW-R-1, Rebuttal Schedule 2, page 1 of 6? And just let me know when you're there, please.
Rebuttal Schedule 2, page 1 of 6.
Yes.
Yes, I'm there.
So is it accurate that you stated that in this analysis, you compute a natural gas utility equity risk premium by comparing the DCF estimated cost of equity for an electric utility proxy group to the interest rate on A-rated utility bonds?
Yes, that's a typo. In the heading for the Schedule 2, it says natural gas utilities. And in the first sentence under that, I incorrectly said electric utilities.
So you're saying that when you say that the estimated cost of equity for an electric utility proxy group, that's a mistake. It should say natural gas
Yes, and
utility
it-
proxy group?
Yes, and that's also clear from the prior, first part of that sentence. In this analysis, I compute a natural gas utility equity risk premium. And in the title, I say a return on investment in natural gas utility stock. So it is, yes, it is correct that the electric utility should be changed to natural gas utility proxy group.
Okay, thank you for that correction. And then in response to Commission staff's 5th request for information, item 9, Atmos provided the 10, 20, and 30-year treasury yields. Do you recall the date of the final order in Atmos's last rate case?
No, I don't.
Subject to check, does May 3rd, 2018 sound correct?
It sounds, that could be correct, yes.
All right, at this time, the commission staff will hand out, it's a commission-created document, and I'll explain a little more as soon as we get these passed out.
You're gonna mark this for identification?
Yes, Your Honor, commission staff's exhibit 1, please. And, do you agree that what was just handed out is it's a commission staff created document that's a graphic representation of the data that Atmos provided to commission staff's fifth request for information, item 9. And then the financial staff also added a trend line. Can you see that?
Frankly, I don't see any explanation of this data on the sheet that was handed to me.
I believe the financial staff at the bottom of the graph, that shows the 10, 20, and 30-year treasury yields that Atmos filed into the responses, and then they just created the graph that's on top of it.
Okay?
Do you see that? Subject to check, of course.
So the staff created the graph on top.
Yes, the financial staff created the graph on top based upon the information that Atmos provided into the record on the 10, 20, and 30-year treasury yields.
Okay, and those are the actual yields as of those dates, is that correct?
Those are the yields that Atmos provided in the record.
Okay?
So would you agree that, obviously subject to check, that the trend line for the 10, 20, and 30-year treasury yields since April 2018, they're rather flat, and they actually portray a small downward slope?
I see that the lines in the graph show a slight downward slope at the end. I don't know whether that's a significant downward slope. It wouldn't appear to be a significant downward slope from the data that I observe at the bottom.
Okay, but it is at least a downward slope. You do confirm that?
Well, if it's not significant, that means that it could as well be a straight line.
Okay, and so would you agree that interest rates have not really moved significantly in the past 11 months since Atmos's last final order was issued in May of 2018?
I would agree that the interest rates that are reported here have not moved significantly. I would say that investors expect interest rates to increase, however, as time goes on.
Okay, so that parlays into the next question. Just recently during the March Federal Reserve Systems, or the Fed, their Federal Open Market Committee, did the Fed increase interest rates?
I don't recall.
Subject to check, would you believe that they did not
Yes,
increase interest rates? And are you familiar with the signals that the Fed gave during this report?
no, I'm not.
Okay, so subject to check, would you accept that the Fed indicated there now appears to be no likelihood of a 2019 interest rate hike unless conditions change significantly? And in its post-meeting statement, the FOMC indicated it would remain patient before adopting any further increases?
I would accept that that's what they said. I don't believe that those are the long-term interest rate forecasts that I'm seeing for investors in the capital markets.
Okay. Do you use forecasted interest rates in your analysis?
Yes,
And did your interest forecast include rate increases throughout 2019?
I don't recall. I'd have to look that up.
As a post-hearing request for information, the commission staff will ask for that detailed analysis. And if you did include rate increases throughout 2019, and now the Fed is saying that, unless something significantly changes, they are not going to raise interest rates any further, and potentially not even until 2020, do you still support the accuracy of your forecast?
I'd have to look at a specific forecast that I was, in the context in which I was using it. If you have a reference to a place where I was using the forecast, I'd be happy to discuss what rate I used.
The CAP-M models use the forecasted interest rates?
And that's in my direct testimony?
I believe so, yes.
I believe that I did use a forecasted interest rate there, yes.
Okay. Well, in order to get a more detailed response, commission staff will just issue a post-hearing request for information so that you'll have time to go through your detailed analysis and provide an adequate response.
Okay.
Can you please refer to page 4 of your rebuttal testimony, lines 15 through 16, and just let me know when you're there, please?
Yes, I'm there.
And can you read those 2 lines into the record, please?
This is item 5 on line 15 to 16.
Yes.
The commission recently awarded Duke Energy Kentucky an ROE equal to 9.725%. Order at page 29.
Okay. And this award that you're referring to with Duke, do you know if it concerns Duke Energy Kentucky's electric or gas operations?
I didn't go back and read it, but Duke Energy, I would guess it's their electric operation, but I don't know for sure.
It is the electric operations. Would you, subject to check, accept that?
Yes, I would accept that subject to check.
And do you, I'm sorry, did you say something?
No, I was clearing my throat.
Okay. Do you agree that typically electric operations carry a higher risk than that of natural gas and thus are typically awarded a higher ROE? In general?
I don't think I would say that, no.
So generally, you do not see nationwide that electric companies have a higher ROE than natural gas companies because they're considered riskier?
No.
Are you aware that in the Duke Energy Kentucky's gas rate case, case number 2018-261, the order just issued in the past few weeks, that Duke Energy Kentucky actually settled upon an ROE of 9.7%?
No, I'm not aware of that.
And do you believe that Atmos carries a higher risk than Duke Energy Kentucky and should be compensated for it?
I haven't compared the risk of Atmos Energy to that of Duke Energy. I've compared it to other natural gas companies, but not to Duke Energy.
So even though the commission has not yet issued a final order in the Louisville gas and electric rate case, that's case number 2018-295, are you aware that Louisville Gas and Electric agreed upon an ROE of 9.725% for both the electric and gas operations recently?
Are you asking me to accept that subject to check? Or
I was asking if you're aware of that,
I'm not aware of it, but.
but you'll accept it subject to check?
I would accept the subject to check.
Thank you. And I have the same question on this one. Do you believe that Atmos Kentucky carries a higher risk than Louisville Gas and Electric does?
I have not compared Atmos Energy to Louisville Gas and Electric.
Do investors read commission orders? In general?
I would say in general they do, yes.
Okay, and so do you think that investors know what this commission historically allows in terms of ROE and takes that fact along with other available information into account before making investment decisions?
I don't think that all investors would. I think they would make their own assessment of what they felt the company, or what they needed in order to invest in the company. I think they as sophisticated investors might be aware of what the company has allowed, but they would, again, form their requirements based on market prices, not on allowed returns and required returns in the marketplace.
Okay, according to your testimony, ROE awards in the 9.7% range are too low. But if this is accurate, then why would Duke, Kentucky, and Louisville Gas and Electric agree to ROEs that could be detrimental to their companies?
I can't speak to why they would do that. Since I have no knowledge of, I've not interacted with the company and I don't understand the circumstances of their case.
But just generally speaking, we know that Duke and LG&E are sophisticated investor-owned companies, and it wouldn't make rational sense that they would do anything detrimental to their companies, correct? By accepting an ROE that's below what you're saying is acceptable.
I think in a regulatory context, the company has to look at potentially what's possible within the regulatory context and make a decision based on what they think the possible returns would be in that regulatory context. That doesn't mean that they believe that that is the return that investors require in the marketplace. Those are two entirely different considerations.
Could I ask one question?
Mm-hmm.
But isn't Atmos competing with those companies for those dollars?
Yes.
And so LG&E and Duke would have to know that accepting a lower rate of return meant that they would have the same opportunity for that investor dollar as Atmos would receive if Atmos received 10.5?
With regard to the regulatory allowed return, however, the required return is determined in the capital markets. Prices can go up and down, and investors would base their required return based on their opportunities in the marketplace on market values. So the allowed return, there may be strategic reasons why a company would accept an allowed return that is different than what their best belief is of what investors require in the marketplace.
Or investors realize that that could be the market rate of return and therefore accept that based on risk?
It could be, but a test of whether it could or could not would be to actually estimate the cost of equity using standard cost of equity estimation techniques like I have in this case. And my evidence is that investors require a higher return than 9.7%.
I'll let you finish, then I'll ask the rest of my questions.
Mr.
Thank you.
Vander Wyde, can you please refer to pages 4 through 5 of your rebuttal testimony? And just let me know when you're there.
I'm there, yes.
And here you discuss how it is your belief that flotation costs should be included in the equity analysis. Is that correct?
Yes.
Are you aware that this commission has never allowed for the recovery of flotation costs?
I haven't studied other orders other than the last Atmos Energy case, and that's what I'm talking about here.
And the
And I'm
commission-
expressing my opinion on whether they should or should not as an economic proposition.
Just to clarify the record, the commission did not allow flotation costs in the last Atmos case, correct?
Right, but I think that you were asking me about have they ever, and
Right.
I haven't studied that.
And are any other Atmos operating companies awarded a flotation cost adjustment in their respective ROE awards in other states?
I have not studied that. My testimony relates to what investors require in the marketplace.
Okay, as a post-hearing request for information, the commission staff is going to issue discovery asking for Atmos to provide a list of each of its operating companies, the respective state commissions, whether or not flotation costs adjustments are included in the awarded ROE, and the size of the adjustment if applicable. Do you know, are there any other Atmos operating companies awarded a size adjustment in their respective ROEs, as you discussed in your testimony and rebuttal?
I am not. My testimony does not relate to what has actually happened in other regulatory jurisdictions. It relates to what investors require in the capital markets.
Okay, as a post-hearing request for information, commission staff will ask Atmos to provide a list of Atmos's other operating companies, the respective state commissions, whether or not a size adjustment is included in the awarded ROE, and if so, the size of the adjustment. And are you aware of any rating agencies or other similar industry observer that has singled out the Kentucky Commission for awarding abnormally low or punitive ROEs?
I have not studied what the rating agencies have said with regard to the awarded ROEs in Kentucky.
But you have not heard of any rating agency or similar industry observer that has noted that the Kentucky Public Service Commission has awarded dangerously low ROEs?
I haven't heard one way or another because I haven't studied it.
Can you please refer to your rebuttal testimony, page 8? And I'm looking at the table 1, the earned and expected returns on equity.
Yes, I'm there.
And can you explain why New Jersey Resources earned an ROE of 17.1% in 2018?
Was the question, can I explain why?
Yes, can you explain why that's such a high ROE?
No, I'm just reporting what what Value Line reports their earnings to be in 2018. I don't know why.
Since the 17.1% is such a higher ROE than the rest of the companies that are in your table, do you believe that New Jersey Resources is an outlier?
I believe that their number is certainly higher by some magnitude in 2018, and hence I would focus more on the 2022 to 2024 period, where it would take away that any unusual characteristic of that year, and we would see that their numbers are pretty much in line with the expected ROEs for the natural gas utilities.
And that goes into my next question, which is earning a 17.1% ROE, in general, that's not sustainable, is it?
But it's higher than my estimate of their required return. So I would not look at that one number and say that that's the required return on equity. I would look at the average of 10.4%, where there are some numbers above and some numbers below the average. And in particular, I would also look at the forecast for the longer run, which is what investors look at, and I would see that their number is quite in line with those for the other natural gas utilities.
Okay, looking at table 1, do you know what the average ROE would be for 2018 if you remove New Jersey Resources?
No, that's not something that I calculated, nor would I recommend doing that calculation.
Okay, that is noted, but subject to check, would you agree that it sounds accurate that if you remove the New Jersey Resources, the average ROE for 2018 would be approximately 9.61%?
Well, as a mechanical matter, it might be. I would accept your calculation of that, but that would not be an estimate of the cost of equity. The cost of equity, I've presented a lot of different evidence on the cost of equity, including a DCF model, an ex-ante risk premium, an ex-post risk premium, and a CAPM. I've also looked at Value Line estimates of the earned returns on equity in 2022 to 2024 and in other years. And I don't think that any investor would base their estimate on removing one number out of the 2018 from the group for natural gas utilities.
So in case you want to elaborate on anything, can you explain why you believe that the New Jersey resources should be included in the average ROE, even though it appears to be an outlier for 2018?
I haven't studied why their number is high in that year. I would imagine that there is some particular reason, but I also would note that there are numbers below the average, such as numbers in the eights, several numbers in the eights, which taken together would also greatly affect the average. I wouldn't recommend taking them out either. I would recommend that one look at the average, which has both the higher number and the lower numbers, which is calculated on the entire set of numbers, including the higher numbers and the lower numbers. And specifically, I would test that against the longer run forecasts of the allowed returns and test it with the DCF and the risk premium and the CAPM cost of equity estimates. And I noticed that there's quite a consistency in the average in the 2022 to 2024 average to the 2018. So that would give me a confidence that the 10.4% for 2018 is a lot more reliable number than a number in the mid-nines.
Okay. At this time, can you please refer to your rebuttal testimony, Exhibit JVW-R-1, Rebuttal Schedule 1, page 1 of 2.
Rebuttal I'm sorry, I'm not sure I picked up on that.
Rebuttal testimony, Exhibit JVW-R-1, Rebuttal Schedule 1, page 1 of 2.
Yes, I'm there.
Okay. And then, can you look at line 3 where it states New Jersey Resources is the company? Do you see that?
Yes.
Can you explain why the DCF model results for New Jersey Resources is 6.6%? Can you reconcile that with that 17.1% ROE that we just looked at?
Yes, the two numbers, it can't be reconciled because the two numbers are totally different calculations. The value line number is the rate of return on book equity, and the number here is a DCF result based on the market value of the equity. And if the market price has gone up, then the DCF result could be low. And if there were unusual circumstances for that one company in 2018, the book return could have been higher than average. But in both cases, I would not base my estimate on a single result for any one company. I would look at the results of all my cost of equity methods and use all of the companies, because there's uncertainty with regard to applying them to any single company.
Okay. And then going back to the original table that we were discussing, New Jersey Resources ROE for 2018, do you know what New Jersey Resources ROE is for the first quarter of 2019?
No.
Okay, as a post-hearing request for information, the commission staff is going to request that Table 1 be updated with the first quarter of 2019 results.
Well, excuse me, I don't believe this could be updated because this is the value line. These numbers are taken from value line, and value line doesn't show an ROE for a quarter.
Okay, then we'll word it as just giving an update to the first quarter results for the ROE for the companies that are listed. if it's available?
I'm not sure it would be, but I can attempt to find that.
Okay, thank you. And then finally, can you refer to page 10 of your rebuttal testimony? Table 2. It's titled Cost of Equity Model Results.
Yes,
So are either flotation costs or size adjustments included in the cost of equity model results in this table?
they would have been calculated in exactly the same way that they were in my direct testimony, so they would have included flotation costs. And and a size adjustment where appropriate in the CAPM. But those would not have had a very large impact on the cost of equity result. And indeed, I'm not even updating my 10.4 recommendation. I'm not changing my recommendation from the 10.4. I was updating my model results to determine whether my original recommendation is still appropriate. And so, I'm not recommending 10.5 at this time. I'm still recommending the 10.4 in my direct testimony.
As a post-hearing request for information, commission staff is going to request for you to provide an update to this table, excluding both flotation costs and any size adjustments. And we have no further questions at this time, Chair.
Commissioner Cicero, questions?
Can you clarify for me on table 1, the years 22 through 24? Is that a value line provided number?
Yes.
So they do their own estimate on what they anticipate the rate of return is going to be just for these particular companies?
Yes.
So I'm curious, this is the value line, and then we have the S&P Global. And the S&P Global appears to be more of a broader populated database of returns. And for the year-to-date in 2018, the average ROE was 9.62. So I'm curious, what causes you to use a particular database over another database?
Well, the value line, I believe, is more widely available to investors. The value line is a publication that's available in every public library that I've generally seen. It's a database that shows returns over a longer period of time rather than just the first part of 2019. And not only that, but the numbers for a partial year, like a quarter, can reflect seasonal factors. So the numbers for an entire yearly data, and especially looking at more than 1 year, as I have done, would be more reliable than looking at an S&P database for a particular quarter.
Well, I almost understand that, but your table shows 2018 versus S&P's 2018. It's projected out to 2024 for a 3-year period. The S&P doesn't do any forecast, so I'm not sure. The only thing that I see with the value line is that it's making a projection as far as historical. If I look at the S&P, I can go back to 2006, but this table here doesn't show anything except 2018. And you may have that data in when you did your research, but as far as what's presented here for your testimony, you're only using 2018.
I am using 2018. I wouldn't look at, I believe that looking at accounting numbers, there are accounting numbers that are earned returns, and there are market-based numbers that are reflected in the cost of equity methods. When you look at the historical record of accounting numbers, those can be distorted by one-time write-offs that would distort the numbers. And so it's difficult to interpret the accounting numbers for a historical period. The S&P numbers, I would ask you, were they for the utilities only, or were they for the
Just natural gas.
natural gas? I've really not followed the S&P numbers over time. I have found it more important for me, at any rate, to look at the value line numbers.
That's fair enough, but you would agree that S&P is a fairly reputable database in terms of what's being presented.
Well,
It's historical, I mean.
S&P is certainly a very reputable bond rating company, and they do provide historical data. I have not studied their historical data, so I can't assess whether I would agree with it or not.
Well, we'll agree that there's a lot of information out there. You made the statement that the best estimate in the marketplace, for your opinion, is 10.4% and updated maybe 10.5% on a ROE.
Yes,
And you said that the long-term rates that investors expect and require are 10.4, 10.5 or greater.
right, yes,
And then I think you said that the rates you use reflect the future.
yes,
Okay. There's many assumptions in any of the ROE calculations. Doesn't matter whether you use the CAPM, the DCF, the risk analysis, all of them require some kind of an assumption, is that correct?
yes.
So depending on what assumptions you use can greatly affect the outcomes of what those calculations are. Would you agree?
I would generally agree. I'm not sure whether it's greatly, but it could affect. And I would say that is exactly why I look at several methods that are based on different assumptions and are each used by cost of equity experts to estimate the cost of equity.
I went online and looked at some of the analysis, and all of this happens to be a study that was done in 2013, and it talks about no matter what method you use, it's highly subjective. Even though including the DCF, which seems straightforward, and it goes on and talks about the risk premium and all the other ones, it's very highly subjective. So when the commission does an evaluation of what ROE to use, whether we use the expert testimony of what an intervener may provide, or whether we use the testimony that in this case happens to be Atmos, we do have to do an evaluation of what the variables are that go into the ROE and look at everything in order to make a determination. Would you not agree?
Yes, and I would agree that one ought to look at the evidence provided and assess that evidence, and I'm providing that evidence.
But you made the statement that your rates reflect the future, and given the testimony that Atmos intends to come in every year for an annual rate increase, then projecting rates into the future would mean that there doesn't need to be as much of a projection as what there might need to be if a utility wasn't coming in every year.
I would respectfully disagree with that. Investors, we're talking about investors when we talk about the cost of equity. And investors are looking, when they make an investment in the company, whether they make that investment every year or they make it just once, at each point in time, they are making an investment whose return is going to, which is going to generate cash flows over a long period of time. And they're going to calculate their expected return based on their expectation of the cash flows over the life of their investment, not just on the single year in which they made the investment. And so if they made the investment in 2017, it would be a long-run investment that they had in mind. If they made another investment in 2018, it would again be a long-run investment that they had in mind. And their required return would be based, in both 2017 and 2018, would be based on a long-run view of the future at each of those points in time.
A long-run view of the future would be what those interest rates will be into the future.
But the cash flows would be that they expected to generate, the dividends, for instance, and based on their, and what discount rate that would generate in the DCF application, and what cost of equity result would happen in the CAPM or the risk premium. But in each case, this was their return over the life of their investment. If they made the investment in 2017, their life of the investment would be a long-run period beyond 2017. If they made the investment in 2018, it would be another long-run investment, but one beginning in 2018.
Yes, but we've already agreed that Atmos intends on coming in every year, so those risk premiums and whatever that investment return is will be adjusted going forward based on the current application and approval of an ROE from that point going forward. Is that correct?
That is correct, but it doesn't mean that, it still doesn't mean that it's a one-year return.
It's not a one-year return, but the return will be whatever the approved ROE is for that annual increase. If a company is in for an increase, that ROE may or may not be adjusted, but it will reflect, hopefully reflect market rates at that point in time.
Yes.
So, looking out into the future over a long term, it's not as important to try to project interest rates, which may be based on assumptions that could occur or couldn't occur, because as an example, we talked about the Fed rates, which everyone thought would continue to increase, but the Fed has backed off and they could increase it again. We don't know. It's still an assumption, and assumptions aren't as good as what the current period of time is. And given an annual application for a rate increase, isn't that the best measure of what an investor should expect to receive as a return?
Hopefully at each point in time it would be, yes.
I don't have any other questions.
Mr. Matthews?
I don't have
I have no questions. Mr. Hughes, any?
I have
correct?
two.
Correct.
Dr. Van Wyder, when Commissioner Cicero was asking you about the S&P report,
Yes.
what was your understanding of the S&P report he was referring to?
Frankly, I've forgotten which report, what report he was referring to at this point in time. I recall that at the time he said it, but I don't recall which one, at this point now, which one it is.
Are there a number of S&P reports?
Yes, there are a number of S&P reports. And S&P, for instance, provides bond ratings and bond rating information, and they also supply historical information. My recall now is that this was historical book returns on equity.
Okay. Was it your understanding that it was the RRA report?
No, I was not. It was not my understanding it was the RRA report.
Okay. When calculating ROE, do you consider regulatory lag?
Well, when calculating the required ROE, I would consider whether there's regulatory lag or not, because that would affect the risk. When calculating the ROE for a particular period, that would be whatever it was in that period. It may be a lagged period, but the required ROE would be dependent on the risk, which would depend on whether there was regulatory lag or not.
Okay, that's all we have. Thank you.
Anything else?
No questions, Mr. Chairman.
No further questions.
Okay, may this witness be excused?
Yes, ma'am.
Thank you. You may step down. Do you have another
Wait.
witness?
Paul Robb.
Rob, please raise your right hand. You solemnly swear or affirm under penalty of perjury that the testimony you're about to give will be the truth, the whole truth, and nothing but the truth.
I do.
Please be seated. Counsel?
Would you state your name and your business address?
Yes, my name is Paul Robb, and my business address is 5313 Portsmouth Road, Bethesda, Maryland, 20816.
Have you filed testimony in this case?
Yes,
Do you have any changes, corrections, or additions to that testimony?
I do not.
If your testimony was given today under oath, would it be the same?
Yes.
Before we start, Ms. Gold, did you intend to introduce Staff Exhibit 1 into the record, or just introduce it for identification purposes?
If there's no objections, we would like to introduce it into the record.
Any objections? Please let Staff Exhibit 1 then be admitted into evidence. Mr. Cook or Mr. McNeil?
Chairman, no questions.
We do have questions, Chairman. Good morning, Mr. Robb.
Good morning.
Can you please refer to your direct testimony, Exhibit PHR-5, page 2 of 2? It's titled Revenue Deficiency at Equalized Proposed Return, and just let me know when you're there.
I'm there.
Can you explain the criteria you used when allocating the proposed revenue increase across the various customer classes?
They're explained in detail in my direct testimony, obviously, but I relied on 3 different methods to allocate the return, or allocate the costs of serving each of the classes. The first one was a customer demand approach, which which classifies the mains expenses into customer and demand components. The second one was the demand-only approach, which classifies those same costs as demand-only. And then there was a third approach that uses a load factor approach to classify mains investments into a portion related to demand and a portion related to energy. And they formed the basis for the 3 different studies, which were then, and those classified costs were then allocated essentially in the same way, although there were different groups of costs to allocate in that way, obviously, and resulted in these, in the values provided in Exhibit PHR 5, page 2. These values, as it says at the headings in both of those blocks of numbers anyways, are at the equalized proposed return. So what we simply do there is calculate, if I were trying to earn the same return from each customer class, what revenues would I need? How would I need to increase or decrease revenues to achieve that return?
Okay. At this time, Commission staff requests permission to provide a handout, and we would like to mark it as Commission staff's Exhibit 2 and ask for it to be admitted into the record if there's no objection. Mr. Robb, subject to check, can you confirm that this commission staff created table that we just handed to you is an exact replica of the first table that you had in your Exhibit PHR-5? And we just added an additional column representing the percentage of revenue proposed from the average? Subject to check, of course.
Yes, it appears to be.
Okay, and at this time, we'll hand out one more, handout.
Is there any objection to introducing Staff Exhibit 2, Mr. Hughes? Then let it be admitted into evidence as Staff Exhibit 2.
And we would request that this handout be marked Commission Staff's Hearing Exhibit 3, and for it to be admitted into the record if there's no objection. Okay, so subject to check, does this commission staff created table appear to represent the current and proposed rate of return on rate base from each of your rate studies? The goal in both of these handouts were just to combine your results for ease of reference.
I haven't checked every number, but I would assume that
Subject to
it's
check.
correct, yes.
Okay, so do you agree that this is a summary of the, let's see, of the rate of returns at present and proposed rates for each filed cost of service study?
Subject to check, yes.
Okay.
What I was agreeing.
And can you please refer to the non-residential interruptible cells class?
Yes?
And can you explain for the commission what this class is?
It really is as indicated in the title. It is a class of non-residential customers whose sales can be interrupted for a variety of reasons, primarily if they have a backup fuel and they can switch to the backup fuel. But it's a customer class that doesn't take firm service.
Do you know who usually takes under this class? Would it be industrials? Would it be, what type of customer is it in this class?
It could be it certainly could be an industrial customer who can turn off their production processes. It could be an apartment building, for example, who might have a backup fuel source, heating oil, for example. Anyone who might have a backup fuel source or who can defer their use of gas to another time would be eligible for to be such a customer.
Thank you. And would you agree that based upon your studies, the non-residential interruptible cells class is being heavily subsidized?
Well, based on the definition that I would generally apply, that is, they are not providing the system average rate of return, then the answer to your question would be yes.
Okay, and can you explain why only 10.72% of the average increase needed for an equalized return is allocated to the non-residential interruptible cells class if they are being subsidized?
I think you'd have to ask that question of Mr. Martin, who did the final rate design.
Is the residential class contributing to the subsidization of the non-residential interruptible cells class?
Well, the answer is it depends on which cost of service study you rely on.
Okay, so if commission staff asks for a post-hearing request for you to provide a revised exhibit PHR-5 and a revised Schedule M, removing any subsidy that the residential class is providing to the non-residential interruptible cells class, would you be able to create that?
I believe that's what PHR-5 does, though. PHR-5 eliminates all of those subsidies, so I'm not exactly sure what you're requesting.
Just one moment. Okay, so it appears to commission staff that the amounts allocated do not remove all the subsidies. So that's why we were going to ask for a post-hearing request for information removing the subsidies.
Well, certainly, certainly at the equalized return, they do remove all the subsidies. They remove all the subsidies for all the classes. If what you're asking is to keep the to eliminate the subsidy only for that one class, to move them up to equalized rate of return, then I would probably need additional information. How then do you want to spread the deficiency that might exist, or the excess that might exist among all the other classes?
So the question was, we were gonna issue a question where you provide an updated, schedule and table, and you remove any subsidy that the residential class is providing to the non-residential interruptible sales class. Does that make sense?
Yeah, but then I need more information than that. What are we gonna, we don't then, there are either excess or deficient dollars depending on the cost of service study they're gonna do. What would you like me to do with them? Do you want me to spread them equally among everybody else? Or exactly how are we gonna allocate these costs? I just don't understand the question, I guess, I'm sorry.
Okay, I think at that point, you would just give as your proposal, what Atmos's proposal would be, if the commission wants to remove any subsidy that the residential class is contributing to that non-residential class.
And, with all due respect, my answer would be, the answer to that request would be Exhibit PHR 5 as presented.
Okay,
It would be the equalized class rate of returns depending on the class cost of service study that you wanted to rely on for that. That eliminates all of the subsidies.
okay, so what we can do is, just say that the commission will issue a post-hearing request for information on it, and then, commission staff will work together and formulate the question, to address your needs.
That's fine, and I'm not trying to be difficult. I'm not exactly sure I understand the request, but hopefully we can get to a point where I can provide you with information
Absolutely.
that's useful to you.
And then the last question I have is, if the commission decided to alter the revenue requirement for the non-residential interruptible sales class so that they're not being subsidized, especially by the residential class, if that is happening, then I guess it would be better for a post-hearing request for information that we can issue for Atmos to propose what their recommendation is for how the revenue should be allocated at that point.
I'm certain they can answer that question, yes.
Okay, no further questions.
Mr. Hughes, is there any objection to staff's Exhibit 3?
No, sir.
And let it also be admitted into evidence. Mr. Cicero?
I have no questions.
Mr. Matthews?
I have no questions.
I have no questions. Mr. Hughes, any redirect?
No, sir. No questions, Judge.
May this witness be excused?
He may.
Thank you. You may step down.
Thank you, Your Honor.
You may call your next witness.
Josh Dinsman.
Do you solemnly swear or affirm under penalty of perjury that the testimony you're about to give will be the truth, the whole truth, and nothing but the truth?
Yes.
Be seated.
Would you state your name and business address?
Josh C. Dinsman, 810 Crescent Center Drive, Franklin, Tennessee.
And what is your position with the company?
I am Vice President of Finance for the Kentucky Mid-States Division.
Did you file testimony in this proceeding?
Yes, I did.
Do you have any changes, corrections, or additions to that testimony?
No, I do not.
If asked those questions today under oath, would your testimony be the same?
Yes, they would.
Mr. Cook, Mr. McNeil,
No questions at this time.
No questions at this time.
Mr. Cicero? Mr. Matthews?
No questions.
Well, you don't have an opportunity for redirect. You may step down.
And I had a lot for you.
Thank you.
Jennifer Story.
Please raise your right hand. Do you solemnly swear or affirm under penalty of perjury that the testimony you're about to give will be the truth, the whole truth, and nothing but the truth?
Yes, I do.
Thank you. Be seated.
Would you state your name and business address?
Jennifer Story, 5420 LBJ Freeway, Dallas, Texas.
And what's your position with the company?
Director of Regulatory Reporting.
And have you pre-filed testimony in this case?
Yes, I did.
Do you have any corrections, additions, or changes today?
No, I don't.
if you were asked those questions under oath, would your testimony be the same?
Yes.
That's all.
Mr. Cook, Mr. McNeil,
No questions at this time.
Ms. Gold?
We did have a couple questions. How you doing, Ms. Story? You were involved in the case number 2018-00039, which was the case that addressed the effects of the Tax Cuts and Jobs Act on Atmos's revenue requirement. Is that correct?
That's correct.
In the settlement in that case, Atmos had calculated the excess deferred income taxes and indicated that in order to get the final number that they would need to, or that you would need to complete the 2018, or I guess the tax year that ends in September of 2018. So I guess that's Atmos's 2018 fiscal year. Is that correct?
That's correct, and filed a tax return for that period.
And in the settlement, I think it said, final termination of the excess deferred tax liabilities resulting from the TCJA cannot be fully determined until end of fiscal year accounting is completed in late October. And that's referring to late October of 2018, is that correct?
That's correct.
And then I believe in response to, and if you need to refer to this, it's Atmos's response to staff's third data request, item 28 in this proceeding.
Okay.
And on the second page, in response to item C, it's the third paragraph down in the second sentence. Again, you're talking about the finalization of the, finalizing the excess ADIT amount, and you indicated that the amount will be finalized when the company files its federal tax return in July of 2019. I guess, is that the drop dead date that Atmos will have the final excess ADIT number?
Yes. So our accounting was completed for September of 2018, and we do have an updated number. But until we file the tax return and perform all those calculations and determine if there are any minor true-ups to that number, we won't have a final regulatory liability number. But once we file the tax return in July 2019, the number will not change after that.
And kind of changing topics here a little bit, could you refer to, it was produced in response to staff's first request for information. And I think it's just one of your work papers. It's ADIT _ KY _ projection 2018-2020.
I believe I have that.
And this basically, and correct me if I'm wrong, but I understand that this shows the timing differences for the various divisions between both the timing differences with respect to depreciation, but also the differences in the basis, for the book basis and the tax basis. Is that correct?
That's correct.
Okay. And then from those amounts, you calculated the deferred tax liabilities associated with each division. Is that correct?
That's correct.
I'm just looking, if you look at the time periods past in 2018 and 2019, the way that you calculated the deferred tax liability was by multiplying the difference, whether the difference between the tax basis and the book basis times tax rate. Is that correct?
That's correct.
And the tax rate you used was 22.82%. I was curious just where that tax rate came from.
That tax rate is a blended federal and state deferred rate that the company uses. So it uses the federal rate of 21% and then a blended state rate of 2.3%, which is then reduced for the benefit of the federal deduction for that. So that blended state rate of 2.3% is used for all of Atmos's operations.
Okay, so that 2.3% is, that's the state rate that is then blended in with the 21% federal rate, correct?
Yes.
And that's used for all of Atmos's operations across the entire nation?
That's correct.
And is that 2.3% a blended rate that is based on the tax rates in all of the states that Atmos operates?
That's correct.
Okay. So could you look at, and you can keep this open because I might come back to it, but if you look at Waller rebuttal testimony, it's basically the exhibit to Mr. Waller's rebuttal testimony. I think it was GFWR1.
R1,
Yes, I believe it was the only one.
okay, which page?
It's a spreadsheet, so let me see. Tab B.5F.
Well, this is a, R1 is 6 of,
Okay.
I apologize, mine's actually loading at this second, so take 1 second. Okay. So, are you at B.5F?
Yes.
And I know this is an exhibit to Mr. Waller's rebuttal testimony, but this exhibit is an updated version of 2018 KY Rev requirement model, is that correct?
It includes updates from that projection, yes.
Okay. And you were in part, or you provided information for that 2018 Kentucky Revenue Requirement Model document, is that correct?
That's correct.
Okay. And if you look at tab B5F, it says witness, Waller, and Story. You did provide information for this exhibit, is that correct?
Yes.
Okay. Could you can you scroll down to line 68 and line 70?
I don't see a line 68 and line 70 on this printed copy.
Okay, so it would be on the Excel spreadsheet, it's line 68, but I think you all have additional line numbers there, so it's line 56 on the numbers that you provided. And it says return gross up for income tax is what is the title there.
Okay. I'm not seeing it, but I do know what you're referring to.
And it says tax expense on return. And there is a percentage there next to tax expense on return. It says 24.95%. I'm curious, what is that 24.95% referring to? Is that the blended tax rate with federal and Kentucky taxes?
I'm not sure. I would need to see what you're looking at, and I'm not seeing it on the printed copy that I have.
So it's down where you calculate the change to net operating loss carry forward. You can take your time if you all need to find it. Okay, maybe in the printed version it could be on the next page, I guess.
Yeah.
But on the Excel spreadsheet, it's on B5F. Tab B5F. If you'd like me to approach, I can come try and show it to you on the sheet.
Okay,
We can present it on the
Let's wait.
laptop, is that?
that works.
That's fine.
I think, I know what you're referring to, and I think it's out of the print area, and I think that's why I'm not seeing it on the sheet.
Okay. So you said line 5, 6, instead of 24.
Okay, the 24.95% represents the 21% federal rate, the 5% Kentucky statutory rate, net of federal benefit, to arrive at 24.95%.
So it's the blended rate between the federal tax rate and the state tax rate.
That's correct.
Okay. Going back to the ADIT KY projection 2018 to 2020, and I guess specifically we'll look at Division 9 first, because that is the primary Kentucky division, is that correct?
That's correct.
In determining the value of the ADI, or the amount of the ADIT liabilities for Kentucky, would it not be appropriate to use the blended rate of 24.95% as opposed to 22.82%, since that is the state tax and federal tax amounts?
Our practice, up until recently, was to mirror the way we recorded deferred taxes with the way we file our tax returns. And because we are a C corporation with operating divisions rather than subsidiaries, we file a state income tax return, say for Kentucky, based on all of our utility operations. And that's true for many of the states that we file in. So we have historically recorded deferred taxes using the blended rate to reflect the manner in which we're required to file state tax returns. However, in December of 2018, we modified this practice, and we are now recording state taxes, deferred taxes, using the statutory state rates in the jurisdictions that we operate in, which is, I think, what you're getting at.
So in December 2018, you actually modified, and so in Kentucky, you will be filing using
Yes,
the state amounts to calculate the reserves and the assets with respect to,
yes. We will be recording deferred taxes in Kentucky going forward using the statutory state rate of 5%.
with respect to calculating the total value of the ADIT liabilities during the forecasted test period, do you think that it would be reasonable to use the same blended rate that's used to calculate the taxes for the test period?
I think that on a prospective basis, we have determined that that's a reasonable approach. The manner in which we calculated and included taxes for purposes of this filing was consistent with the manner that we have done in all filings in the past, and reflective of what was on our books and records at the time.
Okay. Thank you. I don't have any other questions.
So just to clarify his last question to you, you verified that beginning of December of 2018, you're changing the methodology for taxes from a blended rate to the actual jurisdictional rate in the state you operate in.
We are changing where we record those taxes, yes, based on the statutory rates in the states that we operate in.
Okay, and I missed it. So for the forecast period, which methodology are you using?
We used in the forecast period, which was prepared many months ago, but we used the blended tax rate that was reflective of what was on our books and records at the time and the methodology we were using.
Okay, so there's a slight difference there, but
Yes.
I know everything else.
Matthews?
I don't have anything.
I have nothing.
No, sir.
Andrew, correct? You may this witness be excused?
Yes, sir.
You may step down. Thank you.
Laura Gillum?
Please raise your right hand. Do you solemnly swear or affirm under penalty of perjury that the testimony you're about to give will be the truth, the whole truth, and nothing but the truth?
I do.
You may be seated.
State your name and your business address.
Laura K. Gillum, 5430 LBJ Freeway, Suite 600 at Dallas, Texas.
And what is your position with Atmos?
Director of Accounting Services.
Have you pre-filed testimony in this case?
I have.
Do you have any corrections or additions or changes today?
I do not.
If your testimony today, if you were given that testimony today under oath, would your answers be the same?
They would be.
That's all right.
Good.
Chairman, no questions at this time.
Ms. Gold, Mr. Bellamy?
We have just a few. Good morning, Ms. Gillum.
Good morning.
In your rebuttal testimony on page 7, if you'd like to refer to that, just let me know when you're there.
I'm there.
In on line 16, you state that using total operating expenses as a component of the composite factor produces circular results. Do you
Yes.
see that? Are the circular results based on the allocated cost being part of the current or previous year's operating expenses?
The circular results are more getting at just because you have higher total operating expenses doesn't necessarily mean that the level of service provided to that division was higher or lower. And so you may be indirectly penalizing or unpenalizing, if you will, giving more cost to a different division that otherwise had the same level of service provided to them, which then drives up the cost that they're being allocated, which then drives up their percentage, which then makes the reference circular.
No further questions at this time.
Mr. Cicero?
Good morning.
Good morning.
So I'm curious, when capital projects and the management of capital project occurs, does that occur at Atmos headquarters or does that occur at a local level?
At the local level.
So there's no allocation that occurs from the headquarters to the local level for any of those services?
There is, I mean, there is indirect support provided to those capital project managers at the division level, but it's an indirect level of support. We are not managing the day-to-day projects.
It's more of an umbrella oversight from a corporate level rather than an actual management of projects at a local level.
Correct.
You don't have any other questions?
Mr. Matthews?
I don't have any.
I have no questions. Any
No, sir.
resurrect? May this witness be excused?
She may.
You may be excused.
Mark Martin?
Chairman, I wonder if we could take a short break before Mr. Martin.
This might be a good time to take a break. Let's take a break until 15 until 11, and then we'll continue on through. Okay. I've been asked all state property, so we'll need to. I don't know where you can go, but you can't go here. We'll be in recess for 15 minutes. We're now back on the record. Mr. Martin, will you please raise your right hand? You solemnly swear or affirm under penalty of perjury that the testimony you're about to give will be the truth, the whole truth, and nothing but the truth?
Yes, sir.
Please be seated. Counsel?
Would you state your name and your business address?
Sure. My name is Mark Martin. My business address is 3275 Highland Point Drive, Owensboro, Kentucky, 42303.
And what is your position with Atmos?
I'm Division Vice President of Rates and Regulatory Affairs.
Have you filed testimony in this case?
Yes, sir.
Do you have any changes, corrections, or additions to that testimony?
No, sir.
If you were asked those questions under oath, would your answers be the same today?
Yes, sir.
That's all I have.
Mr. Cook?
Yeah, Mr. Chairman, thank you. Mr. Martin, good morning.
Good morning.
You should have a binder we provided during the break. There, if you could turn please to tab 16. This is the list of Kentucky registered legislative employers as of March 26, 2019. This is an excerpt. We provided the full version to your council.
Okay.
Chairman, at this time, I'd like to mark that as an AG Exhibit 16 out of order, just for sake of clarity,
Let it be so marked.
and admit it to the record if there is no objection. So,
Is there an objection, Mr. Hughes, to introduce this? That could be filed into evidence as AG Exhibit 1.
16, yes.
16, 16, I'm sorry.
Okay, Mr. Martin, you there?
Yes, sir.
Okay. So if you could turn to the second page provided there. And towards the bottom, Atmos is listed and also displays your name and contact information in bold print. Is that correct?
In the middle of the page, yes, my name is in bold print, yes.
Okay. And so you are the person within Atmos in the state of Kentucky in charge of lobbying.
No, that's not correct.
Well, how would you explain it then?
I file, they're not necessarily monthly, but periodically throughout the calendar year, the Ethics Commission requires us to file reports that kind of outline our lobbying activity. And Mr. Ashcraft, whose name is below the Atmos Energy name, is our contract lobbyist in the state of Kentucky. I purely file reports with the commission on behalf of Atmos Energy.
So do you, as for Mr. Ashcraft, do you direct his efforts? Do you help him perform his job? How does that relationship work?
Well, he doesn't work independently, so the company, whether it be myself or other people within the division or even in corporate, would talk to Mr. Ashcraft when he relays legislative reports about possible legislation before the House and Senate when the legislature's in session.
So when he relays his reports, are you always involved? Do you help communicate that?
Not always involved, no. It would depend on the circumstances.
So can you estimate how much of your time is spent dealing with this issue, lobbying in total?
It probably, I mean, I'm not trying to oversimplify it, but the reports are fairly simple. They're handwritten, so maybe it takes me 5 to 10 minutes to fill it in and scan it to the Ethics Commission.
So very, very little of your time is to file quarterly reports?
Yeah. It's more administrative than anything else.
But ultimately, you are the pivot person between Atmos Corporate and lobbying efforts in Kentucky on behalf of Atmos Energy.
No, I wouldn't say that. No, the contract is with Mr. Ashcraft. I didn't sign it. I don't know if, I'm assuming it's our Vice President of Government Affairs out of Dallas who would have signed that contract, or someone under her designation.
So would you say then that he communicates with corporate Dallas without you being involved very often?
I mean, periodically there are legislative updates, and I'm copied on those, and I'll skim through them just to see bills of interest, but that's really to the extent I'm involved in anything related to governmental affairs.
What percentage of your salary and benefits are above the line that is paid for by ratepayers?
That I'm not sure.
And post-hearing data requests, could you provide the best
I'm sure we could.
information that you
Yeah, I'm
can
sure
on
we
that?
could, whatever we have, we're glad to give you.
Thank you. So I'm going to move to an issue. So are you aware that an issue in this case is whether the commission will allow the company either a return on construction work in progress in the revenue requirement or the allowance for funds used during construction and directed to capitalize that return as AFUDC? Are you aware of that issue?
I know that's an issue, and Mr. Waller would be the best company witness to address that issue.
As far as high-level policy, though, is it not under your purview to direct the policy? Which of those you would elect to try and use?
I would not say that's my job duty to direct how the company books CWIP or AFUDDC.
So anything about that issue, you do not feel comfortable answering?
No, sir.
Anything Mr. Waller would be able to answer those
He'd
questions?
be the expert on the topic.
Okay. Okay, so in this current case, Atmos is proposing to recover forecasted PRP costs in the base revenue requirement, correct?
Yes, sir.
Could you turn in your rebuttal to page 3, please? Looking for line 15 when you're there, please.
Page 3, line 15, I am there.
Okay. Do you see where you claim that Mr. Collin, the Attorney General witness, did not consider the context in which the commission reached that decision?
Yes, I see that.
Okay. Can you now turn to tab 1 in the binder? This is the final order the commission issued in the last rate case, 2017-00349. And please turn to page 37. Chairman, I'd like to mark this as AG Exhibit 1.
Any objection to it being marked and filed, Mr.
No, sir.
Hughes? Let it be marked as AG Exhibit 1, filed in evidence.
Okay, Mr. Martin, are you there?
Page 37, yes, sir.
Yes. About halfway down, there's a sentence that starts with, the commission noted that, and then a quote, when Atmos. You see that?
I believe I see what you're referring to.
If you could read that through the paragraph on the next page, please.
Start with that sentence?
Yes.
The commission noted that, quote, when Atmos's PRP rider was approved in 2010, the 15-year program included the replacement of 250 miles of bare steel pipe and services at an estimated cost to be $124 million, period. Atmos subsequently discovered that there was an additional 100 miles of bare steel pipe to be replaced, and then added the replacement of the Shelbyville line at a cost of $21.7 million, and the Lake City line at a cost of $5.7 million, both due to safety and reliability concerns. Atmos now estimates that the cost of the pipe replacement program to be $438 million, or 350 miles of bare steel pipes and services in the 2 additional projects, period. Thus, the cost per mile for replacing the bare steel pipe and services has more than doubled from just under $500,000 per mile to just over $1.1 million per mile. Atmos affirmed in that case and reiterated during the course of this proceeding its intent to complete the PRP within the 15-year time period originally approved in case number 2009-00354.
Okay, thank you. So after reading that, isn't it true then that this part of the commission's order arose out of the context of Atmos's overspending and under the PRP program?
I disagree with the premise of the question. You know, the company probably could have done a better job last year explaining those costs, and we've got 3 expert witnesses here today to validate the costs of all of our capital projects, but I disagree that we were overspending.
But the costs were higher than originally anticipated.
Well, I
Much
think what
higher.
gets lost in the shuffle is a lot is really kind of hung right, wrong, or indifferent on that 2009 order, and I believe the company has really gone out of its way on multiple occasions to talk about how a lot of things that were in that 2009 application where the PRP was approved that estimates just aren't valid today. Unfortunately, it never came to fruition. So we've updated those numbers. We try to be as transparent as possible, but I would not ever agree that we overspent.
Okay, could you turn to page 40 of that order?
Yes, sir?
And towards the top of the page, the third line, just read that one sentence that starts with the eligible bare steel.
The eligible bare steel pipeline replacements for which Atmos's PRP is approved, however, cannot be reasonably made and funded by ratepayers at the levels estimated by Atmos for the PRP programs years of 2019 through 2022.
So isn't it also true then that the commission expressly found that Atmos's annual recovery of investment can and should be limited without risk to public safety?
I think the company could have done a better job explaining its forecasting and its projections. Unfortunately, we're living with this order, but we could have done a better job last year. And so the commission asked us to extend the replacement of bare steel, which we're complying with.
So if you look at the next page, 41, toward the bottom, middle of the bottom paragraph, there's a sentence that starts with Atmos is inconsistent and unsupported.
Yes, sir?
Could you please read that onto the next page, the paragraph?
Atmos's inconsistent and unsupported estimates for PRP eligible projects that it states are necessary to complete the program is of great concern to the commission. Atmos's projections based on a 12% future annual escalation rate resulted in an estimated $517.8 million remaining investment amount that caused the commission to question the reliability of the estimates and the reasonableness of the program as currently constructed. Do you want me to keep going?
Yeah, actually, please keep going to the end of that paragraph.
Atmos stated in its April 20th, 2018 response that the PRP estimates for 2023 through 2025 that it provided in case number 2017-00308, and which it has continued to support in this case, $70.7 million in 2023, $79.2 million in 2024, and $88.7 million in 2025 are actually costs of estimated miles of early generation and unlocatable plastic pipe, which are not currently eligible for replacement through the PRP. The commission therefore finds these future cost estimates to be speculative despite Atmos' reliance on past commission decisions concerning eligibility of projects beyond bare steel, and no conclusions can be reached about the appropriate time frame for their recovery in this proceeding.
Thank you. So then again, after reading that, wouldn't it therefore be true that the context out of which the commission has issued this final order in that rate case arose out of, one, the cost per mile of replacing bare steel pipe that had doubled, and then two, Atmos's use of forecasted cost projections, which had a 12% annual rate escalation?
Yeah, that's what I mentioned earlier. You know, I think we caused a lot of confusion last year when we were asked in the PRP docket to forecast the spend from the current period through the end of the PRP period. And the company at that time had a 12% escalator. And those costs obviously rose and caused concern.
Which were noted as speculative, correct?
Well, we got Mr. Smith here today, and he can discuss not only PRP capital projects, but non-PRP capital projects and support all of the projects. All the projects that we propose in this filing, we fully support. Mr. Collin has provided no information to rebut any of the projects that we proposed.
So I'm sorry to have you keep switching back. At your rebuttal testimony, page 3, line 16. Could you read the sentence that starts with "the commission changed"?
Sure. The commission changed the PRP rider, quote, "in order to remove any question as to the reasonableness of the ratepayer-funded PRP," end quote.
Okay, so there you're citing to page 42 of the commission's final order, the one we've been reading from, is that right?
Yes, sir.
So we're gonna go back to the final order, same page 42,
Okay.
and this is probably one more paragraph that starts with KRS 278 in the middle of the page there.
Would you like me to?
Yeah, if you could read that paragraph into the record, please.
Sure. KRS 278.509 authorizes the recovery of PRP investment costs only when the commission has deemed the cost to be fair, just, and reasonable. In order to remove any question as to the reasonableness of the ratepayer-funded PRP, we therefore find that Atmos's recovery of PRP investment should be based on actual spending subject to the $28 million cap in an historic 12-month period, and that budget estimates for funding a future PRP period will no longer be accepted as the basis for calculating the PRP rider rate.
So now in this case, isn't it true that in contravention of that order language, Atmos is once again back to using forecasted estimates as a basis for replacing pipe?
The company has no intention to be disrespectful and was never trying to ignore a commission order. Basically, the company has a long history of a great working relationship with this commission. We deem that relationship to be a partnership. However, trying to reconcile the impacts of the commission's order last year, the company decided to use this rate case to address those issues. We've used a forecasted rate case for at least 20 years. The PRP is and has always been permissive, and we're not aware of any other utility company that utilizes a forward-looking test year along with an historic rider.
When you say permissive, can you explain what you mean?
The other tariff says we may file, it doesn't say we shall file.
So Atmos's current proposal includes both historic and forecast costs, is that correct?
Yes, sir.
The historic costs incurred and forecasted prior to the beginning of the test year, and then forecast for the test year, is that right? It's kind
Yes.
of a jumble, but yeah. And then the company is proposing to recover certain pipe replacements costs under the title of non-PRP costs, is that right?
Currently, the company is on a 95-year replacement cycle. Mr. Smith can discuss why a more adequate replacement cycle is something less than 95 years. Please note, the 2014 PRP order stated that pipe replacement programs were not limited to bare steel replacement. However, out of the 17 order, which was issued last year, the company is committed to spending $28 million a year on bare steel projects through 2027. However, I've already mentioned the 95-year replacement cycle. I don't know why anybody wants 95-year-old pipe in the ground. The longer you wait, the older it gets. There is other additional types of pipe that need to be replaced. Mr. Smith is here. He can be able to discuss all PRP capital projects as well as non-PRP capital projects in Kentucky. We've also got Mr. McDill here that can talk about from an industry perspective. The company was very proactive in 2009, and the commission approved a mechanism which allowed us to replace aging infrastructure. We did that prior to any national incidents. Again, I already mentioned Mr. McDill, and he can talk about that industry perspective. However, there's been enough incidents across the country to raise awareness, not only to the industry, but also to regulators, for the need to replace, on an accelerated basis, aging infrastructure.
So then, just in terms of the actual total spend, if the commission were to compare the total amount of proposed capital spending, in this case, regardless of how the company has characterized it, that total would nearly approximate the level of total capital spending the company proposed in its last base rate application. Is that correct?
Subject to check.
Now, is Atmos, it is not anticipating an influx of new customers, is it?
Growth is not the only factor when determining capital investments. Number one, safety, reliability. Our goal is to be the safest provider of natural gas service. I mean, we're committed. It's our blue chip. We're all in. So, I mean, you can't put a price on safety.
Sure, but growth itself is relatively flat, is that right?
We've had modest growth over the last couple of years, mostly in the residential class.
And now, Atmos controls its capital expenditures. Would you agree with that?
Mr. Smith will be the best person to address that, but what I can tell you is in any given year, the company has more projects than capital dollars. I've already stated we're currently on a 95-year replacement cycle in Kentucky. Mr. Smith can address why a 95-year cycle is not adequate.
You could turn to tab 2 in the binder, please.
I'm there.
So tab 2 is the company's response to the Attorney General's data request set number 1. This is question 1. I'd like to mark this as AG Exhibit 2. Admitted, no objection.
Any objection, Mr. Hughes? Yes. That would be marked and filed as AG Exhibit 2.
On that first page there, Mr. Martin, you see the subpart A?
Yes, sir.
Request. Could you just read the subpart A question, please?
Subpart A, is Atmos in control of capital expenditures such when it replaces infrastructure, question mark? If not, who controls the capital expenditures of Atmos, question mark, the PSC, question mark?
And if you would turn the page, and please read the response to A from the company.
The response was yes, to the extent its level of investment ensures compliance with federal, state, and local regulations, Atmos Energy manages the pace with which investments is made in infrastructure replacement as well as all other capital investment. The company strives to be the safest provider of natural gas service and will always operate a safe and reliable service. Period.
Now, as a general matter, isn't it true that increasing rate base by means of capital expenditures has the effect of increasing the company's top line base revenues as well as its bottom line income?
Well, financial health is very important, and this commission knows all about that with the city of Drakesboro and all the situations that are going on there. However, that is not the only factor when determining capital investments.
Sure.
As I mentioned earlier, safety is number one. Safety, reliability, growth. There are other factors, but yes, financial health is important.
And increasing the revenue as well as income will happen even if you're having little to no customer growth. Is that correct as a general matter?
Again, growth is not the end-all, cure-all factor for capital investments.
Understood.
Safety and reliability is job one.
So, now can I reconfirm your Vice President Rates and Regulatory Affairs, correct?
Yes, sir.
So you understand as a general matter how the revenue requirement in this case is determined?
From a general point of view, yes, but any technical questions really need to be addressed of Mr. Waller.
Okay. Well, I think this is high level enough that you, I'm not.
Well, I appreciate your confidence
I trust
in
that
it.
you can understand what I'm gonna, I'm no, requirement genius either, so would you understand the interplay between the company's required rate of return and the company's rate base? Is that right?
Yes, sir.
Okay. And then you would also agree that generally the company's operating income is determined by multiplying its rate base by that required rate of return.
Yes, sir.
Okay. So if we look at tab 17, please, in the binder. Chairman, I'd like to mark this as AG Exhibit 17. No
Any
objection?
objection, Mr. Reeves? Let it be marked and filed as AG Exhibit 17.
And now this first page is a revised filing requirement, 16.8A, Schedule A.1, page 4. And this was first filed in response to the company's response to staff data request 264.
I would note at the top of the page, it says witness Waller, and I would think he would be the most appropriate person to ask any
Well-
questions related to this.
You mean even just recognizing what these lines mean and what, how they relate, you would not feel comfortable with that?
I think he'd be the best person to answer them. I mean, I could talk globally about whatever you want to, but again, Mr. Waller's the witness on this particular exhibit.
Well, if you prefer I push to him, then I can ask them of him.
Sure.
Okay.
Thank you.
That's all for now, Chairman.
Let's go, questions?
We do have some questions. Good afternoon, Mr. Martin.
Good day, how are you?
I'm good. I'm going to do my best not to be repetitive over anything you just discussed with the Attorney General, but a few questions may overlap.
Sure, I understand.
Please bear with me. So could you please refer to Commission staff's second request for information, item 4? Just let me know when you're there.
I'm there.
Okay. And can you explain why Atmos only used 325 new customers in the company's forecast when the number of customers added in the most recent 3 fiscal years has actually averaged 619 new customers per year?
I believe we used 325 because the average was 327, and we rounded it to 325, subject to check.
Well, based on your response, Atmos went all the way back to 2015 and then averaged that through 2017. But 2015, Atmos actually lost 82 customers.
I believe there was a prior data request that talked about last case and this case, and last case was average of 300, at this case was an average of rounded to 325. And if given a moment, I'm pretty sure it was
Take your time.
staff that asked that question. I think if you looked at staff question 2-29, that is a little bit more descriptive, the attachment to 2-29. And for last case, which is 2017-00349, the 3 fiscal years that were averaged were 14, 15, and 16, which the 3-year average was 302. And we rounded to 300. And then for this case, it appears it was the average of 15, 16, and 17, which the 3-year average was 327, and the adjustment was rounded to 325.
So then, in that line of thinking, would the next annual rate case be, averaging 16, 17, and 18?
Yes, ma'am.
Okay. I think that will answer, the financial staff's question, but if not, we can issue a post-hearing request for clarification.
Absolutely.
And do you know whether any of the current or proposed construction projects are expansion projects, that will serve new customers?
Mr. Smith he'd be the appropriate witness, discuss any of our capital projects.
Okay, but you're not aware if any of them are designed to bring in new Atmos customers?
I specifically don't know.
So you defer all of those to Greg Smith?
Yes.
All of those questions, I should say. Okay, and so I know you touched a little bit on the pipeline replacement program with the Attorney General's office, but subject to check, was the PRP rider originally approved by the commission on around May 28, 2010?
That's subject to check. I would agree with that. I know we filed it in 2009 because I had a 2009 docket number.
Yes, 2009 354 is the case number.
Yeah, but when the actual order came out, I'll stand by your date.
Okay, and you've already discussed a little bit of the overview of the PRP, but can you kind of expound on the large increase in the cost of the pipeline replacement program since its inception in 2010, when Atmos estimated the cost of $124 million to Atmos's estimated cost of $438 million in case number 2017-308, which I believe is Atmos's last PRP docket?
Yeah, I can touch on a few things, but Mr. Smith's going to be the perfect witness because prior to his role, or one of his prior roles, he was the manager of our pipe replacement program in Kentucky. And he will be able to address why costs today are different than what the company had forecasted back in 2009.
Did you want to go ahead and expound on a little bit of it at this time?
I think there was just some things that the company didn't envision at that time. Cross-bore inspection was one of those. I think we do pre and post videos to ensure we're not boring into a sewer line and things of that nature. That's just one example that kind of comes to the top of my head, but Mr. Smith will be able to itemize all those.
Okay, and then the last estimate that I could find in any of the records that Atmos has provided on the pipeline replacement program was the $438 million. Do you know if that's still accurate?
I'll defer to Mr. Smith.
Do you know if Atmos is still on track to complete the pipeline replacement program by 2027?
We're committed to having all bare steel out of the ground by 2027 per commission order.
And then anything that is not bare steel, are you going to flow that through the non-PRP projects?
Well,
Such as the Adelaide pipes and?
Our plan now, after the order from last year's rate case, is we'll be filing annual cases. It appears that the rate case process provides more transparency and allows for more time for review. As you can see, Mr. Hughes has got 4 boxes of information behind him, so obviously the record in this case proves that there's a lot more time and information available. And also, you know, when we kind of step back from last year's rate case, again, subject to check, you know, there was, I don't want to say it was the last 3, maybe it was 3 out of 4, but the PRP orders were not coming out prior to October 1st. That tells me that staff needed additional time to review those projects, which obviously the rate case process is longer than the 2 months per the tariff.
Okay, so I don't think you quite answered my question about anything. You said all the bare steel that Atmos is committed to replacing that by 2027. But then what about the other pipes, like the Adelaide pipes? Are you going to flow that through the non-PRP capital investment?
Yeah, our plan is to file annual rate cases, and those rate cases, the commission, staff, and any interveners will have full transparency over the proposed projects that the company proposes to replace.
Okay, and would Atmos be designating still PRP versus non-PRP projects? Do you envision that?
We're committed to $28 million per year for bare steel replacement through 2027.
So you will still specify between the PRP versus non-PRP?
The way I will be happy to do whatever the commission wants us to do, but we can surely designate those programs so it's easy for staff to be able to reconcile that the company is indeed doing what it says it's gonna do.
Okay, and I realize you deferred the question about the cost to Mr. Smith, but the commission staff will issue a post-hearing request for information, just asking for some details about the cost and if there's been any changes in the capital expenditures for the pipeline replacement program since the last order.
Okay?
And then can you explain how the commission's final order in case number 2017-349 affected the operation of Atmos's pipeline replacement program? Just the highlights.
Affected, I'm not sure.
So it created the 28 million cap, correct?
Yes. Yes, it
And
did.
then it also implemented a historical test period, correct? To use
I
for the
believe if I
PRP.
understand the order correctly, if we were to use the PRP rider,
Right.
then it would be based on an historical period.
Yes, and Atmos, correct me if I'm wrong, but Atmos has stated throughout the testimony and the record that they do not have objection to the 28 million cap that was placed on the PRP program and rider, but it had problems with the historical test period, that portion of it. Is that
Well,
correct?
Well, we believe, we've used a forward-looking test year, like I said, for at least the last 20 years, and we view the PRP rider in of itself to be permissive. So, in our minds, it's simpler and more transparent for us to make one filing a year and for the commission to have that full rate case timeline, as allowed by statute, to review all of the company's projects, which would include 28 million isolated for bare steel replacement.
Okay, but specifically, can you confirm that in the totality of Atmos's filings and responses and testimony and rebuttal, that Atmos does not seem to have a problem with the 28 million cap on the PRP, but it was the historical nature that Atmos felt like it would cause too much regulatory lag. Is that correct?
That's a fair question.
Has Atmos followed the changes that were implemented to the PRP program rider from the last order?
We believe so, yes.
And can you confirm that Atmos is requesting to cancel its pipeline replacement program
Yes.
and delete the associated tariff, correct?
Yes, ma'am.
And can you also confirm that due to Atmos requesting to cancel its pipeline replacement program, Atmos intends to file annual forecasted test period base rate cases?
Yes, ma'am.
Can you please refer to page 21 of the Attorney General's witnesses, Mr. Collins' testimony, and just let me know when you're there.
Jack, I don't. I'm sorry, was it page 21 of?
Page 21 of Lane Collins' testimony.
Thank you. I'm there.
Okay. And subject to check, does the table that appears on page 21 appear to be an accurate reflection of Atmos's PRP and non-PRP investment numbers?
Subject to check, I would agree.
Okay.
Those appear to be what I recall.
Okay. And so according to the table, and obviously all of this is subject to check, what was Atmos's total PRP investment in 2018?
PRP investment 2018, 45.9 million.
And what was Atmos's total non-PRP investment in 2018?
33.9 million.
Then pursuant to the cap that was placed on Atmos's PRP in the final order in case number 2017-349, Atmos is forecasting $28 million of PRP investment for both 2019 and 2020, correct?
I'm sorry, could you repeat your question?
Based on the $28 million cap that the commission placed on PRP investment in the last rate case final order, it appears that Atmos is forecasting $28 million roughly for both 2019 and 2020 for the PRP investment. Is that correct?
Yes, ma'am, that's correct.
And can you read into the record what Atmos's proposed non-PRP investment is for 2019?
2019 is $58.7 million.
And then for 2020, can you read into the record what the proposed non-PRP investment is for 2020?
68.7 million.
Is it fair to say that Atmos's projected non-PRP investment for 2020 is essentially double what it was in 2018?
Well, I think that's for the entire fiscal year, and the entire fiscal year is not in the company's test period. So anything outside of the test period is not really relevant to this rate case. We're not filing for a multi-year plan, and each rate case will stand on its own. As the company's already stated, it's going to file annual cases, and any future costs will be reviewed at that time.
So, correct us if we're wrong, but commission staff has that the base period for the pending application is January 1st, 2018 through December 31st, 2018, with the forecasted test period being April 1st, 2019 through March 31st, 2020. So would it not in fact cover 2019 and a portion of 2020?
Yes, you're correct.
Okay, so based on these estimated totals, if that's what you want to refer to them, is it not fair to say that the proposed either 2019 or 20 non-PRP investment is basically double what it was in 2018?
Yeah, and I was just trying to state that fiscal year 2020 is not the entire fiscal
A
year.
full
It's
year.
not in the test year.
Right. But would you confirm that it is proposed to be essentially double that of 2018?
Yes, but, you know, one thing to take into account is when the commission issued that PRP order in 2014, it was crystal clear, at least to the company, that the PRP was not limited to just replacing bare steel pipe. The company has identified other types of pipe and other aged infrastructure that needs to be replaced, and we're currently on a 95-year replacement cycle, and Mr. Smith can talk in more detail, more eloquently than I can on why a more adequate replacement cycle is less than 95 years. So the company, I think there's been some confusion, and some of that probably falls at the company's fault, because in its application in 2009, all it did mention was bare steel, but there are other types of pipe that need to be replaced. So the company was planning, and Mr. Smith can get into more of the metrics on how much Adelaide plastic pipe that we have in our system. But our plan all along was to replace aging infrastructure through the pipe replacement program, whether it was bare steel or not. However, that's now shifted, and we're gonna file annual cases.
So is it your testimony that the proposed non-PRP investment for 2019 and 2020 has basically doubled that of 2018 because you're including the other types of pipe outside of bare steel
Yeah, yes, and Mr. Smith can discuss all of our PRP capital projects as well as non-capital PRP projects.
Do you know if the drastic increase is associated with any other type of actual non-PRP projects?
Mr. Smith can be able to discuss all of the projects the company plans to do.
So it is your testimony today that the doubling of Atmos's non-PRP investment since 2018, projected out to 2019 to 2020, is not in any way connected with the commission placing a cap on the PRP of 28 million?
No, if you look back at 18, obviously our run rate that the commission approved was 45.9 million. And that 45.9 million did not contain just the replacement of bare steel. So the company is still committed and wants to have the safest, most reliable system that it possibly can. So the company has tried to gradually increase the level of capital investment to replace and accelerate the replacement of aging infrastructure, whether it's bare steel or any other type of pipe.
Okay. You state in your direct testimony that Atmos proposes to update the time period used to weather normalized revenues with the company's weather normalization adjustment. Is that correct?
Yes, ma'am. I can't remember and I apologize. I think it was the 15 rate case. The WNA was made permanent and the commission staff wanted the company to use a more current period of time to weather normalize. And the company had always traditionally used the 30-year NOAA information, which can get a little stale because they only do it in 10-year blocks. And so the company was amenable to the commission staff's suggestion, and every case since then, we've updated that 20-year period to try and have the most current data available.
Okay, well, as a post-hearing request for information, commission staff is going to request that Atmos provide the current and proposed updates to the heat sensitivity and the base load factors, as well as the supporting documentation for the same. Can you please refer to commission staff's second request for information, item 76, concerning third-party contractor damages?
Okay.
Can you please read your response into the record?
The company, in most cases, does attempt to charge the third party for 100% of repair costs. Attachment 1 is the third-party damage calculator used for Kentucky. However, many third parties are, quote, judgment-proof, end quote, or otherwise incapable of paying the company's charges. A collection agency is sometime engaged on such matters. However, the company does not ultimately recover 100% of associated repair costs.
Okay, and can you explain Atmos's specific process for determining who is at fault for incidents of damage to underground utility facilities?
The company has, damage prevention personnel and we normally, contractors are supposed to call 811 before they do any type of excavation. And then the company will mark our facilities as well as, or 811 would have the company as well as other utility companies mark their facilities in this area that's going to be excavated. And based on whether there is a mismark or the contractor fails to call 811 or disregards the marking, there can be damage to our facilities. And, the company attempts to recover as much money as possible, and any money it does recover, it credits back. Unfortunately, we've had some situations where the damage was so severe that the people just did not have the ability to pay for it.
Okay, and you said that, if I heard you correctly, you said that personnel at Atmos handles the damage claims, is that correct?
We've got people that are titled damage prevention specialists, and they work with first responders and probably work with the commission safety staff to try and get that safety message out there of how important 811 is.
As the Vice President of Rates and Regulatory Affairs for Kentucky Mid-States Division of Atmos, are you involved in that process at all?
Damage prevention, no, I mean, if there's a meeting that is available, I would definitely attend, but it's not in my purview.
Okay. As a post-hearing request for information, Commission staff is going to request an organizational chart of the people at Atmos that do make the decisions
Okay.
to determine who's at fault for incidents of damage to these underground utility facilities, including the job title.
Sounds good.
And in your response, you stated that in most cases, Atmos attempts to charge the third party for 100% of repair costs. Can you expound a little bit on what in most cases? I'm assuming you're talking about what you just referred to.
That's probably a poor choice of words. I apologize for any confusion, because we do attempt to recover as much money as possible, and obviously that would be 100%. It just depends on the situation, and whatever money we do recover, we automatically credit back. So.
Does Atmos do so with its own general counsel, in-house counsel, or do you hire outside law firms to handle it?
That's a great question. I'm not sure I know the answer, but can definitely find out for you.
Okay, Commission staff will issue another post-hearing request for information on that. And then what collection agency does Atmos use to collect repair costs?
Another great question. If you could add that to the post-hearing data request, again, we'll be glad to respond.
Okay, and we will also ask the charge that those collection agencies offer. And then, I believe that's all on that one. Please refer to Commission staff's third request for information, item 27. And I'm aware that Greg Smith did sponsor this response, but as Vice President of Rates and Regulatory Affairs for the Kentucky Mid-States Division, I'm going to ask you a few questions about the Certificate of Public Convenience and Necessity filing.
Thank you. Okay, I'm there.
Okay. So researching back to the 1990s, Commission staff can only find where Atmos has filed applications for CPCNs to bid on franchises, but no request for specific projects. Can you explain why that is?
Well, I'm assuming based on advice from legal counsel that all of those projects were deemed in the ordinary course of business and that a certificate was not needed. Again, the company will do whatever the commission and the staff want us to do. But I know we do file for all the franchises. I'm not aware of any projects that we've deemed to be outside the ordinary course of business.
Okay, that goes into my next question where, I wanted you to explain how Atmos determines which capital expenditure projects require CPCN. Do you just rely on council, or is there an internal process that happens?
If there is an internal process, I'm not part of it, so I hate to keep punting everything to Greg, but Mr. Smith may know more. If not, we'll be glad to answer that for you.
Okay. Well, in Mr. Smith's response, he states that all the proposed projects that Atmos proposes are considered ordinary, consist of primarily upgrading the existing facilities. None of the projects have material impact on the financial condition. And then he cites to a staff opinion, staff opinion 2017-005. Do you see that?
I see the citation, yes, ma'am.
Okay, and he says that staff opinion said that based upon the 2% of net plant parameter, Basically that all of Atmos's proposed projects have always or will in the future fall within those exceptions, and that's why Atmos isn't filing the CPCNs. Is that correct, your understanding?
That sounds fair.
Okay. So if Atmos is using the 2% of net plant parameter as one of the determining factors as to whether an application for a CPCN should be filed, then would it be accurate that in the base period, and all subject to check, but I took these numbers from your all schedules, that in the base period where Atmos is projecting a net utility plant of $474,440,000, then any project under approximately $9.5 million would be exempt from the CPCN requirement?
Agree with your math.
Okay, and then based on Atmos's net utility plant in the forecasted test period, which jumps to $564,564,000, then any project under approximately $11.3 million would be exempt from a CPCN requirement.
Again, I would concur.
Okay, would you agree that $9.5 million and $11.3 million are quite large amounts of money for any company to spend without commission's oversight or approval?
Again, we're not trying to do anything to limit the commission's approval. Atmos Energy Corp has a $1.5 billion CapEx on an annual basis, so $9 to $11 million projects at the corporate level, they're a dime a dozen. Again, I'll defer to Greg. I don't know how many we typically have in Kentucky that would approach that level. I know back in 2014 when we did the Shelbyville line, I think that was around a $30 million project, and we met with staff. We even solicited a staff opinion to include it in the PRP program back then. But I'm just not aware of projects of that magnitude. Doesn't mean they're not, or maybe they cover multiple fiscal years. But that's the extent of my knowledge on that.
Okay, and just to make it clear, Commission staff is not saying that Atmos has done anything wrong, that it has not complied with orders and staff opinions properly. We're just exploring in the future with the, the net utility plant growing, and if we keep going off this 2% rule of thumb, then, there'll be some large projects that the Commission may not have adequate overview over, so.
I totally understand, and trust me when I say that the company is committed to whatever oversight the commission wants, we'll give it to them.
Okay, and do you know whether Atmos has ever broken down maybe a larger project into some smaller projects, not intentionally circumventing the CPCN requirement to file an application, but that's just how it happened?
Well, not for that latter part that you mentioned. However, there have been some projects that were just so large it was going to take multiple fiscal years to accomplish. Just from a planning, design, construction, test, permitting standpoint. And again, Mr. Smith can talk more eloquently in detail about those, but there have been projects over the years that have fallen into multiple fiscal years. But there was no intention to avoid the CPCN requirement. It was more out of necessity and of workload.
Okay, we'll follow up with Mr. Smith on some of those questions, and then if we need to issue a post-hearing request for information, we can do so. And then finally, is Atmos aware that if the commission issues an order altering that 2% rule of thumb that came out in the staff opinion in the 2017-005, then the commission order will supersede the staff opinion?
Yes, ma'am.
I have no further questions.
Commissioner Cicero?
Would you agree that the order that was issued in the last Atmos rate case, the limit of $28 million was initiated on a couple of different bases? One was the fact that it appeared to be just a escalation of projected cost, which the commission didn't agree with that modeling, and because the commission thought that the accelerated rate of spending was basically more than what the commission believed that ratepayers should be subjected to in a short period of time.
No, those are great questions. I think, as I mentioned earlier, we could have really done a better job last year, and that's on us of kind of explaining, where we came up with those numbers. So we understand that the commission had concerns and wound up with the $28 million cap. However, ever since the pipe replacement program came into existence, and technically the rate started in June of 11, the company has attempted to gradually increase that capital expenditure, because it was number one going to take time to find contractors. We couldn't do it all in-house ourselves. Then, as I mentioned earlier, I mean, right now, we've just gotten to the point where we're at a 95-year replacement cycle. So, I'm not sure that's the best. We understand the concerns, and some of that, shame on us last year for not doing a better job of explaining our CapEx. But as I mentioned earlier, we got 3 expert witnesses here today that can discuss and answer any questions related to our capital projects.
Well, the only reason why I asked the question is because the capital spending in total is basically flipped. It's gone from a large projection for PRP to now a non-PRP investment. I mean, it's almost the same as it was last year, but
It's close.
You're putting it in different categories. And last year, when you came in, the Adelaide pipe replacement was included in the pipeline replacement program.
Well, Mr. Smith can address that in more detail, but I think our response was, in some of our projections, we were planning to replace Adelaide plastic pipe. I don't think the entire replacement of all 200 miles or whatever it is was in there, but, so I don't know if that helps answer your question or not.
Well, I think based on the fact that you identified, I think 350 total miles of bare steel pipe, the plan was from there to go into other types of pipe, which is why you were seeking a greater capital investment in the pipeline replacement program to just continue in those other areas where you believed it to be unsafe.
Correct.
And so the commission said, wait, too much, too fast, slow it down. But now it appears that it's just been shifted over to the other side so that the other types of pipe, other than bare steel, are now just being classified under the non-PRP investment, and the amount of spending rate continues to increase at the same rate as it did in the last rate case, but just under a different category.
Like I mentioned earlier, the company meant no disrespect to the commission whatsoever, was not trying to ignore any commission order. The company has a long-standing relationship, great working relationship with this commission, and views it as a partnership. So where we were concerned with is, like I said, we just now got to a 95-year replacement cycle. So we just now got there. I mean, we've been at this for a while. And if we slow that down, obviously, it's going to be larger than 95 years from a replacement cycle standpoint.
Well, I think the big issue that I have is that in 2013, the total spending was $35.5 million. And now projected for 2020, which is basically 8 years later, the amount of capital spending will have tripled to $96.7 million is what's projected.
Well, I understand your concern, but please know that we do have the lowest rates in the state. And we're projected, I think we were even asked some data requests, that if we got 100% of our ask, what would that do to our rates? And the average annual residential customer, if it was served by Atmos Energy, which thank goodness I am, would have the lowest rates in the state.
I guess part of the concern is, even looking at the years 2018, from 17 to 18, 18 to 19, and 19 to 20, not only does it flip between categories, but the rate of increase in capital spending increases 9.5%, 8.6%, and 11.5%. So your total capital spend continues to increase close to double digit,
even at the higher value going forward? And at what point will you reach a level where you're not continuing this 10% additional capital spending each year on a larger value from the year before?
It's a great question, and, I think I've addressed it a little bit, and Mr. Smith can talk more about it, but, we believe the replacement cycle should be less than 95 years. So at some point, whatever that number is, we believe all the projects that we proposed in this case, we've justified. We would argue that Mr. Collin has not provided anything to rebut the reasonableness of those projects. At some point, like you said, you have to reach a level that this commission is comfortable with of a replacement cycle. And like I've said, we're just now got the 95-year replacement cycle.
Well, I look at the net plant value of $177 million in 2008, and based on the way your capital spending has increased, you'll be over $1 billion Kentucky company in about 5 years.
We're committed to being the safest and most reliable provider.
Well, one last question for you. It must take additional resources in order to manage a budget that's tripled over the last 8 years. What kind of staffing increases has Atmos had to, what are the increases it's had to have in order to manage this type of a program? Because, triple the spending, I imagine you have to add bodies.
Well, Mr. Smith, he was the first ever engineering manager that was over the Kentucky pipe replacement program. He could talk probably better about headcount, but we've added several engineers, we've added several project specialists that kind of manage that workload. The mapping department has got a lot more bodies, but I can't give you a specific number. But there have been, as we try to do as much with technology and be as efficient as possible, but we have had to add additional resources, like you said, to manage all the projects.
Are those bodies assigned to a project, or are they a general overhead that's just incurred by Atmos at a local level? I know it doesn't come from Dallas, I was already told that, so.
Yeah, it's a great question. I don't know if they do work outside of Kentucky PRP. If they do purely Kentucky PRP type work or any pipe replacement work, any type of capital work, those costs would be directed to Kentucky. If they handle multiple jurisdictions, those costs would be allocated amongst our division, but I don't know.
Let me rephrase it a different way. You show a capital project and the total cost of the capital project, and I'm curious whether that staff that's administering those projects is allocated into the capital project or whether it remains an expense.
Yeah, I apologize, I misunderstood your question. They're not in the projects themselves. No.
Okay, so that's an additional cost to whatever
They're in our
increase in
it's the
spending
cost of
that there
service.
is. This is separate from that.
Yes, sir.
Okay, so as a post-hearing data request, can I have the number of staff that's been added in order to manage the capital project increase?
Sure.
Thank you. I don't have anything else.
Mr. Matthews?
I don't have any questions.
I don't have any questions. Mr. Hughes?
Yes, sir.
I have one follow-up, Chair. Mr. Martin, you mentioned your low rates.
Yes, sir. Proud of them.
Can you tell me, does the company have the company done any studies internally as to what it would do if natural gas prices rise, especially to the rates maybe you've seen 10 years ago, as to capital expenditures and how customers could afford these types of projects?
Well, that's a great question because our rates are already the lowest, and gas cost is purely a pass-through, so we're buying gas either equal to or less than what everybody else is. So all the other companies in Kentucky's GCAs would go up. So under that simple math, we'd still be the lowest. Now, how that impacts customers, I don't know, because fortunately, we're blessed to be in a low, stable environment, and prices are forecasted to be in that low, stable environment for the next several years. I don't think there's a NYMEX above $3 for 5 years. Now, that can change, the NYMEX changes daily, but we're blessed to be in a low stable natural gas price environment.
Is there any, can you provide any, in a post-hearing data request, any sort of study that might explain in more detail that analysis?
We could print off the NYMEX for you, but we haven't done a study per se.
Okay, there's no study. That's all, Chairman.
No further
Go.
questions.
Anything else, Mr. Hughes? May this witness be excused?
He may.
You may step down and you're excused, Mr. Martin. Thank you. All right, it's now noon, so let's break for lunch until 1 o'clock.
Chairman, if I may, before we go off the record, Mr. Martin has passed 2 lines of questions to another witness, and Mr. McNeil had prepared a line of questioning on one of those issues. So when that witness comes, I would just ask that if Mr. McNeil will be allowed to ask that one line of questions, then I would pick up the rest of those questions.
Of course, that won't be a problem. Thank you. We'll be
Thank
in
you.
recess until 1 o'clock.
Mr. Chairman?
Okay, we're now back on the record. Mr. Hughes, do you have another witness?
Yes, sir. Mr. McDill?
Please raise your right hand. Do you solemnly swear or affirm under penalty of perjury that the testimony you're about to give will be the truth, the whole truth, and nothing but the truth?
Yes, sir.
You see.
Could you state your name and your business address?
John S. McDill, 5430 LBJ Freeway, Dallas, Texas.
And what is your position with Atmos?
Vice President, Pipeline Safety.
Have you filed rebuttal testimony in this case?
I have.
Do you have any changes, corrections, or additions to that testimony today?
I do not.
Well, if asked those questions under oath today, would your answers be the same?
Yes, they will.
And nothing further.
Any questions, Mr. Cook?
Yes, we do have some questions, Chairman. Good afternoon, Mr. McDill.
Good afternoon.
You did not file direct testimony in this case, did you?
No, sir, I did not.
Okay. Could you turn to your rebuttal at page 14 and let me know when you're there?
I'm here.
All right. And now, there you discuss measures that the FERC takes to incentivize interstate gas pipeline companies like Columbia Gas Transmission Company to maintain their pipes utilizing forward-looking test years. Isn't that correct?
Is there a particular line number that you were referencing? I'm sorry.
Starting at line 12.
That is how that reads, yes, sir.
Okay, good. FERC doesn't regulate in the same manner that the Kentucky Commission does it?
It does not regulate us in that same manner, that's correct.
All right. Isn't it true that Atmos in Kentucky is required to maintain its pipes in order to ensure safe and reliable service regardless of the cost recovery mechanisms in place?
We have an obligation to maintain safe and reliable service.
Right. Isn't it true that the PRP, even if it utilizes historic costs, provides more rapid cost recovery than a base rate case?
Could you repeat your question? I'm sorry.
Sure. Isn't it true that the PRP, even if it utilizes historic costs, provides more rapid cost recovery than a base rate case?
If the PRP, the funding of that,
Yes.
if it provides more proactive replacement, do you say?
More rapid cost recovery.
Yeah. I've not studied the PRP, mechanism for the financial recovery. Yeah, those questions would be better asked by a different witness.
Do you know which witness that would be?
I would say that would be Mr. Waller.
Mr. Wong. That's all the questions we have at this time, Mr. Chairman.
Ms. Coe, questions?
We do have a few questions. Good afternoon, Mr. McDill.
Good afternoon.
Can you please refer to your rebuttal testimony at page 7, lines 3 through 9, and read that section into the record, please?
So on page 7, starting at line 3.
3 through 9, please.
3
that
through
first
9.
paragraph.
Yeah, the question is the company's only goal to provide safe and reliable service? The answer is no, we must be fiscally responsible as well. Under well-established principles of utility regulation, utilities must have the duty to provide customers with safe and reliable utility service at reasonable rates, and in return, utility shareholders are allowed the opportunity to earn a fair rate of return on their investments. However, in balancing these competing considerations, it's critical that neither Atmos nor the Commission allow the goal of providing low-cost service to jeopardize the undertaking of initiatives to maintain a safe and reliable system.
Okay, thank you. And so in that rebuttal testimony, you state that being fiscally responsible is one of Atmos's goals, but then you also state that Atmos nor the Commission should allow the goal of providing low-cost service to jeopardize the undertaking of its initiatives to maintain a safe and reliable system, correct?
That's what it reads.
And do you believe that Atmos's request to increase non-PRP investment from approximately $33.9 million in 2018 to $58.7 million in 2019 and $68.7 million in 2020 is properly balancing these competing interests?
Yeah, I would, with respect to the exact financial numbers, those numbers are developed by the division. I do know that with respect to the focus on safety, and if you look through my testimony, my rebuttal testimony, there are examples throughout where utilities operators are being called upon to more proactively and systematically identify risks that are placed on our system. And in doing so, to address those risks, we have to invest at higher levels to offset those risks that we face. The specific numbers are developed by the division in conjunction of working with other shared services groups. And so the specific numbers, I would have to, someone in the division would have to more specifically answer those questions.
And I understand that we can follow up with, you said, Mr. Waller on the specific numbers.
Correct.
But just in general, you do make the statement that being fiscally responsible is one of Atmos's goals in your rebuttal testimony, correct?
That's correct.
And do you think that it's fiscally responsible for Atmos to request the non-PRP, an increase in the non-PRP investment by basically double?
Yeah, I've not tried to, analyze the funding request. I know it's already been testified already that the needs continue to be there for replacement of aging infrastructure, and that we're working with the Commission on the pace of addressing those needs to replace those assets.
So if the level of non-PRP investment is required to be at these increased levels, that's basically doubling the 2018 non-PRP investment, and you're saying, I assume it's for safety purposes, correct?
Correct.
So why was Atmos's non-PRP investment anywhere between $18.3 million in 2013 and $33.9 million in 2018?
Yeah, that's questions really would be best directed towards our witness, either Greg Waller or Greg Smith.
Has Atmos taken any opportunity to slow the pace of capital investment when it could safely do so?
I'm not involved with the execution of the capital, and I think has already been testified to already. The needs to invest in an infrastructure are really driven by federal regulations and directives that call upon operators and commissions to work together to develop in a proactive way, to develop a systematic way to help offset those risks in a pace that makes best sense for that jurisdiction.
Can you explain whether Atmos considers the associated rate impacts when it creates its capital budgets?
I'm not in the, it's not my role in the development of capital budgets.
So would you defer to Mr. Waller or Mr. Smith, or both?
Yes.
Both?
Yes.
You state in your rebuttal testimony on page 7 that Atmos's natural gas pipeline system in Kentucky is not in imminent danger of catastrophic failure. But then you also state that delaying pipe replacement until there's an imminent threat to public safety is obviously not good public policy. Do you confirm that that's what's in your testimony, your rebuttal
That's
testimony?
correct.
So what level of deceleration of replacement of pipeline would you consider an imminent threat to public policy?
I would not, the question about deceleration, I think has already been, testified to earlier, that the pace of replacement that we're on now is an long period of time, and I think that if we examine federal orders and directives that came out from the Department of Transportation and also from the regulatory agency, the Pipeline Hazardous Material Safety Administration, they came to a conclusion based on tragic incidents that were happening around the nation that the pace of replacement needed to increase. And I think that we're still in a phase, and I think was recognized by this commission early on, that there needed to be a means by which the pace of replacement needed to increase. And I think we're still in that phase today.
So when Mr. Martin said earlier on the stand that the pace of replacement for Atmos is 95 years, is that Atmos as a whole or the Atmos Kentucky operations?
Well, I think that question would best be directed for Kentucky specific to Mr. Greg Smith.
Mr. Smith?
Yes.
Well, can I interrupt for a second? Aren't you the VP over all the pipeline replacement program?
Yes, sir, I am.
And the 95 your replacement cycle, you're saying that you're not certain how Kentucky compares with the rest of the system?
I'm sorry, if that's the question, I misunderstood. I thought she was asking specifically around the Kentucky, the calculation for Kentucky.
Okay, maybe I got that wrong, but then let me finish my question.
Sure.
I'm curious how the 95-year cycle for Kentucky compares to the rest of Atmos.
It's a good question. I think it varies. What we have spoken to is that we operate about 76,000 miles of pipe. And if we look out over a 5-year period of time, we think that we will replace about 5,000 to 6,000 miles of pipe a year. 5,000 to 6,000 miles of pipe over that 5-year period of time. So at least in that 5-year window of time, we think that we replace approximately 1,000 miles a year during that period of time. How that sustains beyond that, I'm not sure, but that is the number that we have forecasted that we would replace over the next 5-year period of time when we operate 76,000 miles of pipe.
Of course, it has to be based on topography, various other factors. I guess the pipe is pretty standardized throughout the system as far as a replacement, but I don't know what the pipe is that you're actually replacing. Do you have some kind of schedule that shows system-wide what the cycle is and what the plans are?
I don't have a schedule. I think the pipe materials vary by jurisdiction as they were constructed over the years, by the decade, based on material that was available, to the operating companies at that time, or even in the industry. I think the materials really are just dependent upon those that were available at that time for that company that was operating those jurisdictions.
Okay, I'm not sure they'd answer my question, but if you can provide us with a schedule of what the cycles are for the various states, and then show Kentucky as a post-hearing data request.
Okay?
I'm sorry, I didn't mean to interrupt you.
No problem. So we will issue that specific question as a post-hearing data request, and then we'll also follow up with Mr. Smith.
Okay.
So is it your contention in your rebuttal testimony in here today that any level of replacement of pipelines below Atmos's proposed level is unsafe somehow?
I don't think my testimony says that. I think my testimony reflects that there is a need. The Department of Transportation has characterized some materials as being, higher risk materials, that being bare steel, alloy, plastics. So they have called those out as being higher risk. And I think that we will continue to invest in matters that address immediate safety needs, plus also ensure that we continue to meet state and federal requirements.
Okay, and finally, do you know the percentage of high relative risk assets that Atmos plans to replace on an annual basis?
I do not.
Is there anyone here that would know the answer to that question?
That we state your question one more time.
In your rebuttal testimony, you discussed high relative risk assets. Do you know the percentage of high relative risk assets that Atmos plans to replace on an annual basis?
Would you mind pointing to my rebuttal testimony of where that's made?
Just one moment. Okay, you can turn to page 9 of your rebuttal testimony.
Okay?
And on line 13, it says, have other jurisdictions in which Atmos Energy operates also created such a regulatory environment? Do you see that part?
I see that.
So can you read lines 15 through 20 into the record?
So starting on line 15 of page 9,
Yes.
the answer, yes, Texas has enacted policy measures that mandate the company replace a certain percentage of high relative risk assets on an annual basis and provided methods for the company to recover that investment. Similarly, Louisiana, Mississippi, Tennessee, Virginia, and Colorado have also enacted similar policy measures to mitigate risk by permitting recovery of infrastructure investment on an annual basis.
Okay, so that's what the question's referring to, is do you know the percentage of high relative risk assets that Atmos plans to replace on an annual basis?
I can tell you that this is, the high relative risk was speaking to the Texas requirement,
Okay,
which their requirement has a minimum replacement of 5% of the highest relative risk assets on an annual basis.
and does Atmos use any of that same philosophy on the Kentucky assets, or?
That was an order that was entered into by the commission, the Railroad Commission of Texas.
Okay, no further questions at this time.
Mr. Cicero, questions?
So you mentioned that Texas has a minimum of 5% replacement on high-risk assets.
Of the highest relative risk, yes, sir.
Is there ever any time when Atmos does not meet that 5%? Strike that. Has there ever been a situation where Atmos was, only did the 5%?
I'm not familiar with any that we've only just done 5%. But I just, my general awareness of that is I'm not aware of that.
Okay, so you're basically doing the same thing as you are in Kentucky, and you're saying this is the pipeline that needs replaced, so this is our capital program, and we're going to replace it as much as we can do.
Sorry, would you mind restating your question?
So you look at Texas and you say, these are the this is the miles of pipeline that we have that are high risk. And so you just attack that with your capital spending and do as much as you can and never reach the level of I can only do 5%.
It's a requirement that we must do at least 5%.
Right, and my question is, you're never at the 5%, you're always somewhere above.
Yeah, I know in general that we certainly will meet our regulatory requirements. And it's the highest relative risk asset, so every time you conduct a risk assessment, it's always relative to the other assets that you assess against.
So I'm not trying to make a trick question. I'm looking at the capital spending that you have in Kentucky and the flip-flop of capital spending for pipeline replacement over into the non-pipeline replacement, which is now apparently includes Adelaide pipe and other non-bare steel pipe. So you made a decision that for safety and reliability, that pipe needs to be replaced, so you're flipping your resources over to that. And I'm curious, in Texas, that has a 5% minimum spend towards high-risk asset replacement, whether you're doing something similar as you are in Kentucky, which is to look at all of the pipe and spend as much as your capital budget will allow you to, which means that you're always in excess of 5%.
So, yeah, thank you for the clarification of the question. The requirement in Texas is non-material specific. It's about addressing the pipe with the highest relative risk, regardless of material types.
So you prioritize what the high risk is and say, this is the value of what needs to be replaced, and a minimum of 5% has to be addressed, basically according to the Texas Commission. Do you ever only spend 5% of what's been identified as that high-risk asset?
You know, the regulation has been in effect for a number of years. I don't know the answer to that. I know we spend at least the 5%.
Okay, as opposed to your debt request. You asked that question so that
Yes.
you can check the history. Thank you. Any other questions?
Mr. Matthews, questions?
I don't have any.
I have no questions. Mr. Justin? Anything else?
No questions.
May this witness be excused?
He may.
Thank you. You may
Thank
step
you.
down and you're excused, sir.
Thank you.
Greg Smith?
Please raise your right hand. You solemnly swear or affirm under penalty of perjury, the testimony you're about to give will be the truth, the whole truth, and nothing but the truth. I do. Please be seated.
Would you state your name and business address?
Greg Smith, address is 810 Crescent Center Drive, Franklin, Tennessee.
And what is your position with Atmos?
I'm the Division Vice President of Technical Services.
Have you pre-filed testimony in this case?
I've pre-filed direct and rebuttal testimony.
Do you have any corrections or additions to that testimony?
I have a slight correction to rebuttal testimony.
Okay, what is that?
My rebuttal testimony, it has to do with number of farm taps that our division currently has scheduled for replacements on page 17. And that number, after doing some field survey, that number has come down from 928 to 922.
Okay. Any other corrections that you want to make at this point?
Well, I don't know if it's appropriate or not. I do want to make a correction to something Mark Martin, a question Mark Martin was asked earlier having to do with cost allocation to projects and labor.
Go ahead.
So I think the question he was asked was, does our workforce charge time directly to capital projects? And they do. I think he misunderstood the question, but whether it is related to our bare steel replacement program or any other non-PRP project, their time is charged directly to those projects, as well as any contract labor or contract services as well.
So any projects identified as capital projects, you charge that portion of the workforce to them, and anything that's related to operating and maintenance, you just charge that to expense?
We do.
Okay, thank you.
Any other corrections or?
No, sir.
Okay, so if you were asked those questions in your testimony or rebuttal today under oath, would your answers be the same?
It would.
Your Honor, as I mentioned earlier this morning, Mr. Smith has some maps that he's prepared that might be beneficial for everybody to have while he goes through his testimony. I can pass those out now if
Why don't
you
you
think
go ahead and do
appropriate.
that, and then we'll go into executive session as soon as you do, so before you ask any questions about it.
Well, the handouts that I'm going to give you, although the maps are confidential, they won't be seen.
No, no.
And I think the questions that will be asked of him probably won't relate to specific locations of the facilities, so we can probably stay on line.
Well, I want you to be comfortable with it, so if there's
Well,
an issue,
that's
we'll
fine.
go, we'll do whatever you require.
I understand, and if we get to the point that it does have to be confidential, I'll alert the commission, but if I could, I would pass out
And to the extent if you decide to basically file that map, it'll go into the confidential record as opposed to the public.
we don't intend to, but if the commission or if the attorney general, I'm short some maps, I need two more.
Yeah, we can share.
One more right here.
There should be 12.
The first maps I gave you are system-wide maps of our service area. The maps I'm giving you now are comparing the replacement of pipe over the 8-year period to see, so you can see what has been done in the joint ERP program over time.
Okay, thank you.
With that, I have no, well, let me introduce those maps through Mr. Smith, if I could. Mr. Smith, did you prepare the maps that we have passed out now?
Yes, we did.
And is that part of your job duties to prepare maps of that nature for the company?
Part of my engineering department's job duties.
Could you generally describe the nature of the maps dealing with the overall service areas?
Sure, so we're trying to provide an illustration using these system maps of, we're talking about targeting of 3 different kinds of risk assets, being our continued work on bare steel and the low pressure systems that we have remaining in Kentucky and our aldelay and unlocatable plastic. So you can see at the top, and these maps are just simply to show kind of how this material is fragmented and spread among the many communities that we serve within the state of Kentucky.
Okay. And then the second set of maps I gave you, could you explain what they describe?
So the second set of maps, we thought it might be helpful to show the impact of all the capital spend over the last few years related to bare steel. So you will see kind of a before and after, not really an after, it's kind of current. For our 2 probably largest communities we serve in Kentucky, Bowling Green and Owensboro. So the first map that's labeled 2010 is we went back and illustrated all of the bare steel that existed in that system then in 2010. And and laid on top of that the low pressure and aldelay plastic then and now. And so you can turn to a current, and this is just current as far as projects that have closed and projects that have been mapped, the amount of noticeably bare steel and low pressure that is no longer in that system. And low pressure is one of the areas we're planning on presenting in this case for continued replacement. And the same thing for Owensboro, Kentucky, showing a snapshot of what we had in 2010 as part of the original 350 miles of bare steel and what that system now looks like as we continue to work through replacement of those facilities.
Thank you. And if any questions come up during the course of his cross-examination, he can refer to those.
Cross-examination, Mr. Cook, Mr. McMahon.
Yes, Your Honor, a few questions. Good afternoon, Mr. Smith.
Hello.
So, with regard to the non-metallic pipe that the company has slated for replacement, does the company have data on the number of leaks specifically for that pipe and loss and unaccounted for gas? Not specific to those pipe segments, no, sir. Okay. Would you be able to provide, do you have anything you can, estimates? It would be, we can estimate the amount of leaks. LNU, we really can't. That would be a
Okay.
pure estimate. We do LNU based on the system throughput from our purchase stations to our takeaway points. And there's no way to divide that on a street-by-street segment, for example.
Okay.
Could you turn to your rebuttal testimony, please, page 20? Just let me know when you're there. Yes, sir, I'm here. Okay, lines 3 to 5, could you read that sentence into the record? It would be in the public interest to allow Atmos Energy to continue its capital spending to accelerate the replacement of pipes conducted of these types of materials. And so when you make that statement, can you clarify whether it's the company's intention, or contention rather, that it's in the public interest to allow Atmos to build to standards in excess of those required by applicable law?
I'm not following your question, I'm sorry.
So, when you say it's in the public interest to spend this capital, replace these pipelines, are you only saying, you're only aiming to build to standards required by law, or are you saying you might go over those standards and build in excess of what's required?
I don't know what standards of law you're referencing to. I think our job, as it's been testified in by previous witnesses, is to always look for elimination of risk out of our system. What do we have that we feel like poses risk to customers and the public? And to be targeting those facilities for either replacement through capital spend or employing technology to mitigate those, or adjustments to our procedures or O&M. Is that
So, what can you-
halfway answer?
Well, this might be helpful. Can you turn
Okay.
to page 18
Yes, sir.
of the rebuttal? Down at line 17, one of the measures identified says escalation of grade 2 and grade 3 leaks, repairs to a higher minimum standard than required by 192.
Yes.
Is that, I mean, I guess that's sort of what I'm asking, is that common, that you're repairing over and above standards as required?
I feel like that's a very common thing that all prudent gas operators are looking to see how can they identify leaks more quickly, and then certainly repair them as soon as possible. The regulations, our O&M does lay out requirements for repairing leaks. I do not believe 192 speaks specifically to leak repair schedules.
Okay. Regarding the farm tap projects that Atmos proposes to replace, are those all owned by the company?
Turn to some farm tap information. So about half of those farm taps, and we're talking about basically small purchase stations off of a transmission line, is what we're talking about. Half of those are off of transmission lines that Atmos owns. Half of those were applied for and granted off of a third-party pipeline. In Kentucky, it's typically Texas Gas.
Okay.
So although the above-ground structure of that farm tap is owned by Atmos, the meter, the regulation, the stuff affected by the change in code, the tap itself and the below-ground valves are owned and operated by Texas Gas.
Okay. So for any of those projects that are included in replacement plans, what about the piping? Does any of the equipment the company proposes to replace include customer or third-party owned piping?
No. All the replacement of that above-ground setting is Atmos-owned facility. But to maybe the point of your question, that's what makes replacing these farm taps kind of challenging when they're not completely, they're owned by you, but it's a partnership with Texas Gas about doing the work. So we've been working since the code was put in place with scheduling and coordinating the work and replacement of Texas Gas farm taps with Texas Gas, so that they have allocated crews, schedules, materials, valves, pre-tested pipe for the work up to the ownership point of those taps, and we can do that work at the same time.
Okay. Same question on, does any of that work involve the replacement of regulators on those farm
Yes.
taps?
When we replace the farm taps, we're replacing all regulators, relief valves, inlet and outlet piping, installation of excess flow valves and meters.
And is it the same situation where some regulators might be owned by others?
No, all the regulation will be owned by us.
Okay.
You know, what would be owned by the third party in this case would be a riser and two inlet valves.
Does the distribution integrity management program include farm taps?
Our distribution integrity management program has farm taps indicated in the plan, but that's not what is driving our replacement of these farm taps. Obviously, we are replacing them and scheduling that work based on the 192.740, the 192 code.
Okay, they're just incidental to that replacement? That's right, okay. I'm curious about the forecasted test year ending March 31st, 2020. Do you have any discrete pipeline projects already planned for that year?
Yes, we have projects already planned for, we'll be entering those into our budget in a few months. So those projects have already been defined. Project level estimates have already been defined for those. And we're finishing the final touches on them, but they're ready for next fiscal year.
Is that also true for those last 6 months, the very last 6 months of the year?
Related to pipe replacement projects like bare steel?
Right.
Yes.
So you already have discrete projects for that period lined up and ready to implement?
I believe so. I know we do for the bare steel. I'll have to verify it for the other projects such as
For other?
Aldelay and the low pressure project.
As opposed to data requests, because you just clarified that? Okay.
Absolutely.
So when you say you have the projects for the last 6 months of the test year, have they already been identified? And I guess what I'm asking, are they allocated according to, say, this year's projects, and just, are there some sort of placeholder number there until your next fiscal year closes to put in those actual projects?
So the projects that we have named in this case, being the beginning of Aldelay replacement, the beginning of low pressure system replacement, the continuance of our bare steel replacement, those projects, I mean, they have a proposed kind of timeline of how long it's gonna take to do them. And they would have projects, the next projects are built, ready for budget entry for fiscal year 20. Which would be October 19 through September 30th, 2020. So that should overlay into, I think, what you're asking me about the test year.
Okay. Yeah, if you could just clarify the same thing in the proposed steering data request I just asked. So is that made clear in this filing?
This filing, we have listed all the projects that we plan on doing for the test year in this filing, yes. Specific projects with specific dollar amounts for this case.
Okay.
I'm sorry, I feel like I'm not
Yeah,
answering your question. Can you give me a specific example and I'll try to speak to it?
You know, I'm not sure I have one at hand, but yeah, we'll try and provide an example in the data request, and we'll try and resolve it that way.
Okay.
That's all I have right now, Chairman.
Ms. Go?
Yes, sir. I have some questions. How you doing, Mr. Smith?
Good, thank you.
There was some testimony earlier regarding the 95-year replacement cycle, and that at the current rate, Atmos is on a 95-year replacement cycle. I'm curious, is that with the projected capital expenditures in the base period and the test year in this case, or is that at some other level of spending?
Yes, that is with the projects in this case. And we're simply arriving at that calculation by saying within Kentucky, we have 4,250 miles of transmission and distribution pipe. And that divided by 45 miles, approximately 45 miles of pipe replaced a year comes to that number of 95 years.
So I think in your testimony, you kind of said something to the effect of, do you really want pipe in the ground for over 100 years?
I believe that was in my rebuttal, if I can find that. I don't know that I said
really
that
wasn't
that
gonna-
way. I think I was giving an example of how you could just, if you replace 1% a year, back to the discussion earlier, the previous witness, if you replace 1% a year, you're gonna end up, for us to be 42 miles a year, you're gonna end up with a 100-year-old system at some point.
With some pipes in the ground that are 100 years old,
Yes,
basically.
our system grows by 15 miles a year. It's
Okay.
typically, if you look at our DOT reports, we're growing our system by about 15 miles a year. So there's, I guess, there's some shifting of that number, but
15 miles per year.
15 miles.
So I guess the question that I had was, with respect to whether or not the pipes that are in the ground are safe and reliable, doesn't really have anything to do with the amount of years that they've been in the ground. It's more has to do with with their useful life and how long they're actually going to last. Is that correct?
That is correct. And let me clarify, I know that there's been a lot of discussion on that 95 number. That's simply a calculation based on what our capital spend is allowing us to replace right now as far as infrastructure replacement compared to how much we have in existence. But the types of projects that we are proposing for this, during this case, are risk-driven. The fact that we are targeting low-pressure, removal of the rest of our low-pressure system in light of the incident that happened in Boston, it's a really good overlay for us because half of our low-pressure systems already are bare steel. We're going to take care of half of that anyway. 60% is bare steel. So all we're saying is let's replace the rest of 40%, and we eliminate the risk of low pressure for the public and for our customers. Continued effort with our bare steel replacement, and as been talked about previously, starting on a long-term project of replacing out-of-lay plastic, which has been recognized by industry as having risk as well. And laying into that farm tap replacement and others. So I don't want to get caught up into we're just replacing pipe to hit a number. That's not what our discussion is. It's just we're identifying it based on risk, but also keeping in mind on what is the overall cycle, the age of your system.
And I wanted to talk about the specific types of projects that you are going to do, but right now, just kind of getting a more broad view. And kind of with respect to the pipes you are replacing, I think the bare steel. I think when approximately what's the approximate age of the bare steel pipes that you are proposing to replace?
So since the beginning of our bare steel was installed 30s, 40s, 50s,
Okay, so
maybe early 60s.
So that we're not hitting quite the 100-year mark on those pipes, correct? And the Adelaide A was installed in the 70s, or?
And I have that also. I don't want to provide a little bit of history of the materials. John McDill talked about the kinds of materials used in the system. So the 1960s through the early 1980s is the dates we have on our Aldo line.
Okay. So when you're talking about a system that has 4,200 miles of pipes, there actually could be pipes in your system that are older than those, just they have a useful life that might be longer than these Adelaide A pipes or the bare steel pipes. Is that accurate?
That is accurate.
Okay.
And I think that's why you speak to the fact that it really needs to be based on what we know and being proactive on what we know may present a risk within our system to the customer and to the public. Outlet pipe's a good example. I don't think when outlet pipe was put in the 1960s, they expected it to have the history it's had, where now, 50 years later, customers are looking at accelerated replacement of that material, so to your point.
And when you say Adelaide A pipe, is that a specific type of pipe that uses a specific type of plastic, or is that actually just a brand name of polyethylene pipe produced by DuPont?
Exactly. You're right.
It's a brand name?
It's a brand name
Okay.
of medium density polyethylene.
And would it only apply to Adelaide pipes that were produced before a certain year? The issues that you've referred to?
I believe the risk that's been, I think I had some notices that I put in my rebuttal testimony from PHMSA, kind of labels all Aldolay DuPont product as well as some other manufacturer types.
Okay.
That is part of that first early generation plastic.
So I'll kind of come back to that here in a second.
Okay.
You mentioned earlier, let's see. Oh, throughout your testimony, you kind of mentioned accelerated replacement plan or replacing pipes on an accelerated basis. When you say accelerated, what are you referring to? Accelerated with respect to what?
I think it's accelerated based on our historical replacement cycles. I think that's what Mark Martin had referred to, and John McDill as well, is that the expectation from regulators is that we are looking at these risks and accelerating their replacements, certainly before any failures occur.
Are you referring to accelerated, like you said, I think you indicated in your rebuttal, you don't really see an imminent risk of catastrophic failure of the system, correct?
No.
So with respect to the accelerated replacement, are you meaning essentially before they get to the point where they actually need to be replaced?
Well, you always hope you replace them before it gets to the point of a leak occurring. I mean, again, that's the whole point, is to be proactive and identify the materials that have a higher than normal chance of failure. And part of our DIM plan is to do that and then to accelerate it. So bare steel, for example, we know that as documented in our DOT reports, 40% of our leaks occur through corrosion on bare steel. And I think in my rebuttal testimony, I'm showing the trend as we have allocated capital over the last 7-8 years towards PRP. You can see that number falling dramatically.
So, and you said that as you've allocated capital,
Sure.
is the first step in the process for determining what projects are going to be conducted in a particular year the allocation of capital? And then once capital is allocated, you then determine which projects you're going to do based on the capital that's been allocated. Is that accurate?
I think I would answer it this way. My role as Vice President over Engineering and Compliance is to keep our division president and corporate management aware of what risk assets we have in our system, what things we need to be spending money on to improve safety and minimize the chance of anything occurring, whether that is completing the farm type replacement program, whether that is let's finish our low pressure replacement because it makes sense to do so, whether that is now let's work on our Aldolay plastic that is within our system. I think you've heard already, we have more miles of that risk than we would have in any one year. So I guess I would say I'm always pushing to do more. I mean, my goal is we should always be targeting more and more dollars. If I could replace the rest of our bare steel tomorrow, I say I would, but I understand that you can't. It's just you can't accelerate that fast. We can't manage those kind of projects and be able to execute on those kind of projects.
So you're saying that the need outstrips the capital that's allocated.
Yes.
But kind of back to my original question, the first step is the allocation of capital, correct?
It's not quite that black and white. We have a 5-year plan, you've heard that referred to from Atmos Energy before, where we lay out over the next 5 years what projects we want to be tackling, why we need to be tackling them, what's the reasoning. We have that conversation from a division level to a corporate level. Yes, there's a final decision that comes back to us from the board of directors that says you have X amount of dollars in capital, and that's the role we play. Okay, let's divide it up this way. But speaking from my role in the organization, it is always aimed at safety and mitigating the risk that I see on our natural gas system.
And I understand that once the capital is allocated to you, that you try and divide it up in a way that you see fit, but when the board of directors is allocating capital to you to spend on projects, what exactly are they looking at? Do you send a report saying this is the projects I want to do this year, and then they say yes or no? Or do they just say, we're going to allocate $80 million to the Kentucky division,
I
and then
think-
you, from that money, then determine what projects you want to do.
It's kind of a give and take. You know, Greg Waller's fixing to be a witness after me. You know, budget and planning comes down. We have those meetings talking about what capital may be available, where do we want to put it. My job is to represent the needs of the division. We have this need as far as setting aside money for expected growth. We have this need for setting aside money for IT and technology. We have this need in supporting risk reduction. And no doubt, we have accelerated and spent more money over the last 10 years on reducing risk than we ever have in the past. But we also have, 1/4 of our transmission and distribution system was installed prior to 192 code, prior to 1970. So I've got 1,000 miles of system that was installed prior to 1970. So there's a huge need of infrastructure replacement.
So, scratch that. When you're talking about the accelerated replacement, and actually, let me go back here. You testified, if you look at page 4 of your direct testimony, and it's line 3 through 9, and I won't ask you to read it aloud, but I will give you a second to look at it.
Yes, sir, I've read it.
You testified there that the company proposed in case number 2017-349 to accelerate the replacement of bare steel in a manner that would have resulted in the replacement of all bare steel by 2022. Is that correct?
Yes, sir.
And in this matter, you're proposing to replace the bare steel at a rate that will result in its replacement by in or about 2027. Is that correct?
Yes, it is.
And that completion date of 2027 is based on the annual investment in bare steel of $28 million. Is that correct?
That's correct.
And that $28 million doesn't include amounts for Adelaide A or any other plastic replacement, correct?
That's correct. I think we plan on coming in annually and applying for projects that would fit under those non-PRP type projects each year.
So the capital budget there was testimony earlier that the capital budget for Kentucky really didn't change much for 2019 and 2020. Is that your understanding also? The amount of capital that you're going to be spending?
The amount of capital we're spending has not changed.
Okay.
It's increased.
It hasn't changed since the 2017 proposal in 2017-349, correct?
Subject to check. I'm not exactly sure, but I take your word for it.
You believe that it's roughly the same though?
I'm sure.
So, in that case, you were proposing to replace the bare steel at a rate that would have allowed you to have it complete by 2022. Now it's going to be complete by 2027, so roughly twice as fast. And I think the cost of the bare steel was about $28 million to do in 2027. If you were replacing it twice as fast, would it cost approximately 2 times $28 million, so close to $60 million per year?
No, I'm not sure I'm following the logic of the numbers. As we do more, yes. I mean, I guess if you're just linearly extrapolating it, yes. If you're replacing twice the amount of footage, I would caution everybody on costs, because costs fluctuate greatly based on the type of projects we are doing that year. I mean, we've talked earlier about cost tripling. Well, that's not exactly true. That is, yes, some years, unit rates of costs have increased substantially over previous years, but that also could be attributed to how much we're doing, what type of facility it is, and just how expensive that piece of pipe itself was to replace. So I'm sorry, I'm getting you off track of your question.
So my question's more about, you're currently spending $28 million a year on bare steel. You'll complete in 2027 based on your current projection. If you were to have continued replacing the bare steel at the rate you wanted to in the previous rate case, and you would complete it by 2022, in 3 years as opposed to 7 years, would you agree that you would have roughly been spending $55 to $60 million a year during those years on the replacement of bare steel?
Yes, I would.
And the capital budget hasn't changed from the proposal in that rate case to the proposal here, is that correct?
Well, of course, it'd be based on approval of a capital budget that would support it.
Yes.
As was acknowledged earlier, we had plans of accelerating our bare steel replacement. Probably would have been done slightly earlier than 2022, and moving on to aldehyde plastic replacement as well.
So that's my question. Would you agree that some of the projects that have now been included in the capital spending for this case, if you had continued replacing the bare steel at the rate of basically twice as fast, that some of those projects would have been pushed back at least as far as 2022?
I'm not sure. I'd have to go back and look at what our plans kind of called for back then. I would just, again, we're looking for these projects. We're operating under the $28 million to spend for bare steel. We're going to continue to do that until we finish the bare steel that we've indicated we have on our maps and projects. And we're looking to start replacement of aldelay and finish off replacement of our low pressure systems. And we've proposed projects that we feel are driven by safety and are prudent for this case.
And I understand that you indicate you prioritize projects, but I guess my question is, are these projects that could have been put off till 2022? Or perhaps even further?
Well,
Without
I
jeopardizing
disagree
safety?
with the premise of the question. I think that our farm tap, we're certainly under order to finish our farm tap replacements. We're going to continue on that path. A year ago, I don't think the industry realized probably the risk that we had with low pressure systems until the incident in Boston. Then everyone started talking about the fact that we have customers without regulators at their meter set, protecting them from overpressurization. So I think that's a change of industry guidance and risk that we are reacting to and are going to be proactive for. So no, I would not say any of these things. The HCA replacement, we have a history of replacing our high consequence areas as part of our pipeline integrity program over the years. And so, no, I'm not sure that I would be pushing any projects off. They need to be done now.
But if the capital spending were the same as what was projected and the same as what now, and you were doing an additional $28 million in bare steel, I mean, some of the projects would have had to have been pushed back, correct?
I suppose.
And you can't say which ones those would have been?
Not this time, I couldn't. There was a couple DRs that came out asking us, which projects here do you feel like you want to push? And our response was none. I mean, all these represent safety and risk avoidance for our customers and the public. There's not one at this time, for this case, that we would say we feel the need to delay for any reason.
So I was going to refer to your response to, it's Atmos' response to commission staff third request for information, item 27. I don't know if you have that handy, but it indicates you were the person that responded to it. I'll give you a second to find it and look over it.
This is the CPCN discussion. Yes, sir?
Yes. You have it there?
I do.
Okay. And you are responsible for answering, you did answer that question, correct?
I did. I would go back to the previous answer. We did this under guidance from council, and I would repeat probably the same response that was given earlier, that we don't feel like we've had a project that's exceeded the 2% plant parameter.
And I was kind of going to clarify some
Yeah.
things really quick. So first, if you could, there's attachment 1 to that request. And I think you said it lists all capital projects for fiscal year 2019 included in the test year.
Yes, sir.
Is that what that attachment does show?
I think it totals 86 million at the end, so yes.
Okay, I just had some questions about that. Do you have that?
The list of projects, yes, sir.
The attachment 1. You do have it up there.
It's not labeled, yes, it is labeled attachment, yes, sir.
Okay, so attachment 1, it has a list of projects, approximately 200, I guess. Maybe 190 or so. And then it has names of the project, the budget category, and then the third column, column C on the Excel spreadsheet, it has dollar amounts, and it says 10/2018. Is that the capital spending that you anticipate on that project in October of 2018?
Yes, but it's a breakdown by month of the forecasted, the estimate of forecasted spend by month, yes.
And if you there's a column labeled grand total. On the Excel spreadsheet, it's column O. I don't know if yours has the.
I'm looking at a paper copy, but I do see a grand total column,
So the column immediately before that one is 9/2019, correct?
yes.
And that indicates the capital spending in September of 2019, correct?
Yes, sir.
So this shows the capital spending for those projects from October 2018 to September 2019, correct?
It appears to, yes.
It doesn't show the capital spending for October of 2019 through March of 2020, correct?
No, it does not show that.
Do you know, and I know you weren't responsible for this spreadsheet, but there was a spreadsheet that was produced in response to staff's first request for information. It's KY Plant Data 2018 case. That spreadsheet has plant additions which appear to correspond to the spreadsheet that was produced in response to 327 that we were just referring to. But the numbers in October of 2019 appear to be carried forward from October of 2018. Do you have any reason, and the numbers from November of 2019 appear to be carried forward from November of 2018. Do you have any reason to believe that the capital spending on specific projects in those months would be identical for 2018 and 2019?
I can't answer that,
You
I don't have it in front of me, number one, and I just don't know. I'm sorry.
Okay. I think you were asked by the Attorney General earlier if there was specific capital projects associated with plant additions that were projected in, I think he said the last 6 months of the test year, and you said you thought there were, but is this spreadsheet, the 327, is this the only spreadsheet that has the capital projects that where spending is specifically shown in any portion of the test period? Or is there some other spreadsheet that would have the specific projects and the capital spending for the remainder of the test period?
I'm not familiar with the other spreadsheets. I'm sure we have probably presented capital spending spreadsheets to the test year. I would probably ask that question, maybe go to Greg Waller. If it's a plant accounting question, Laura Gillum may be able to answer that better.
Are you aware, though, of any spreadsheet other than the one we just talked about that has specific project and shows specific capital spending for those projects, other than this one 327, or some version of it?
That was submitted for this case?
Yes.
I'm not.
there was another version of this 327 spreadsheet that was produced in response to staff's 5th request for information. And I know it was initially produced in a non-confidential manner, and you all had requested confidential treatment. And this is actually, I did have a couple questions, but I wasn't going to go into anything about specific contractors or anything.
The confidential was just the naming of the specific contractors and vendors and so forth.
Okay, okay.
Yeah.
So, and so I won't mention any of the specific contractors or vendors or anything on that, but I guess I'll just refer back to the 327 just to be safe, the spreadsheet you were just looking at. So, do you have, for these projects, there could be spending on these projects that occurred before October of 2018, correct?
Yes, there could have been, if it was a project that took longer than a year to accomplish.
Would you be able to provide the total capital expenditures on each one of these projects
Yes.
as opposed to your data requests?
If it was a project, make sure I understand your question, if it was a project that spanned 2 fiscal years, you want the total amount of the project?
Yes, the total amount for the
Go through all these
project.
projects and highlight the ones and include those dollars. Yes, we can.
There's kind of a second part to your response to staff's 3rd request, item 27. And it was with respect to CPCNs. I think you said, Atmos does not believe there are any projects included in the test period that would require a CPCN. That is a statement that you made there, correct?
It is.
Okay. So then below that, you kind of indicated that you thought that they were in the ordinary course of business, and one reason you gave is none of the projects has a material impact on the company's financial condition based on the current 2% of plant parameter established by the commission. And so my understanding of that is one reason that you think that a CPCN isn't required is none of the projects in the test period at least have are larger than 2% of Atmos's net plant and service. Is that correct?
That's correct.
Could you refer to just page 7 of your direct testimony? I'm looking at line 11. So it's the sentence that begins on line 11. If you could just read that sentence, I guess, into the record.
The Kentucky Mid-States Division decides how to deploy the capital for the upcoming fiscal year. I would add the Kentucky Mid-States Division often has projects that exceed any 1 year's capital budget. Those projects have to be completed in phases or in sequence over multiple years based on the system type.
So in the second sentence, you basically say that Kentucky Mid-States Division often has projects that exceed any 1 year's capital budget. And the capital budget for the base year is, or the test year is approximately $86 million. Would you say that Kentucky Mid-States Division often has projects that exceed that 1 year capital budget of $86 million?
No, I don't think we often do. It's an occasional project. Again, I would echo Mark Martin's testimony and response earlier that it's just projects that logistically are so large they have to be done. You know, whether that is easement acquisition or permitting or environmental that have to be done ahead of actual construction. We can't squeeze it all into one fiscal year. So it's not many.
But there are
Certainly larger ones.
There are projects in Kentucky Mid-States Division that have reached that $86 million figure or something in that range.
86 million.
$86 million is the approximately the projected capital expenditure for the forecasted test period. And here, you indicated that Kentucky Mid-States Division often has projects that exceed any one year's capital budget.
I don't mean literally the whole capital budget. I mean whatever the project estimate and the dollars that were set aside for that project. I'm sorry, I misspoke in that.
But what you're saying here is that if it is a really big project, then Atmos generally breaks it up into separate phases. Is that what you're saying?
We do, again, I would echo Mark's comments earlier, we don't do that to get around the CPCN requirement. We will do whatever staff needs us to do as far as keeping ahead of this 2% number.
I guess that's do you know when the last time Atmos requested a CPCN for a project was?
Well, I was just listening earlier and someone said we've only done it for franchise agreements. And I don't know of any other time, to be honest. We don't do many projects that would approach a 10 million, an individual project that would approach a $10 million level. But we will certainly go back and investigate that further and make sure we comply.
Do you know that any of the projects that are listed on this attachment 1 FY 2019, the attachment 1 to 327 that we were just talking about earlier, do you know if any of these projects are projects that had to be broken into phases or broken into multiple years?
Was that, again, what staff, what DR was that?
327 attachment 1.
Can we answer that as part of the, are you gonna ask us for a post
I
hearing
can
DR?
ask that as part of a post-hearing if you don't know.
Because you want us to go back and look for more than one
Yes.
fiscal year.
Yeah.
Would that give you the answer you're?
I think it would in part, and we had also asked in a data request for any projects that were designed pursuant to the same contract with an engineering firm or constructed pursuant to the same contract with a general contractor. And you all provided confidentially the names of engineering firms on projects and
Sure.
construction firms, but didn't really say whether or not they were part of one contract or not. And I guess we'll ask a post-hearing data request for that too. You understand what I'm saying?
Let me clarify, what I think that you're asking is, I remember the discussion, we went line by line on projects to say, were they awarded to an outside engineering firm for design? Or an outside contractor for construction?
What we were wondering is whether or not any projects that are listed here were designed by a single engineering firm pursuant to the same contract as part of the same project for that firm.
Okay.
You see what I mean? And we can follow up with a post-hearing data request on that. Now I'm almost finished, I'm sorry. I just want to look through these notes. So, when you testified earlier that you were asked about specific projects that could be delayed, I think in that the response to that Atmos has stated that there was $2.8 million that were discretionary. I was curious, do you know which projects those were and why those particular projects were discretionary?
I'm not, can you point me to the data request where that was responded to? There might be something there I can key off of.
I'll get back to you on that real quick. I'll get back to you on that one. With respect to, you were talking about Adelaide A being a, kind of a brand name. And you said that it was mentioned in the PHMSA advisory that you all had discussed. You attached to your rebuttal testimony, you had attached, I think, the PHMSA advisory you were referring to. Is that correct?
I did.
And I think in your rebuttal testimony, you indicated that the PHMSA advisory discussed the type of pipes that you had discussed replacing as part of the Adelaide A replacement. Does the PHMSA advisory, or it's the Department of Transportation advisory, but does it state that those pipes should be replaced, or does it say that they should be monitored?
I think that it's just bringing to the attention, I believe they released this 3 different times, the same notice in regards to Aldelay pipe, and it's mentioned 3 different times in the Federal Register about the dangers of brittle cracking and of Aldelay pipe. It's not limited to Aldelay, they also mention another brand of pipe and another actual spec of medium density polyethylene. But
Does it say that all the pipes need to be taken out of the ground as soon as possible, or that they should be monitored though?
I don't believe that it says. If it was an imminent threat such as that, they would have specified it.
And you indicated that it was referring to the type of pipes that Atmos has. If you look at the second page of the advisory that you attached to your rebuttal testimony, and it's the first column midway down, there's 3 bullet points. And that it refers to 3 specific types of pipes. It says Century Utility Products, Inc. Products, Low Ductile Interwall Adelaide A piping manufactured by DuPont Company before 1973, and polyethylene gas pipe design designated PE 3306. So it says specifically Adelaide A piping manufactured by DuPont before 1973. With respect to the Adelaide A that you're proposing as part of the replacement, do you know what the manufacture date is on that Adelaide A?
Yes, our GIS system records installation dates of all of our facilities. I would say it doesn't just, I mean, at the end of the notice, it says these older polyethylene pipe materials include but are not limited to. So it gives an example of these types of early generation polyethylene. But I think it's calling your attention to, again, as a grouping, these early generations of, this first generation of plastic, on top of those specific brand names.
But those are the ones that they've seen issues with that called their attention to keeping an eye out with respect to the older plastic pipes. Is that correct? Or do you know?
I agree. I would also just, in my professional opinion and what I've seen of failures of Aldelay pipe, it is not small leaks. The brittle-like cracks cause large ruptures of that line immediately. So the risk of Aldelay pipe failing is high.
And when you say high, do you mean it's high and if it breaks, it's gonna fail catastrophically, or if there's a high probability that it's gonna break?
I would just say the brittle-like fractures that they've seen, that we've seen in the industry, have been sizable. They are cracks that occur along the longitudinal seam of the pipe.
Do you know of the?
I shouldn't use the word seam. Polypipe doesn't have a seam, but longitudinally along the.
The projects that are proposed and are listed in the spreadsheet that we were referring to earlier, do you know what portion, if any, of those projects are to serve new customers?
Of that list we were looking at, of the 200-plus projects?
Yes, sir.
No, I do not know that right this minute.
Do you know if a percentage of them are designed to serve new customers? Or any kind of metric that you're aware of with respect to those projects, I guess?
Without going back and looking at those actual projects and project descriptions, I would just be taking a guess. A lot of those projects are set up as functionals for us to do leak repairs under. It wouldn't, typically we would budget our growth projects a certain way, so we should be able to go through the list and identify the ones that are aimed at serving new customers and new customer loads.
So that's something that you all could provide if we requested it as opposed to a data request?
What projects
Are specifically to
growth
serve
projects?
additional customers?
Yes, absolutely.
Okay. This question was asked of Mr. Martin, but he deferred to you. It's, basically, can you explain the large increase in the PRP program? In 2010, the estimated cost was $124 million, and now the estimated cost in the most recent PRP was $438 million. And I guess, can you explain why that cost increased in that manner?
The overall replacement programs cost?
Yes, sir.
So, in the last case, we kind of went into the reasoning of how those estimates were put together and what I saw differentiated the way we're doing construction last year versus how the estimates and the were put together back in 2008, 2009. I was not the person putting together the estimates, but there was, I mean, if we go back and look at this case and this hearing last year, we went through a number of items that we do differently by procedures or construction practices, or just things that were just left out of the original estimate of work for the overall replacement program of bare steel. I mean, I can attempt to recall some of those, but I did not come prepared to go line by line back through that original cross.
That's fine for now. Referring back to the question I'd asked earlier about the 2.8 million that Atmos had indicated were discretionary, it's in response to staff's fifth request, item number 2. I guess if you can look, there's about 15 projects listed there under subpart A. Are those projects that could be delayed at this point?
So the kinds of projects that I see here have to do with, a couple of them are exposures, line exposures, which we have found are distribution or transmission line exposed above ground that needs to be remediated immediately. Some station replacements or station modification projects, which I'm assuming there's good reasons from a measurement and regulation standpoint need to be spent. Purchase station replacements. Purchase station replacements are our largest of our regulator stations that take years of planning and design to accomplish. And I see a few that are listed as tiebacks, which indicates to me they are system improvements where we are experiencing low pressure issues in parts of town, and we're trying to make tiebacks of our system to make sure we improve the reliability of the customer. So just looking at these project names, without digging deeper, I would say no.
That's all the questions I have. Thank you.
Mr. Cicero, questions?
You indicated there's a timeline for replacement of Adelaide and low-pressure lines. How many years out does that go?
Let me clarify, our low-pressure replacement, we should accomplish in the next 3. That's within this 5-year plan of replacing the rest of our low-pressure system.
3 years?
Aldelay pipe, sorry,
3 years?
3 years.
Is that what you said, 3 years?
We have 4, yes, sir.
Okay. And the Adelaide?
Aldelay is certainly a longer-term project. That's 210 miles. That extends past our immediate 5-year plan.
You indicated that there's when you replace these lines, especially the Adelaide, that there's a reduction in line loss. As that reduction in line loss, you said of up to 20%, is that included in savings going forward when you do these replacements?
When you say line loss, do you mean L&U loss not accounted for gas?
I believe that's what you're talking about when you say it reduces the line, you said reduces line loss by 20%. I'm just going back on what you said. I believe that's what you're talking about, is unaccounted for line
I'm
loss.
sorry, I don't place the 20% number. Is it somewhere in my testimony, or did I just say it out
No,
loud?
you just,
Oh, no, I'm sorry.
I know it was a while ago, but
No, I would not make an assumption or a statement that we can reduce our L&U by 20%.
no,
I
that's
think
not
we
what
show in our,
That's not what I said. I said, you said when there's a leak that relates to the Adelaide pipe replacement, when there's a leakage and you replace that pipe, it reduces, you're looking at a 20% reduction in the line loss related to the replacement of that pipe. And maybe I'm taking it out of context, I don't know. I'm just interested in this, if there is a reduction in line loss, are there savings realized that you've included in this forecast? Whether it's 20%, 5%, or any savings?
it might be a better question for Greg Waller about how do we incorporate L&U into the forecast, because I don't know about that. The L&U, I have an exhibit within my rebuttal testimony that kind of shows, I think one of the DRs that staff sent was how has our L&U trended since we started investment in our replacement of our system. And we put a chart, I believe it was AG Staff 1, questions A and B, and then I also included my rebuttal testimony that has a graph that shows a general trend of L&U, and it's in a positive manner trending down. But I would be the first to tell you that that's probably more relevant to how good our measurement is getting and improving as we do work on our purchase stations, than that really is of loss of gas from leaks. If that's what-
I'll ask it to Mr. Waller.
Okay.
If he can't answer, I'm just gonna ask as a post-hearing data request, if savings or reduction of line loss is included anywhere in the forecast period for the replacement of all this pipe?
Yes, sir.
So that will be my question.
Okay.
You mentioned that, I didn't quite understand, has your capital budget been approved by your board or hasn't?
It is not.
It has not. So the numbers that we're looking for are not yet approved for spend.
No, I don't believe it has.
These maps that were handed out,
Yes, sir.
one of them is interesting in that it shows 2010 versus current. I think that's self-explanatory to a certain degree. But the other one, I'm trying to, is it just 4 parts of a large map that overlays each other, or what am I looking at?
Yes, sir, we're just trying to show, in all the communities that we serve in Kentucky, so what you're looking at is counties within Kentucky and the towns we serve, just giving some kind of visual representation of, when we're talking about bare steel and low pressure and aldelay plastic, just how sporadically that is spread among lots of different, of towns. I think there's been some questions in the past, and I certainly have answered questions in here about how do we tackle this work. And when I say we tackle it logistically, mobilizing area to area, town for town, that's what this is trying to show, that it's not isolated to any one community or area of communities, it's spread.
You're just trying to show that it's all over the place. I mean, basically.
Yes.
So what would be interesting is if you could tell from these maps, you don't have to have it on a map, but identified on how much lineal feet of each type that you have identified on here, bare steel main, low pressure system, banana lay on an unlocatable plastic pipe, how many lineal feet there are and how many lineal feet of those are supposed to be replaced in the current program, current capital budget, which would
Sure.
give a very good
Can-
idea of what you're talking about in terms of percentage of replacement that currently exists.
Can we provide that by town name in like a spreadsheet?
Yeah, well,
Instead of
something
modifying-
like, that's fine, yeah, just something that gives us an idea what
How
it
much
is
we're
that this
currently
new
aware of.
spending will take care of in this current budget.
In this current budget, yes, sir. We'll do it.
I don't have any other questions.
Mr. Matthews, questions?
It's not my area of expertise, so if I ask a question incorrectly, feel free to rephrase it in a way that makes more sense
Yes, ma'am.
for you. If we looked back at the previous rate case and all of the projects that were in the pipeline replacement program, you removed everything that wasn't bare steel, is that correct? From the PRP? And moved the Aldol A, the farm taps, the unlocatables, and the low pressure replacements into the regular capital budget, correct?
But they say yes or no rather than.
Yes, that's correct, I'm sorry, I apologize. With the clarification that part of our low-pressure systems already were part of our bare steel
Okay.
replacement. 60% of our low-pressure
Some of them
systems
are
were 60%.
overlapped.
So we're still planning on replacing those parts of those low-pressure systems under the bare steel program and continue that under those dollars.
Yet, give me, the overall budget has not changed, correct? For the capital spend for this forecasted year.
Correct.
Maybe the box that it comes out of has changed, but the overall magnitude has not. And the company has indicated it's going to come in every year for a rate adjustment. So really, what box it's in, I guess I was under the impression earlier that pipeline replacement was for the most risky assets, right? That's really not how you're approaching this anymore. The whole box
No.
is for the most risky assets.
I still deem
little
bare
compartment
steel is
is a
a
higher
big, is a
risk.
high-risk
Okay.
asset for us.
Is it a higher risk than certain sections of Aldol A, for example?
I would like to replace the bare steel. If you
Okay.
give me a
And
choice,
that's-
I would be
okay.
continuing acceleration of our bare steel replacement.
Okay, and that's exactly the question that I was asking. On the farm taps, there has been I guess a recent development, on the replacement of the farm taps, and that, does that change what you're doing there at all?
It does not change our plans for this year. I mean,
Okay, maybe,
last
When you
week,
look
in
out,
fact,
right, it
it's
was
been
last
very
week.
recent. Last week, they released a notice of a stay of enforcement while they consider changing the code, but as the code still stands.
okay. Another question is, and I've, again, forgive me, the low-pressure system that's not bare steel, that is slated to be replaced, is that correct?
It is. It's part of the projects that we are submitting in this case.
Is that as opposed to, some sort of overprotection, overpressure protection? What we've heard, what I've heard referred to in other utilities as a slam shut?
So the fit for us, the best fit for us, we thought was since over half of our existing low-pressure systems in Kentucky are already going to be replaced under bare steel, that the right course of action would be just go ahead and replace the other remaining miles. Now, put it in context, we have 41 low-pressure systems. They're small. In total, that miles is maybe very similar in miles, about 40 miles, 45 miles of system. So all you're talking about is how to deal with another remaining 20 miles. And instead of leaving that and trying to remediate every customer meter with a slam shut device, I think it's the best application of capital spend just to replace that entire system and be done with it completely out of our system. We do not install any more low-pressure systems. That's a legacy system.
And you're responsible for Kentucky and Tennessee
In Virginia.
and Virginia. And when you look at projects across the 3 states, do you have a risk ranking for, like, removing state boundaries and just looking at sections and saying, if I had money, regardless of where it came from, these are the sections that I go to sleep at night worrying about a little bit?
We have a plan for each of the states.
Okay.
To be honest, most of the states want to know what the biggest risk they have in their state, and they want to be minimizing that, working to actively minimize whatever risk they have in their state. So that's why we usually approach it.
It's our responsibility.
But we have replacement. We're proposing right now a plan in Virginia to deal with unlocatable plastic. And so in each of the states, again, Mr. McNeil talked about historical types of pipe and facilities that were installed over the years. We have to kind of look at each one individually.
Okay. I think that was my last question.
Mr. Smith, I guess there's been testimony about the life cycle of pipes, different types of pipes, and somebody said, I guess, the life cycle at present is 95 years. Is that correct?
With the case as we've presented it, with the miles we're proposing to replace, the calculation comes out to be about 95 years.
In Kentucky?
If you can sustain it, yes, sir.
In Kentucky. So what's the life cycle in Texas?
I do not know. I think that was the question that was posed to Mr. McNeil to
Or
follow up on.
Tennessee? Well, you're in Tennessee. What's the life cycle in Tennessee?
I have not calculated it. I don't know. I will tell you that Tennessee worked probably 10 years prior to how then we started in Kentucky with infrastructure replacement. And it is that system, we had a chart about how many leaks we manage within Kentucky now, and it's come down from 1,300 leaks at the beginning of our PRP program to 400 now that we manage on our books every year, which is great. It's not wonderful, but it's better. In the entire state of Tennessee, we manage 60 leaks. And we have a similar number of customers and system in Tennessee and Kentucky. So I think that continued investment in the system here is going to reap that same long-term rewards for us, where we just we're able to find repair leaks. We would like to do it even faster than we do it now. We certainly
Well,
can't do it with.
Let me ask you this.
Yep.
Is the company's position that investing in infrastructure upgrades is more likely to occur in states where you get a better return than in states where you don't?
I can't answer that. I know that in talking with my peers and all the Atmos divisions, we are doing some level of accelerated pipe replacement in most of our divisions. And I'd have no basis to know what their rate of return is or not.
Well, and you're saying that you don't have any basis or any way of knowing whether capital is allocated, more capital is allocated to, into states where the return on that capital is higher.
And I personally do not know the answer to that. Greg Waller might be able to give you a more direct answer to that. I would say I think we're more successful in investing in infrastructure where we have a good partner relationship with our commissions, and we see that there's a benefit to investing in our systems and renewing our systems. So absolutely.
In looking at the page 5, I guess, of your testimony, there's a chart, and it has a date and I guess leaks or number of leaks.
Yes, sir.
And in, say, January of 2011, there were, I guess you reported 1,127 leaks. Is that correct?
Yes, sir.
And then we get down to January of 2018, 489 leaks, correct?
Yes, sir.
Okay, so how were these leaks detected? Tell me, how do you know there were 1,127 leaks detected in January of 2011? How do you know that?
So we are continually leak surveying, as you know. And we leak survey our systems on 1-year cycles, on 3-year cycles, on 5-year cycles. So we're always doing leak surveying to find leaks. What we're simply doing is we knew that as we invested capital in the state of Kentucky, we're gonna see, if we need to see a dramatic reduction in risk, and to us, that is nowhere more evident than the number of leaks you have to manage. So we just started taking snapshots. Every January 1st, I run a report out of our compliance system that just says, how many active leaks do we have on today? Now that may change next week or the week after. It's always going up or down. It's not a straight line thing. But it's just a way of saying year after year, here's some evidence that where we're spending money is working. And it's prudent to do. So that number does change, but we just do a snapshot every January 1st. How many do we have? And these are grade 2 and 3 leaks underground.
Oh, so these aren't grade 1 leaks?
No, sir. Grade 1 leaks are fixed immediately. So
So
these are leaks that we have scheduled for repair at some level.
And under existing federal regulations, what's the time period required to fix a grade 3 leak?
Again,
Or is there a time period at
according to
all?
our O&M, we don't have a time period for repair. We have a time period for reevaluation of that leaks. But as I mentioned in my testimony, our goal within Kentucky is that we are repairing all grade 2 leaks within 6 months and all grade 3 leaks within 36 months. So that's above and beyond those incurred regulations.
Is there a time period required by federal regulations to repair a grade 3 leak? Not reevaluate, repair.
No, sir.
What is the time period required by federal regulations to repair a grade 2 leak?
I believe it's 12 months, not to exceed 15.
Now, when these leaks are detected, the grade 2 and grade 3 leaks that you mentioned, so how is the repair made? Do you replace a whole section of line, or do you just clamp the leak, depending on, or fuse a new section in if it's plastic? How do you do that?
Yes, sir. All those different methods, depending on what it is. If it's a leak on a bare steel system, we might clamp it temporarily until the next project that's coming in and replacing that leak. So we'll do it the safest way we can. If it's a leak that occurs on a leaking fitting that may be tightened and replaced, plastic, cut out and replaced.
Right. For instance, on the leaks that are shown on page 5 of your report, are the records kept as to the type of pipe that was leaking or the type of pipe on which a repair was made?
Yes, sir.
Okay. So could you provide that information with a post-hearing data request if we ask it? I mean, I assume it's broken down, it's on a computer someplace.
It is, and I can run a report at any time to pull out all the active leaks and repaired leaks we have. I'll just, if you're asking me to pull out, for example, the specific 489 leaks that were active on January 1st, 2018, that might take a little bit
No,
of work.
all I was asking was, well, I guess if there were 489 leaks during January of 2018, how many of those leaks were on bare steel pipe? How many of them were on century pipe? How many were Aldo or anything? I don't know how long that takes. I don't want to put you to a lot of effort, but if you could run it, I just wondered.
Could I ask to let us do that for the last year, this 489, and break down a report that shows of that 489 approximately how much were on these type of materials that we're
Yes,
talking about?
yes,
Would that be okay?
that would be fine. I noticed on your plats that you had,
Yes, sir.
looking at the cities, I guess, of Bowling Green, now, if I could say something, Mr. Hughes, that gets into confidentiality, please stop me, don't hesitate. But if we look at the 2010 Bowling Green plat, and as compared to the current Bowling Green plat, it looks like that much, in fact, the great majority of the low-pressure system in Bowling Green has been replaced. Was that fair to say?
It has, because it was part of that portion that was bare steel
Yeah.
as well.
Would that be, well, I was gonna ask, the blue is low pressure, but blue could also be bare steel, is that correct?
It could.
And then just what's noted as bare steel main, it looks like most of that pipe has been replaced in Bowling Green. Would that be fair to say?
A large portion of it. I mean,
And-
Bowling, yes, sir, go ahead.
Well, I'm sorry. Well, I guess the point I was trying to make is that the greatest sections of repair or replacement has been in what looks like highly populated areas or business areas. Would that be fair to say?
Yes, sir.
So that the pipe that is in need of replacement, or to be replaced, or you'd like to replace now, appears, at least compared to 2010, in areas where there is less, a fewer number of people. It's, well, if you look, well, I don't know, would you agree with that? It's outside of the main downtown
Outside of the
business
downtown
area.
and the campus, yes, sir.
Okay.
In Bowling Green specifically.
Right. So I guess the point I guess I was trying to make or ask you about was what is left if we look at bare steel main currently in Bowling Green, and we look at, I guess, southwest, if that's, however that is, the big square section. Much of that appears to be in an area that is either lightly populated or without population. Would that also be, that's what the map suggests to me.
I agree with you. More, I'd probably classify it as more residential, not as much commercial where we're having to deal with wall-to-wall concrete and sidewalks.
Well, and some of it is in areas where there doesn't appear to be any blocks or streets. I assume those are fields, but I don't know, or along highways.
No, most of the, I would, just knowing the system like I do, I would suggest most of that follows city streets where we have customers.
Well, there are large blank areas on the map,
Okay.
which I assume are just vacant areas. Do you know if that's correct or not?
I do not. If there's an area you want me to.
No,
look at, I can
then
look at it.
on Bowling Green, current, it has aldelay / unlocatable plastic pipe. What does that mean? There's aldelay pipe there in the system as shown on the plat, but that you don't know where it is?
No, sir, it's, Bowling Green, fortunately, is one of the areas we do not have any record of outlay plastic.
Okay, all right. That's why it's unlocatable, it's not there. You're glad about that, right? Okay. Let's look at Owensboro.
Yes, sir.
And looking at Owensboro, the 2010 plat, when compared against the current Owensboro plat, I think suggests the same thing, that a great deal, or perhaps most of the low-pressure system and the bare steel main system in the downtown area, not that they're still there, but most of it has been replaced, or more than 50% seems to be replaced, correct?
Correct.
And on Aldelay, which is in the green, the Aldelay pipe, as I see it on this green section, appears to be out of the main business district in more rural or unpopulated areas. Is that also correct?
You're correct.
Now, you have records, I assume, of when, or does Atmos have records that would indicate when all of the Aldelay pipe currently in its system was purchased?
So we have construction work orders that indicate when that pipe was installed.
Okay.
Tying it back to purchase, I would assume it's around the same time. We don't keep materials stored in warehouses for long, so.
And so, for instance, just looking at the bowling, at the Owensboro plat, and you probably don't have this available unless you just know it off the top of your head. Do you know about when that pipe was installed?
I don't, not with me.
Over the course of, say, 2000, between the last rate case here, 2017 and 2018 now, of the pipe that's been replaced, do you know how much Aldelay pipe has been replaced? Is that knowable?
I do not know. I suspect parts and pieces were replaced with the other replacement projects that was just surrounding it.
Like fixing a leak, and we
Yes, sir.
cut off a 10-foot section or 5-foot section and replace it, correct?
Yes. It has happened. I don't know that I have the means of providing that
Right.
information to you, but yes.
No, I understand. I was just wondering if you did know, or if you, I mean, I know the risk assessment, I assume, of Aldelay is based upon, I guess, PHMSA reports or other general information that's available to the industry. Is that correct?
I'll echo that our construction crews and contractors have a directive that anytime they uncover anything that is not modern piping materials, they're to contact their supervisor for directive on what to do with it. We're not gonna uncover something like Aldelay pipe in the course of a project and then just cover it back up again.
But if it's uncovered in the course of repairing a leak that's found on a leak survey, then it would be noted, but repaired, probably, correct? So what is there a target for if you're working on a 95-year replacement cycle now, what is Atmos's target for Kentucky in terms of pipe replacement, infrastructure replacement?
That was kind of the point of my comments earlier on, was I don't want to get too hung up on a cycle of replacement. I think it's something we have to keep our eye on, of how our system is aging, how our infrastructure is aging, because we don't want that to get away from us. The projects that are here are not aimed at just replacing pipe for replacing pipe's sake. These are projects that we have noted risk associated with them, low pressure, Aldelay plastic, bare steel. We're going to continue targeting that and realizing that we'd like to do it at even a faster rate than we're doing now to get to something less than a 95. We know it needs to be faster than that. Picking a number as to what that's gonna change with materials, it's gonna change with regulations.
I mean, don't you, when this pipe is put in the ground, I mean, when you buy it, does the manufacturer have at least generally, maybe it's puffing, but don't they claim it has a projected useful life of so many years?
They do, from a marketing side,
Sure.
they'll say things like modern medium-density polyethylene should last 100 years. Time will tell if that's true or if that falls the way of aldolate plastic.
Well, I think when aldolate plastic was sold, maybe that's about the same thing, 70, 75 to 100 years. But, so I would just assume that Atmos or that most utilities would have some kind of a plan in place going forward to replace all infrastructure over time. But you don't have a specific idea about in what number of years you ought to be working on infrastructure replacement in Kentucky.
I think my charge is to look at, as we achieve some kind of a cycle, replacement cycle, that we consider reasonable. We do it in a common sense fashion. We should look for the materials we have or the system that we have and fix it by either capital spend and replacement or, additional technology for monitoring or changes of our rules and procedures.
Of course, leak surveys go a long way to reducing risk, as shown by the chart on page 5 of your direct testimony, correct?
They do. I would even add to that, I'm pretty proud of that chart on page 5 because I think it shows just how far we've come. And what the general public doesn't know is we are actually surveying our pipe more frequently than we did even in 2011. I mean, now we survey all of our bare steel annually. We didn't do it back then. And in the course of these 10 years, we have better leak detection equipment. I mean, no longer are we using the flame packs that they used to use 20 or 30 years ago. Now they're using modern technology, using lasers and LiDAR that pick up molecules of gas and air, even to smaller quantities. So, yeah, I'm pretty proud of that chart, how we've brought those leaks way down. Still have a long way to go, but the fact that we're doing it, even accelerating the amount of leak survey we do, and we're using better equipment to survey with and finding probably smaller leaks. But the discussion within Atmos is how can we get to continual leak surveying? What kind of technology is on the future that we can just be surveying our system all the time and when we find a leak, don't schedule it and monitor it and schedule it for repair. How can we find it and fix it in a shorter time window, which is I expect what the public and certainly this body would want us to be looking at.
I don't have any further questions. Mr. Hughes?
Yeah, I've got a couple. Going back to one of the questions Commissioner Cicero asked about a 20% reduction in LNU, could that have been a reference that you made to a 20% reduction in leaks?
I don't remember making that reference. I just point to that chart we have.
Okay.
That snapshot we take every year.
When the original PRP was proposed, did the company have the same level of experience in estimating replacement cost then that it has now?
Certainly not. That's
Okay,
what.
so over the course of time, has the ability of the company to estimate current cost improved?
Yes.
And is that a reflection of the difference between the 2009 estimate, the 2009 estimate and the current year's estimates?
It's reflective of construction practices, procedures, technology used.
And you were asked by the Attorney General if it was in the public interest to build to standards greater than required by law.
Yes.
Is the law proactive or reactive? In other words, are you supposed to anticipate and deal with things before they happen, or only after an explosion or some other incident?
No, obviously, I mean, the whole idea behind DIM is that we are constantly improving the records we have of our system, the knowledge we have of our system, and proactively looking for risks before they become certainly dangerous to the public.
Okay. And finally, were the low-pressure systems that we have, were they, and are they allowed by law?
Yes.
Okay. But they are a higher risk than the other systems?
They are.
That's all I have.
Anything else?
I mean, just one follow-up.
Sure.
Mr. Smith, as to Alder Lake Pipe and perhaps DuPont's liability, have they stood behind that product? Do you know?
I do not know.
I can tell you the answer to that's no. That company was spun off somewhere and went into bankruptcy.
Very good, that's all I have.
Any questions? Mr. Bellamy?
No, sir.
Commissioner Fitzgerald? Oh, I have one.
Oh,
And then
okay.
you can talk. Mr. Smith, over the last 5 years, has Atmos experienced an explosion on any of its lines?
Atmos as in the corporation?
Yeah, no, in Kentucky.
In Kentucky, not that I'm aware of.
Or any fires that were associated with leaks or problems with its distribution system?
Not that I'm aware.
Or personal injuries or property damage in excess of $25,000?
Well, that would be something that would be recorded and reported to the commission. You know, the closest a risk we have, and it relates to low-pressure systems and regulators as well as farm taps, is we do have some stations been struck by vehicles. And if we can remove those above-ground facilities, that takes that risk away. That would probably, does that help?
Yeah, but absent some force intervening cause, there hasn't been anything associated with just a leak or a defect in your system that has caused personal injury, death, or an explosion or serious property damage in the last 5 years?
Not that I'm aware of.
Nothing further, Susan.
I have nothing further, other than if the commission would like us to put those maps in the record, we're happy to.
Why don't we go ahead and do that, and we'll put them in the confidential record as, I don't know.
It'd be our exhibit one.
One.
I guess.
We could have
two sets of
1A,
maps.
1B,
1A
and
and
then
1B.
2A, 2B.
Okay,
All right, we could
that's
do
fine.
that. Are there just two other parts? Some of them-
Which one would you like to call which?
I think there's 3 total.
Yeah, but they're stapled, aren't they?
Commissioner, we'll make the statewide map Exhibit 1, and
Okay.
we'll make the combination of Owensboro Bowling Green Exhibit 2.
Two. Okay. All right, thank you. Yeah, I didn't pay attention to the other.
Statewide is 1. Bowling Green and Owensboro together.
Okay, I see it.
These are the exhibit 2, and this is exhibit
Exhibit
1.
one. Yeah, I forgot about exhibit one.
This is 2. And this set.
Okay, may Mr. Smith be excused?
Yes, sir.
Okay. You may step down, Mr. Smith. Thank you for your testimony. Why don't we take a break at this time until 3:20, and then we'll come back and try to do what we can. We're back on the record. Mr. Hughes, do you have another witness?
Mr. Waller, but before we get to him, there were some discovery questions about Blue Flame Insurance that the company uses for its property insurance. We did not have direct testimony on that, but we have a witness here today that responded to the data responses. The staff has indicated they don't have any questions, but before we released that witness, we wanted to see if the commissioners might have questions, so we could be sure to have him here to respond to anything he might have.
So that anything in particular that
I had nothing.
I have nothing. Attorney General have anything?
No, we have nothing, Your Honor.
He may be released then.
Okay, thanks.
Mr. Hughes, thank you.
Okay. All right, Greg Waller?
Okay, thank you. Mr. Waller, please raise your right hand. You solemnly swear or affirm under penalty of perjury that the testimony you're about to give will be the truth, the whole truth, and nothing but the truth?
I do.
Please be seated.
Would you state your name and business address?
My name is Greg Waller. Address is 5420 LBJ Freeway in Dallas, Texas.
And what is your position with Atmos?
Manager, Rates and Regulatory Affairs.
Did you pre-file any testimony in this case?
I did.
Do you have any corrections, additions to that?
Not to mine, no.
Do you have any other corrections you would like?
I do. In keeping with tradition, I'd like to correct one of our other witnesses' answers. Mr. Smith, right before me, was asked whether or not our 2019 capital budget had been approved by the Board of Directors, and the answer is yes, it has been approved by the Board of Directors.
Okay.
And in fact, we're now 6 months into fiscal 19, so we're operating in that budget currently.
Anything else?
No.
That's all.
Cross-examination, Mr. McNeil?
Yes, Your Honor, I will start and then turn over to.
Oh, that's right, this
That's all
was the
right.
witness, that's fine. Yeah.
Thank you. Mr. Waller, good afternoon.
Good afternoon.
Just have one line of questioning for you, then I'll give you Mr. Cook. If you have the binder we gave you before, if you turn to tab 17, please.
Sorry, 17?
17, yes. And this was marked as AG Exhibit 17 earlier. This is the revised Schedule A.1 from filing requirement 16.8A. Do you see that?
Yes.
Okay. So do you see on line 1, column D, a number for rate base, 495 million or so?
Yes.
Okay. Down at line 10, column D, do you see the 14.5 million that represents the revised revenue increase?
Yes.
Okay. So we're gonna back into that revenue increase amount there real quick. So if we go back to line 1, the rate base number, as this schedule indicates, we would multiply the rate base by the required rate of return on line 4 to get the calculation on line 5. Is that correct?
Correct.
Okay. And then to make that operating income an amount of revenue requirement, we need to gross it up with the amount on line 7. Is that correct?
Well, so first is line 6, which takes the difference between line 5 and line 2. And then that number on line 6 is grossed up.
Okay. So, turn to the second page of that packet. This is the revised Schedule B1 that reflects at the bottom right that $495 million rate base number. Do you see that?
Yes.
Okay. And would you agree that essentially rate base is plant and service plus or minus certain other items, correct?
Yes, the bulk of it is net plant and service.
Okay. And plant and service is just additional utility assets that have been placed into service, is that correct?
Well, so in our case, net plant and service includes, when you say additional, that's a cumulative number, of course. That's a cumulative plant balance.
Very good, okay. And, well, to be clear, that 495 million, that is the forecasted test period 13-month average in this case, correct?
Correct. I will note, and I apologize if it was said earlier, I don't remember where this version of our revenue requirement model came from. We have a slightly different version that's attached to my rebuttal testimony that would represent the small differences, but they would represent the most recent version of what we're proposing. This
Okay.
was a slightly older version, it appears, but otherwise I would agree with what you said, yes.
Okay, this was in response to staff's second data request, item 64.
Okay.
I guess for our purposes, I think, okay, I take your point. I think for what I'm doing, it will suffice.
That's fine.
If you're okay with that.
Sure.
So then, page 3, if you turn that over. This is the Schedule B1B from the last 2017 349 rate case. And this, the rate base amount in the bottom right, the $369 million, is the base period 13-month average. Is that correct?
So this would be the base period from last year's case.
Exactly, yes.
Agree with that? Okay.
So if I subtracted this number, this 369 million, from the prior $495 million number, would that approximate sort of the rate base increase from the base period of the last case to the forecasted period of this case? Would you agree with
Correct.
that?
I would note that in both instances, those are 13-month averages.
Yes.
And you're talking about one time period that ends December of 17. The other time period ends March of 2020.
Yes.
So a little over 2 years difference.
Sure. But would you agree that if I made that subtraction, the total would be about $126.5 million, subject to check?
Yes.
And then by multiplying that total times the company's required rate of return, the 7.95%, we would get about just over $10 million, subject to check. Would you agree with that number?
Okay.
Okay.
Yes.
And then if we gross that up with the 1.34184, we get somewhere around 13.5 million. Does that sound correct, subject to check?
Okay. Yes.
So that would just be the revenue requirement impact from the new rate base from the time period I'm showing you.
Yep.
That's correct, okay.
Yes.
So we'll come back to that number. So if we'll turn now to page 4. So this is Schedule J1. Also revised. And I'm looking at the proposed rates of the forecasted period on the top right. And now in column I, you would see that the total weighted cost of capital is calculated by adding the weighted cost of debt and the weighted cost of equity. Is that correct?
Correct.
Okay. Would you agree that the equity portion noted, represented by 6.06%, does that represent shareholder return?
The return on common equity, so yes, generally shareholder return.
Okay. So then you would agree that out of the total capital, required rate of capital, at the bottom, 7.95%, that 3/4 of that weighted average cost of capital represents shareholder profit?
Yes.
Would you agree that the driver of that weighted cost rate is a function of mostly the ROE and the fact that the 58.24% of the total capital structure is equity?
I would agree.
That's, okay. So like we did just a minute ago, we take that $126.5 million difference, we multiply that just by the common equity percentage, 6.06%. We would get something about $7.6 million. Does that sound right, subject to check?
Sure. Yes.
Okay. We gross it up, same way as before, we get about 10.3 million.
Subject to check.
Subject to check. So out of the roughly 13.5 million revenue impact from the increase in rate base from the periods I've showed you, about 10.3 million represents shareholder return. Does that sound fair from what I've done?
Yes, I think that's right.
And then all I'm talking about right now is operating income impacts of the rate base. You also would get depreciation, is that correct?
So to the extent capital is invested, new capital is invested, yes, there's depreciation, increased depreciation expense associated with that, yes.
Okay. So all I would say is with a rough 50-year straight line fixed depreciation rate, if we take the 126.5 million times 0.02, we get about $2.5 million in an annual depreciation rate.
Well, so, I mean, the 126 number, of course, I think as you pointed out earlier, does include some items other than plant and service. So I'd have to go back, before I was able to agree with that, I'd have to go back and look at the plant and service difference. But
Okay, was it fair to say you would be getting an amount in depreciation on that figure I gave you?
yes, that's
Okay.
fair.
So then is it a fair statement to just say that Atmos has proposed to increase its rate base by about 1/3 a year after asking for less regulatory oversight in this commission?
Well, so again, I'll point out that the $126 million number increase is over a 2-year and 3-month period.
Very good.
So
So
it is one case versus the next case, but the 2 time periods involved are more than 2 years apart.
Okay, with that caveat, that is essentially, you would agree with that statement with that caveat?
And what was the statement again, please?
That Atmos is proposing to increase its rate base by about 1/3 over that time period.
Yes. Yes.
Okay, that's all I have. I will pass you to Mr. Cook. Thank you.
Mr. Waller, speaking about depreciation, were you in the room when we were talking about the 95-year replacement schedule?
Yes.
Given that, should the depreciation rate on pipes be about 1%?
You would have to defer those questions to Mr. Watson, who's coming up next.
All right. Does the company use budget variance reports?
Yes.
Can you tell me where they're located in the application?
There's an MFR that has both expense and capital, I believe O&M, expense and capital variance reports that we have updated as required throughout the case, most recently, I think, at the end of last week.
I think I will pose a post-hearing data request to identify specifically which MFR it is.
I can tell you real quick here.
Okay.
1 second.
right.
It's filing requirements 16.7 N and O. Is everything we would have available. O is the one that we update as it's available throughout the case. 16.7 O. And then there's a specific capital related data, it was a data request, not an MFR. 2-13, I believe it was.
For staff, 2-13?
Let me double check, but I'm pretty sure that is correct. Yes, 2-13 staff.
Okay, thank you, sir.
Uh-huh.
Isn't it true that the PRP, even if it utilizes historic costs, provides more rapid cost recovery than a base rate case?
No, I would disagree with that.
Why?
Because a forward-looking rate case, as we've proposed here, aligns investment and really all of our cost of service items with the time period in which they occur. A historic PRP would fail to do that.
And the PRP recovery mechanism appears as a monthly surcharge line item on customer bills, correct?
It did until we reset it to 0 coming out of the most recent case last year.
Okay. And you're aware that in this case, there's an issue about whether the commission allows Atmos a return on QIP and the revenue requirement, or directs it to capitalize that return as AFUDC, correct?
Correct.
The AG proposes that the commission change this to AFUDC to be consistent with almost all other utilities in the state, including Kentucky Power, Duke Energy, Electric and Gas, Columbia Gas, among others, correct?
Yeah, I did not research the treatment for all of those other utilities you just listed, but I do know that, CWIP has been a component in Atmos rate cases for as long as I've been, a witness in Kentucky.
The CWIP and rate base and AFUDC methodologies are considered to be mutually exclusive, isn't that correct?
As a general rate-making principle, that is generally correct, and that's why we remove AFUDC as a rate-making adjustment when we make our annual filings, or when we make our general rate case filings.
What about the
AFUDC is recorded pursuant to GAAP, generally accepted accounting principles.
What about between rate cases?
Between rate cases, again, we record it per GAAP, and whenever we do file a general rate case, it's removed for that current year's CWIP. That's been consistent with every revenue requirement that's been approved at least back to '09 that I'm familiar with, 2009.
If you recover the return now through CWIP and rate base, you don't capitalize AFUDC, add it to CWIP, and then recover it again through depreciation expense over the lives of the assets. Is that correct?
You say that one more time, please.
Okay. If you recover the return now through CWIP and rate base, you don't capitalize AFUDC, add it to CWIP, and then recover it again through depreciation expense over the lives of the assets?
As I said, we remove the component of CWIP that is AFUDC, that's a rate-making adjustment in one of our work papers. So it's not capitalized or not capitalized as part of our revenue requirement because we remove it as a rate-making adjustment.
Would you agree it would not be reasonable to recover the same return twice? Once through a return on CWIP and rate base, and then a second time through depreciation expense on AFUDC?
I generally agree with that, yes. And like I said, the way we've done it here is the way we've done it in our last, 4 rate cases, I guess, going back to 2009.
Okay, and the commission has allowed the company a return on CWIP in prior cases, correct?
Yes.
The company then recovered the return on CWIP through revenues from its customers, correct?
It's a component of rate base, so yes.
You're aware that the company historically also capitalized this return as AFUDC, correct?
Capitalize that return, the return on the CWIP? No,
Yes.
I apologize, I'm not following that.
Yeah, the return on CWIP, yeah.
The return on CWIP is a component of our revenue requirement because CWIP is a part of rate base. The AFUDC we record is, again, as I said before, removed from CWIP prior to including it as a component of rate base.
And you included the AFUDC in rate base, correct?
It is included in rate base on our books and records, again, removed for rate-making purposes in the years in which we file general cases.
Okay. And you're aware that Mr. Collin claims that this is double counting and that it results in the same return being recovered from customers twice, isn't that correct?
I would agree with that, again, to the extent that it is in our books and records. We remove it in the current year, but it is in our books and records. So I would agree with that statement, and that's why I suggested that as an alternative in my rebuttal testimony, I suggested that the commission could, if they chose to, want to keep CWIP as a component of rate base or allow CWIP as a component of rate base in our rates as they have, again, going back at least 10 years,
Okay.
that they could order us to stop accruing AFUDC on capital projects in Kentucky on a prospective basis, and then that would solve it on a prospective basis. But again, we record the AFUDC in accordance with generally accepted accounting principles. Generally, a commission order instructing us to do otherwise would trump the general accepted accounting principles. So if we got such an order, we would solve that on a prospective basis.
What kind, I'm trying to think, why could it not be done through this rate case? What kind of things would the company have to do in terms of GAAP? Is there some kind of reporting requirement you'd have to meet, or what?
I'm not convinced we would have the historical records available to correctly pull AFUDC out of our historic plant balances, simply because once it's in there, we don't depreciate individual assets, we depreciate groups of assets, so that's why it's difficult.
Is AFUDC separately reported in power plant?
It is, but again, as I was saying before, we don't, once it is in service and those assets are subject to depreciation, we do not depreciate individual assets, we depreciate groups of assets. So to be able to determine how much AFUDC is in our net plant balance would be difficult, if not impossible.
We'd like to ask you in a post-hearing data request to do that calculation. We'll write it out and send it to you.
Fair enough. I believe I believe that question came in as a hearing request or a data request, and we answered it. We answered that once already, basically what I just said. So we will, depending on the question worded, we'll take another shot at it. But
Okay.
we'll let you know.
We appreciate that very much. What is the earned ROE for Atmos Kentucky since the final order in the last rate case?
If you look at my rebuttal testimony, there's a revenue requirement model attached to my rebuttal testimony. And on schedule, it's the same schedule we were looking at in your binder. It's Schedule J1 of that revenue requirement model.
All right, so can you tell us what it is?
And did you, apologize, did you ask for ROE or ROR?
ROE.
So it looks like our forecasted return on equity at current rates is 6.3%. That's in the bottom right-hand corner of that schedule.
Is that the same as the earned ROE since the last rate case order?
Earned ROE since the last rate case order. So I would have to have a point in time to be able to answer that question. So when you say since, this is forecasted. If I look at I guess we could look at the base period in this case, which ended December of 2018. That's the section right next to the one I was just pointing at. And that equity return looks like 7.81 on that same schedule.
7.81. Okay. And how much customer growth has occurred since the last rate case? Customer count?
It's my understanding, not a lot. I believe I heard earlier today that our forecast was to add, I believe it was 325 customers approximately.
Okay. Atmos is going to be filing its next rate case in October, isn't that correct?
We've stated in this case that we intend to file annually, and for the last couple of years, we've filed late September of each year. So that would be, as of now, that's our current plan.
Does Atmos intend to abide by the dictates of the Commission's final order in the last rate case regarding pipeline replacement costs?
As has been said earlier today, we absolutely intend to abide by that order to the extent the order said that we needed to spend $28 million on bare steel replacement. That's what's built into the revenue requirement and into the capital forecast of this case.
And so if the company does intend to follow those dictates, then it would have included only the $28 million in PRP cost, as you said, for the historic test year ending September 30th, 2018, and no costs after that through the end of the forecast test year, correct?
And so that's what I was saying, that the order specified 28 million, we've built that into this case. At the same time, we've proposed to eliminate the PRP tariff in favor of these general forward-looking cases. And that's because, the driver of that was the piece of the order that required the recovery of that PRP investment to be on a historic basis.
And the commission directed the company to modify its PRP so that it filed in January following the historic test year ending September 30 of the prior year. Isn't that correct?
Subject to check, that sounds correct.
All right.
However, again, the company opted to file a general case under Kentucky statute that we believe would preempt that order and be subject to review as part of this general rate case with forward-looking treatment consistent with Kentucky statute.
And given what the dictates of the commission's order from the last rate case, isn't it true that there was only a lag of 5 months after the end of the historic test year for the PRP?
You have to walk me through that. The 5 months from the time of the order until the time we filed this case, is that?
So the commission directed the filing of the PRP in January, following the historic test year ending September 30 of the prior year, and then implement new PRP rider rates effective March 1. So that's a lag of only 5 months, isn't that correct?
Between the time that the PRP year would have ended and the time that the new rate would have gone into effect?
Yes.
That would be 5 months. However, that would be recovering that PRP investment on a historic basis, not a forward-looking basis. So while that time period, the 5 months, is correct, it does not adequately account for the regulatory lag involved in recovering those investments on a historic basis.
So Atmos has gone above and beyond that to include another $14 million from October 1 of 2018 through March 31 of 2019, and then another $28 million in the forecast test year. Isn't that correct?
Again, consistent with what I've said earlier and all of the testimony in this case, that's accurate. We filed a forward-looking test year consistent with the Kentucky statute that allows us to forward-look our cost of service through the forward-looking test year in this case, which is March 31st of 2020.
So in other words, the company included $42 million more in PRP costs in the forecast test year than it actually incurred through September 30 of 2018, correct?
Yes, that's correct.
Yeah. If the commission rejects your request to include this additional $42 million, then the company can file on January 1 of 2020 for PRP costs incurred through September 30 of 2019 and implement the new PRP rider rates on March 1 of 2020. Isn't that correct?
That would be consistent with, I guess, that prior order, just pushed forward 1 year. That would be correct.
So if Atmos's proposal for recovery of pipeline replacements is approved, it will be recovering forecast costs in real time, just like it did before the commission's order in the last case, in effect circumventing the specific dictates of the commission's order from the last rate case limiting recovery of PRP costs to a historic test year and on a lag basis. Isn't that correct?
If they approve this case as we proposed it, we would get forward-looking treatment on all of the capital in this case, consistent with every general case that we have filed in the last 20 years. That would be in lieu of historic treatment of the PRP as was in that previous order. That's correct.
If Atmos's proposal is approved, how will it identify and track pipeline replacement costs once the PRP rider is eliminated?
The costs themselves, the projects themselves will still be designated in our plan accounting system as PRP projects, just as they have been in prior years. That allows us to identify those investments for reporting purposes, as we've posed and committed to in this testimony.
So if I understand correctly, if Atmos's proposal is approved, it's the company's position that it can spend any amount for PRP costs it chooses over the 28 million threshold just by recharacterizing the pipeline replacement costs into the different category called non-PRP. Isn't that true?
No, I would disagree with that for a couple of reasons. So we've again committed to the living within the $28 million per year, $20 million annual. The reason you're quoting 42 million is because there's 18 months, again, between September 30th of 18 and March 31st of 2020. That's an 18-month period. So that's a year and a half's worth of 28 million, which you approximated to be 42. And so we fully, like I said, fully intend to abide by that amount, just asking or proposing it be recovered on a forward-looking basis.
Is the category you call non-PRP something to do with a FERC account or some kind of uniform system of accounts?
No.
Okay, so Atmos itself defines this category of costs, correct?
It's simply defined as everything that's not PRP.
What sort of guidelines are there about the amount and types of costs that can be placed into that category?
There aren't any.
Okay. Can you turn to AG tab 3? Do you have the book up there? This is the company's response to PSC 3-22. Do you have that?
I do.
Okay, looking at your response there, isn't it true that under current projections, Atmos's non-PRP spending from 2018 to 2020 is slated to more than double?
That's correct.
And in fact, isn't it also true that when we compare non-PRP spending in 2015, which is 18.6 million, to the projected level in 2020 of 68.7 million, that constitutes a 270% increase?
That's correct, but it's simply a function of the fact that the commission ordered us to spend only $28 million for bare steel replacement.
Well,
and again, we've been very consistent throughout testimony in this case and the prior case in that the level of total direct investment, that fourth column on this chart, total direct investment, is the amount of investment we believe is imprudent to be able to make meaningful progress on modernizing and keeping pace with replacement cycle of the system here in Kentucky. That's the level of capital we need to do that. And as Mr. Smith testified earlier today, that what we've achieved there as of 2019 with that growth in capital allowed us in our 2019 budget to get to a rate that is currently at a 95-year replacement cycle. So while it is bigger than 2015, there's no question it is bigger investment than 2015. That growth has allowed us to just now achieve a 95-year replacement cycle.
you say
We
that's,
believe it
oh,
should
I'm
be,
sorry, go
we
ahead.
should, we believe it should be less than that. And as
Okay.
Mr. Smith testified, it is absolutely risk-based and something we monitor. We don't have a particular number, but we believe safe to say that 95 years is too long.
You say that's the amount of capital you need, but yet you just, through my colleague, you acknowledge that nearly 3/4 of the amount of capital you're requesting is going to be for profit.
So I think we're mixing messages here. That the amount of capital that we have embedded in our system is necessary to maintain the safety and reliability of that system and continue the progress on a prudent replacement cycle for this system. As we continue to invest that level of capital that is required to be safe and be reliable and not fall into the trap where we wake up 30 years from now and have a system that's beyond repair, we want to avoid that scenario. As we invest that capital, the return on that capital is allowed for our investors. That's why the commission sets an allowed rate of return. Investors are allowed an opportunity to earn a reasonable rate of return on that invested capital. It's a mathematical exercise to show that yes, capital increases and as our investment increases, our return on that investment increases.
In Atmos's other jurisdictions, is there the same category of spending called non-PRP?
Well, so we don't have anything specifically called PRP in other jurisdictions. It's called various things. In many jurisdictions, we have capital programs that are, like, we use a variety of different acronyms or ways to identify it. But in most of our jurisdictions, we have some category of what we would call program spending, which is generally related to accelerated infrastructure replacement, and then non-program spending.
All right, I'm gonna ask you in a post-hearing data request to, in all your other jurisdictions, to identify the name of the program and to provide historic spending from 2015 through 18, and then projections through 2022.
Okay.
And we will also ask you to provide customer counts in those jurisdictions, both historic and projected. Now could you turn to AG tab 4?
I'd just like to reiterate that, as you heard others, I believe Mr. Martin testified, the relationship to customer counts is not relevant in our mind. Our job is to provide safe and reliable service to the customers we have. So the fact that our customer growth is relatively flat is not important to us as far as the capital that we need to maintain safe and reliable service to the customers we do have.
All right. Now, there at tab 4, just let me know when you're there.
I am.
Okay, now this is from Atmos's last rate case, correct?
It is.
It's the response to AG 1-15.
Yes.
And it shows the company's projected capital spending at that time, correct?
It's got the two most recent versions of our 5-year plan, yes.
All right. And so in this case, referring back to AG tab 3, when we combine PRP spending and non-PRP spending, we have this category called forecast total direct investment, correct?
Correct.
And so there's virtually no change from the forecast used in the last rate case, isn't that correct?
That's correct.
And this is so even though the PRP spending projections from the last rate case for 2019 and 2020 had decreased from the projections in the current rate case, correct?
That's correct.
Okay. Your Honor, I'd like to move to have AG tab 3 and tab 4 marked accordingly.
Any objection, Mr. Hughes? Let tab 3 and tab 4 be appropriately marked as Attorney General Exhibits 3 and 4.
Thank you. Mr. Waller, what is it going to take to get Atmos to cut back on its capital spending spree?
I'm not sure what's implied or insinuated in the question. We propose capital spending as part of general cases that we believe is prudent to meet our primary objective, which is to provide safe and reliable service to our customers in Kentucky. As I said before, the level of capital spending that we've proposed here, regardless of which bucket it's in, has just now allowed us to achieve a 95-year replacement cycle. So with a 95-year replacement cycle, as has been said earlier, that means if we maintain our current pace, somewhere in the system, there's 95-year-old pipe in the ground. And we don't believe that's prudent. So our intention would be to continue to gradually increase our level of investment until we achieve something less than 95 years. Again, it will be risk-based, and it will be with a look towards what we're seeing from the materials that we're putting into the ground today, what we put into the ground 20, 30 years ago. We just don't know, but we're confident in saying that 95 years is too long. It needs to be less than 95 years. So we're absolutely not in a position to propose to cut back capital spending. Quite the contrary. We need to continue to gradually increase it as capital becomes available to achieve something less than 95-year replacement cycle.
So when I look at this bottom line, we have about a doubled up CapEx for a system with no growth, coupled with depreciation rates utilizing an ELG procedure which front loads cost recovery. This puts a lot of cost stress on the current generation of ratepayers while relieving costs for the next generation, isn't that correct?
Yeah, I'm not prepared to speak to the pros and cons of the different depreciation methodologies. That would be for Mr. Watson coming up next.
Now, you were here when we talked about the farm taps, which the company proposes to replace, correct?
I was.
In what cost centers are the costs for those projects budgeted?
Well, the individual capital projects would be very likely budgeted in, the cost centers we have generally are geographic in nature, so I think generally it's sort of one or two per town. Some of our larger towns have 2 cost centers, smaller towns have 1 cost center.
Would it fall under non-PRP?
It would fall under non-PRP, if that's your question, yes.
Okay.
Cost centers are more town-specific, and they'd be budgeted in the cost centers nearest the farm tap in question.
Are farm taps jurisdictional to local distribution companies in Kentucky?
It's, well, it's my understanding, I mean, if we own the facilities, then we're responsible for those facilities.
Okay, could you turn to your rebuttal at page 3 and just let me know when you're there?
Okay?
All right, at line 19, could you read into the record the sentence that begins with, "The company emphatically reiterates"?
The company emphatically reiterates that rate recovery methodologies that reduce or eliminate regulatory lag and therefore give the utility a reasonable opportunity to earn the fair rate of return authorized by the Commission are absolutely critical to delivering on that commitment.
All right, and in your rebuttal, you discuss how the company purportedly needs what you describe as forward-looking treatment in order to earn its authorized rate of return, correct?
Correct.
And so there you also discuss that Mr. Collins proposed adjustments to remove pipe replacement capital projects from base rates and instead place them into the PRP rider, which subject the company to regulatory lag, isn't that correct?
Correct.
Okay. When did Atmos first request that the commission approve the PRP?
It was in 2009.
Okay, was it in the 2009 354 rate case?
That's right.
Okay, could you turn to AG tab 5? Okay, and do you see your direct testimony in that case?
Yes.
Okay, and then could you turn to page 17 and just let me know when you're there?
Okay.
And beginning at line 24, could you read into the record the sentence that starts, "Because the company's typical"?
Because the company's typical level of non-growth capital investment already exceeds its level of depreciation expense, the PRP result in a significant annual net increase to the company's rate base in Kentucky.
And then could you continue down through another couple more sentences?
The incremental growth in rate base will cause the company's revenue deficiency to grow more rapidly than it would in the absence of incremental capital investments. The PRP will allow the company to earn a timely return on incremental investment while avoiding the resource commitment and expense required by traditional rate cases.
Okay, thank you. So in 2009, Atmos was saying the PRP would, in fact, allow the company to timely recover its costs for pipeline investment, but now in this rate case, you're saying that's not the case, correct?
Right. So I would direct you to same testimony. So it's right on the next page. In fact, the next Q&A begins on page 18, line 5. That Q&A describes 4 attributes of the PRP mechanism as it was proposed and ultimately approved that are critical to making that statement that I just read into the record true. And number 1 on that list of 4 attributes is related to forward-looking treatment.
Okay. And again, isn't it true that the PRP's collection mechanism was designed to reduce regulatory lag?
As it was designed, it was designed to reduce regulatory lag in an environment where the PRP was proposed and approved as a forward-looking mechanism. And at the time, in 2009, while we were contemplating more frequent rate cases, we weren't necessarily contemplating the need for annual rate cases outside of the PRP. They certainly would have been more frequent, and again, I think the record would show we filed in 09, 13, 15, and then since then we have been annual.
Since the date of the final order in the last rate case, did Atmos file its annual PRP application?
The last one we filed would have been August of 2017.
So by increasing capital spending for pipe replacements far beyond the commission's restrictions of $28 million, isn't it true that Atmos has effectively accomplished an end run around what the commission instructed the company to do?
No, I would not characterize it as an end run. I would again characterize it as opting to file a general rate case pursuant to Kentucky statute. That's what we've done. And as part of that general rate case, we proposed to eliminate the PRP, in part because of the order from last year that required it to be recovered on a historic basis.
What limits on capital spending does the company have?
Well, I mean, ultimately, we're limited. If you think about the group here in Kentucky, they're limited to the level of capital that is given to them or authorized by our board of directors.
Okay, thank you. I want to ask you some questions about you are the revenue requirement witness for Atmos,
Yes.
correct? Okay. And so I want to ask you some questions about how revenue is collected from depreciation rates, okay? So I'm not going to ask you technicalities about the depreciation rates, but actually I want to get into how they work in terms of how the company collects revenue from it, okay?
Fair amount, fair, okay.
So have you read Mr. Watson's rebuttal testimony in this case? Are you familiar with it?
I would say familiar. I did not read it word for word.
Okay, I understand. So I take it you're probably aware that the company requests depreciation rates calculated using the ELG procedure, and that the AG is recommending the ALG procedure.
That's right, that's correct.
Okay. So the ELG depreciation rates and resulting depreciation expense are greater than the ALG depreciation rates and resulting depreciation expense, correct?
Correct.
All right. Are you familiar with, there's an old saying by Yogi Berra that says, in theory, there is no difference between theory and practice.
Yes.
In practice, there is.
Yes.
Okay. In theory, the company will recover its plant costs through depreciation expense regardless of whether the depreciation rates and expense are set using ELG or ALG, right?
I believe that's correct, yes.
Okay. How often does the company develop new depreciation rates? Is it every 3 years, every 5?
There's not nothing set in stone. I would say we typically plan to refresh our depreciation studies every 4 or 5 years.
Okay.
Unless there was a case or two ago where we were ordered to do one more frequently than that, I believe.
If the commission adopts new depreciation rates every 3 to 5 years, that means that the company's revenues recover depreciation expense using those depreciation rates over a 3 to 5 year period, correct?
Sorry, repeat that.
Okay. If the commission adopts new depreciation rates every 3 to 5 years, that means that the company's revenues recover depreciation expense using those depreciation rates over a 3 to 5 year period, right?
Well, I mean, so the refreshing of rates or setting new rates every 3 to 5 years is not the same as saying we recover all of the depreciation on a given asset over 3 to 5 years. Clearly, the depreciation rates that are set are set for the life of the asset. The fact that they are adjusted every 3 to 5 years, I wouldn't equate that to recovering it only on a 3 to 5 year basis.
Okay. Well, in other words, if some group of assets with a 2-year service life is fully depreciated under the ELG procedure, the company doesn't reduce depreciation rates or expense to reflect that fact, and certainly does not reduce its revenues unless or until there is a new rate case and new depreciation rates are adopted and reflected in the revenue requirement, correct?
Well, so first let me say I can't think of any assets that we would have, certainly no assets that make up a material amount of our asset base that would have anything close to a 2-year life. Most of our assets are extremely long-lived assets, as you know.
I'm only speaking hypothetically.
As part of a general case, in our work papers, we'll illustrate this. We account for retirements, planned or forecasted retirements, as part of building our forward-looking plant balances. So those retirements are built into the revenue requirement. So for that reason, I don't think I would agree with your question either.
Okay. We can agree that the company's revenues are not reset in real time as groups of assets are fully depreciated. In other words, there's no depreciation tracking mechanism, correct?
No, but again, as I said before, we forecast depreciation expense, which would include the impact on retirements as part of every forward-looking case that we file.
Okay.
So to the extent a plant, a category of plant, an account is forecasted to be fully depreciated during the course of a forward-looking test year, that's going to be reflected in our revenue requirement.
Okay. I'd like for you to turn to Mr. Watson's rebuttal at page 4.
Okay?
Okay. And at line 16.
I'm sorry, you said rebuttal.
Yes, rebuttal.
I'm in direct, just one moment.
Okay.
Okay?
Okay. And at lines 16 through 19, do you see where Mr. Watson states that Mr. Collin proposes to reduce Atmos's depreciation expense by over 30% by means of using a different procedure?
Correct.
Okay. So if you have only one group of assets with a cost of $10 and a 2-year life, and again, I'm speaking hypothetically, you would have a depreciation rate of 50% for that group, and your depreciation expense would be $5, all else equal, correct?
That sounds right, but I'm gonna defer to Mr. Watson pretty quickly on the rest of this line, but that sounds right.
I think we can get through this. If you set rates using the 50% depreciation rate, you would include $5 in your revenue requirement. Isn't that correct?
Fair enough.
And you continue to include the $5 in depreciation expense if you file the rate case in the next year and do not seek to revise depreciation rates. Isn't that correct?
That's right. I guess a couple of caveats. I think you've ignored half your convention, which we use per generally accepted accounting principles in that example. And again, I'll point out that, while it is a theoretical example, we have nothing approaching a two-year lived asset. I can't think of anything that we would have anything, Generally,
Alright.
software is our shortest lived assets, and even it's, I think,
Okay.
over 8 or 10 years usually.
And you would continue to include the $5 in depreciation expense if you filed another rate case in the third year and did not seek to revise?
No, so at that point, no, the answer would be no, because at that point, that theoretical asset would be fully depreciated, and we wouldn't be calculating depreciation expense on a fully depreciated asset.
Okay. But that's true only if the asset was retired, isn't that correct?
No, if it's fully, if a group, a category of assets is fully depreciated, and we file a forward-looking case, and again, the category is fully depreciated, we would calculate zero depreciation expense on that group.
But that again assumes that it's gonna be, that it's been retired.
No. It only assumes that it's fully depreciated. We have assets that are fully depreciated that are still in service.
One moment, please. Could you turn to your rebuttal at page 7? Let me know when you're ready.
Page 7?
Correct.
Okay.
Okay, now line 17, can you begin reading at the sentence that says, "One need look no further"?
One need look no further than the summary table on page 5 of Mr. Collins' testimony for an estimate of the cost of lag to the company.
And then can you continue on through the end of that sentence at line 2 on the next page?
The company has a board of director, parentheses, board approved capital budget and a 5-year plan in place today for capital investment in Kentucky, and the company will have executed the first 6 months of its fiscal 2019 budget as of the date of the hearing in this case, with plans to meet the board approved level of investment for the remainder of 2019 and 2020.
And can you continue just one more sentence?
Mr. Collins has removed from rate making the return on some capital investment and related depreciation and ad valorem tax expense on investment that is used and useful prior to the date of the hearing.
So it's true, isn't it, that one of the activities of a board of directors for a for-profit corporation is to find ways to maximize profit?
They have a fiduciary responsibility to do so.
Yes. And being located in a vertically integrated and fully regulated state like Kentucky, and given the fact that there is no customer growth to speak about, isn't it true that perhaps the only way to increase profit is through return earned on capital spending?
So as a regulated utility, ultimately our earnings are related to our allowed return on investment. That's true. And so again, I'll go back to the fact that we have very little customer growth is irrelevant to that equation.
What is the company doing to keep its rates affordable?
We invest a prudent level of capital. We do so efficiently. We keep O&M costs as low as possible. And we continually look for ways to make our operations more efficient. But at the same time, we are investing at a level necessary to ensure safe and reliable service for our customers.
Looking back at your rebuttal there that you just read into the record from page 7, if Mr. Collins' proposed adjustments interfere with the board-approved capital spending plan, I take it that is unacceptable to Atmos, is that correct?
I guess I don't understand the use of the word unacceptable. I mean, we would obviously disagree with it, yes.
Okay. I'd like for you to turn to Atmos's response to a particular schedule provided in response to PSC 4-9, and it's schedule G-3. You may find it faster, well, you're a whiz at this, I'll guarantee you. You might be able to find it faster in the hard copy form or maybe on the Excel spreadsheet. whichever you feel is fastest.
This is staff 4-9.
4-9, that's correct.
So this is where we provided a revenue requirement model
Yes,
using Mr. Collins' proposed depreciation rates.
yes, and it's Schedule G-3.
Oh, within attachment 1?
Let's see, I have it as 2018 Kentucky Revenue Requirement Model Paren 1.
Okay. I don't have that particular attachment in front of me, but I have a different version of that same schedule that I believe would be,
Okay.
have the same information on it.
Okay. Yeah, and I think it's filing requirement 16.8G, if that makes sense?
Right. Okay. Like I said, I don't have the attachment that you referred to, but I guess we'll find out here in a second. I'm confident that this schedule will be the same in this version
Okay.
and the version that's attached to that data request you mentioned.
What I'd like to look at is at line 10.
Okay?
And it appears that the company has included costs for SERP, or Supplemental Executive Retirement Program for recovery in this case. Is that correct?
That's correct.
Okay. And a portion of those costs are in fact allocated to Kentucky, isn't that right?
Correct.
And the SERP costs were incurred by Division 2, isn't that correct?
Yes.
And Kentucky is allocated 5.18% of the expenses?
I believe that is correct, yes.
Doing the math, isn't it correct that this adds up to approximately $150,000 to the overall revenue requirement? Subject to check, I mean, unless you wanted to do.
Sorry, what was your
the-
number?
Approximately $150,000.
Approximately, that's correct, yes.
Okay. Now, could you turn to AG tab 6?
Okay.
All right. This is a final order from an LG&E rate case in 1990. Do you see that?
I do.
And can you turn to the back of the page included for you in that tab? It is page 27.
Okay.
And could you read into the record the paragraph that starts with Supplemental Executive Retirement Plan?
Supplemental Executive Retirement Plan. The AG proposed an adjustment removing the test year expense of LG&E's Supplemental Executive Retirement Plan, parentheses, SERP. The AG stated that the SERP was designed for certain key employees, and in light of the overall compensation and fringe benefits available to those employees, the cost of the SERP should not be borne by ratepayers.
Okay. So do you see there where the commission has not allowed SERP into rate base?
I would agree. I would note that that was from 1990, which is
Yes.
many years before I was ever a witness
Yes, sir.
in Kentucky.
Me too.
And I will also note that the SERP in our filings have been approved in every case that, again, that I've been a witness in Kentucky. I can say with certainty that it's been approved in every case since 2009.
Isn't it true that those cases where you say it was approved, that it was not adjudicated?
Well, certainly some of them were. The most recent case was, and the 2013 case was. We settled one of them. I believe it was 15. Was it 2015? Maybe it was a settlement, and 13 was a full hearing, or vice versa.
In a post-hearing data request, I'm going to ask you to identify where in the final orders, in those cases, it was expressly allowed into rate base, that SERP was. Okay?
Well, so let me correct one thing already. So it's not in rate base. These are expenses, not rate base.
All right,
O&M
and expenses, okay, thank you.
And second, I can say that you won't find that explicitly written in the orders, but you will find numbers in the orders that tie to numbers that were approved and ultimately tie to rates that were approved, that the work papers would indicate have that amount in there.
Your Honor, I don't think I've moved to have, I don't know, AG 5 and 6, if not, 4, 5, and 6, thank you, to be marked.
Any objection? So it'd be marked and filed as AG, exhibits 4, 5, and 6 and evidence.
With that, Your Honor, I think that's all the questions we have for this witness at this time.
Okay, Ms. Gold?
We have some questions. Good afternoon, Mr. Waller.
Good afternoon.
So previously, Mr. McDill deferred a question to you, so I'll follow up at this time. Can you explain whether Atmos considers the associated rate impacts when creating its capital budgets?
We do, to the extent, so the board of directors starts with a financial plan that includes a level of capital that they believe is prudent and available to be included in the capital investment program for the company as a whole. And as we've said before, that capital in a regulated industry necessarily ultimately results in revenue requirements that ultimately result in rates charged to ratepayers.
And you're saying the board of directors creates those capital budgets, is that correct?
The board of directors sets the level of capital for the company as a whole. And then the planning group in Dallas, along with input from the divisions, decides how that level of capital, total capital, is going to be allocated across the states.
That was my question, is what level of involvement do, for instance, yourself, anyone with Kentucky Mid-States Division have working with everyone in Texas on that capital budget?
So the process we follow generally is we will meet with, and I say we, the planning group in Dallas. I'm involved often in the states that I typically work in, but not all the states. But we would typically have a set of discussions with each individual division in the late fall, say November, December timeframe typically. And we'll go around and we'll talk to each of them and determine, or give them an opportunity to tell us what their particular needs are for the upcoming year. So basically, do they have any large one-off issues? Do they have any known specific projects that need to be accounted for? And generally just what's the state of their system? What types of risky pipe do they have? A lot of that is known to a large degree because again, we do these meetings on an annual basis. Once those meetings are done, the board of directors will set, as I said, an overall level of capital for the company as a whole. And then at that point, targets are set for each individual state that obviously sum up to that total level of capital. Once those targets are set for each particular state, then it's back to the local folks, the division here, including Greg Smith, who you heard from earlier, who then determines what projects they are going to prioritize that fit into that level of capital provided by the board of directors targets.
And speaking of Mr. Smith, he stated previously in his testimony here today that Atmos Kentucky is currently on a 95-year replacement plan. Is that correct?
Correct.
And then, correct me if I'm wrong, but I believe you stated in your testimony with the Attorney General's office just now that you think that 95-year replacement plan is too high. Is that correct?
That's what I said.
So what is the Atmos's proposed replacement plan?
So as you heard Greg Smith answer that question earlier, we don't have a particular number that we're aiming for. All of our capital program is based on a risk assessment of the pipe we have in the ground in each state and the perceived need there. So while we don't have a specific number in mind, as I sit here today, I can tell you that I believe intuitively that 95 years is too long. I don't know what it needs to be, but 95 years is too long.
Does Atmos have any evidence to support a lower replacement rate? That would be in the record or something that you could
Well, I
provide in the
mean,
post
so again, on a
hearing?
material-specific basis, we have obviously there's been lots discussed about material-specific basis, about bare steel pipe that is, in some cases, approaching 100 years, but in many cases, a lot less than 100 years old, that has clearly been identified as risky pipe. We talked a lot today about the Adelaide pipe, which is been identified as risky pipe that needs to be replaced. It's obviously less than 100 years old. So we have lots of examples of pipe that is less than 100 years old that has been identified by our engineers as risky pipe.
In your testimony and rebuttal testimony, you provide Atmos Kentucky Mid-States Division's net income in various schedules. Is that correct?
Sorry, say that one more time, please.
You provide the Atmos Kentucky Mid-State Division's net income in various schedules.
And throughout this record of this filing,
Yes.
it's in a couple of different MFRs, I believe. The reason I'm hesitating, are you referring to rate-making schedules or sort of gap accounting book schedules?
So I can refer you specifically. I'm just going to ask some post-hearing requests on it. You can look at it if you would
That's fine.
like. It's your rebuttal testimony, exhibit GKW-R-1, page 108 of 121.
Okay.
It's just basically showing the Kentucky jurisdictional net income.
Okay.
And so, commission staff wants to ask, as a post-hearing request for information, if Atmos can provide a schedule comparing the other Atmos divisions in the other regulated states' net income, as well as its percentage to Atmos's total regulated net income for the fiscal years ending between 2009 and 2018. And we'll
Okay.
issue that.
Okay.
And then, in that same vein, we're going to ask a request for information to provide a schedule comparing the other Atmos divisions in the other regulated states' cash flow and its percentage to Atmos's total regulated cash flow for the fiscal years between 2009 and 2018. So we'll issue that as a post-hearing request for information.
Okay.
Can you please refer to Atmos's response to commission staff's second request for information, item 64, attachment 1?
That's the revenue requirement model?
Yes. It's the revenue requirement model for corrections in the application. And then, once you're there, let me know.
So once again, I don't have the attachment in front of me. I have the description of the adjustments we made. So I may need to get the attachment depending on what your question is.
Okay.
Okay.
Okay, and then I also need you to reference Atmos's response to commission staff's fourth request for information, item 9, attachment 1, and that's the revenue requirement model for the average group life and equal life group depreciation methodologies.
Okay. Okay.
Can you confirm that the only difference in the models provided in those responses are the depreciation rates that are used?
Let me, look quick. So the only adjustment that was made between the two was the change in depreciation rates. As you can see, there were several other attachments to that request where we properly calculated all of the flow-through impacts to other items, notably deferred income taxes. caused by that same change.
Okay. I'm going to ask you a series of questions now concerning the AFUDC and the CWIP. As you've discussed with the Attorney General's office, it may be a bit repetitive, but Commission staff just wants to make sure that we have clarification on the answers in the record. Specifically, you can refer to your rebuttal testimony at pages 8 through 11 if you need to reference it. Can you confirm that Atmos currently records allowance for funds used during construction, also known as AFUDC?
Yep.
And Mr. Waller, excluding amounts accrued during the test period, is AFUDC included in the rate base used to calculate Atmos's revenue requirement in this proceeding?
It is. As I said before, we remove it in the current year, but then it is in plant balances in subsequent years.
And can you confirm that Atmos included construction work in progress, also known as WIP or CWIP, in rate base?
Yes.
And can you confirm that Atmos's net plant includes AFUDC capitalized prior to the forecasted test period?
It does.
Was that a yes?
It does, yes.
And does Atmos believe that it's entitled to recover a return on rate base that includes both previously capitalized AFUDC as well as the current balance of QUIP?
No, as I said before, we would agree that that's not appropriate. It is consistent with the way the orders, or the way our rates have been approved since 2009. As I explained before, we record AFUDC per GAAP. We remove it in the current year because it's a relatively simple rate-making adjustment. It's a very difficult adjustment, if not impossible adjustment, to remove it permanently. And so, as I suggested in my rebuttal testimony, a way to fix that going forward would be a commission order requiring us to stop accruing AFUDC on projects on a prospective basis.
Okay, just one moment. Okay. Can you refer to Atmos's response to staff's third request for information, item 27, attachment 1, please?
Can I see the attachment? Yeah, I need the attachment. Okay.
Okay. And can you confirm that the sum of the PRP projects in this attachment is $28,775,905?
That sounds correct, yes.
Can you also confirm that throughout the testimony, Atmos has asserted that they limited the PRP spend to the $28 million cap from the prior case?
Correct, and I addressed that discrepancy in a data request somewhere. It was our intention to limit it to the 28 million, and certainly we are attempting to hit that number. The way our accounting or way our budgeting system works, you always have it's basically movement of overheads across projects that resulted in our budgeting system. When it allocated the overheads, it created that discrepancy. It was unintentional, but we would also agree that the 800,000 on a $80 million budget is not hugely material. But yeah, I did address that discrepancy in a data request somewhere.
Okay, and do you want to expound on that any further, just to explain why the commission should not make an adjustment to remove that additional almost $800,000 that's over that cap?
So, because I will explain further. So again, the $800,000, the nature of that $800,000 is overhead that would be, if it wasn't on those PRP projects, would be reallocated to other projects within the state of Kentucky. So the total capital budget would not would not change. It was just some movement of overheads that resulted in that discrepancy. Those dollars would otherwise be on other non-PRP projects if they weren't on PRP projects.
So in addition to Commission staff's third request for information, item 27, attachment 1 that we've been looking at, I would also ask you to refer to Commission staff's second request for information, item 64, attachment 2.
It's the plant data request,
Yes.
or plant data work paper.
Kentucky
excuse me.
Division Plant Additions, I believe.
Oh. Two 64.
You should have 64 now. No, the next one. 2.
Yep, you're right, you're right. This is an attachment that is much more user-friendly in electronic form, but I'll do my best.
I agree. So can you confirm that Kentucky Division Plant Additions for fiscal year 2019 are based on capital spend during each month?
Yes.
Do you know if those projects are in service in the month that they are added to plant?
If they are added to plan, account 101, that means by definition they're in service, yes.
So the answer is yes, that the projects are in service in the month that they are added to plant.
Well, excuse me. So if we add something to plant, then it is in plant and service. The additions columns in that work paper that you're referring to, where we have a section called additions, that's capital spending. So that's not necessarily additions to plant and service. However, the way we have built the forward-looking test year, effectively what you said is correct, that it is the increase to plan and service, and that's because we, as I explained in my testimony, we've held CWIP constant throughout the course of the forward-looking test year. By doing so, we effectively assume that CapEx is equal to the amount of money that's placed in service. And I apologize, I know that's somewhat confusing and maybe in the weeds, but the rate at which we put money, the rate at which we spend capital and put money into plant and service is the same as the rate that we take projects out of CWIP and put them into plant and service. So the long version of that answer is yes, that's correct.
So plant additions are projected monthly, but QUIP is carried forward from June 2018. Why did Atmos not forecast construction work in progress and plant additions at the same level of detail?
Well, so, and again, this is consistent with the way we've done these forward-looking test years for a while, but if we have a level of CWIP at a particular, in this case, it's the June 2018 balance, we hold that CWIP level constant throughout the forward-looking test year, then add to plant and service the level of CapEx. That ensures that the level of CapEx is in rate base once and only once, and that level of CWIP is in rate base once and only once. So it assumes, and I misstated this slightly a second ago, it assumes that we put investment into CWIP at the same rate we take dollars out of CWIP and put it into plant.
Do the plant additions or capital spend monthly amounts include any allowance for funds used during construction or other financing costs?
In that case, no. We've removed the amount of AFUDC that's recorded for the forward-looking test year.
No further questions at this time. Thank you.
Mr. Cicero?
You mentioned a risk assessment is made on pipe replacement in every state in order to prioritize. Is that a study or some internal document that Atmos has?
Those questions would be better asked of Mr. McDill, I know who's before me, but I do not know the process by which they formally risk rank pipe across states.
But you do know that they do it?
They do it, I just don't know the process and can't.
We'll just do a post-hearing data request and ask for whatever that risk assessment study is that be supplied.
We'd be happy to provide what we have, yes.
And then this last question. Is there any savings included for reduction of pipeline loss, whether it's through unaccounted for line loss or for repairs of leaks associated with this huge capital spending that is going on with pipeline replacement?
So two-part answer. The first part, which I think you addressed to another witness earlier, the lost and unaccounted for gas is a component of our GCA. So to the extent we reduce lost and unaccounted for gas, which we have through reduced leaks, that it's not a forecast in this case because this is a base rate case, but it's absolutely a savings to customers in the form of lower gas costs because that's a component of GCA mechanism. The second part of that is as we repair leaks, do we have any O&M savings? And I would say yes to the extent that we are monitoring fewer leaks. There's an incremental savings there to having to reevaluate those leaks and all of the various record keeping associated with those leaks. To the extent those savings are realized, they are embedded in our O&M budget that we have forecasted in this case.
Only for the future.
For the forward-looking test year, yes.
But you're not actually identifying savings and including them in a forecasted test year. You're just saying efficiencies gained over time will be realized, but not as a forecasted savings.
Well, no, so as our budgets are developed, our O&M budgets are developed, each individual cost center owner is looking out and determining what level of headcount, for example, he needs to manage his cost center. To the extent that headcount is reduced or additional headcount is not needed because there's less workload caused by fewer leaks on the system, that's embedded in our forecast already.
I would challenge you to show me what staff reductions have been made by Atmos.
And I would agree, it's probably not, you'd have to reduce leaks a lot to be able to eliminate an entire body out of your forecast. I would absolutely agree with that. There's incremental savings though in the extent that person, if he's not, if he's doing slightly less work evaluating leaks, he's probably doing something else, hopefully productive, or maybe we're using him on a capital project, something else other than evaluating leaks. But yeah, I agree. The workload is not such that it would be easy to eliminate entire bodies.
I don't want to put words in your mouth, but I think the answer to my question was no, there's no savings that is forecast for those types of activities.
Well, so again, to the extent there are savings, they're in there. I would also, however, agree with you that the savings are likely small.
And they're not forecast. They can't be. What you're doing is it's through efficiency. You just said that. The efficiency comes from historical, and you're forecasting a test year. You're not forecasting those savings.
Well, again, so to the extent a cost center owner in preparing his budget is anticipating efficiencies, he built that into his budget.
You don't want me to do a post-hearing data request that gets you into this. I would
I mean,
suggest we just leave this as it is.
It's a question that I mean, I was not obviously involved in every meeting where those budgets were developed, but I can tell you the way we do the budgets is that his head count is forecasted against his needs, so.
And as I said, head count, based on what I'm still waiting when I have our post-hearing data request that talks about head count associated with this increase in spending on capital. I don't expect to see any decrease in staff. I expect to see a huge increase, and I guess it'll be worn out by whatever comes back from the data request.
I agree with you.
I don't have any other questions.
Commissioner Matthews?
I don't have any.
I have Mr. Hughes.
Yes, I've got a couple. On that point, are the forecasts built on the actuals, the company's actual data?
Well, our forward-looking test year is based on our most recent budget, not actuals. The case has got a base period that is partially based on actuals and a forward-looking test period that's based on budget.
Okay. On the AG Schedule 7, or Exhibit 17,
Yes.
page 4,
Yes.
set schedule shows the company's earning its authorized ROE, even with the forward looking rate treatment.
No, it is not earning our authorized ROE.
If the PRP is on a historic calendar year basis, how many months would elapse between the company's first PRP spending in that calendar year and recovering of that expense through rates?
Well, so we went over timeframes that were, I guess, in last year's order. And if I recall those, it anticipated, first of all, instead of calendar year, I would focus on fiscal year. We typically file PRPs on fiscal year. So if we did a fiscal year that ended in September and the rate did not go in until, it was proposed for May 1, I believe, is that right? March 1? If it's March 1, then the average amount of lag that we would calculate would be from the midpoint of the spending, which would be roughly April 1 on halfway through our fiscal year. If the rate then went in March 1, that would be 11-month lag.
Do you remember the discussion you had with Mr. Bellamy about if there had not been on the bare steel, if there had not been a pushback on the bare steel as proposed by the company in the last case, what would happen to those other projects that we're proposing now? Do you remember?
Well, I think this was a question posed originally to Mr. Smith.
Yes.
That's the question. So Mr. Smith was asked about if the company had been able to maintain the level of PRP spending that it had proposed in the 2018 case, where we were proposing an accelerated level of capital spending on PRP. If we had maintained that, rather than being subjected to the $28 million cap, what would happen to our non-PRP expenditures? And I can't remember exactly what Mr. Smith said, but what I would say is, if our PRP spending had stayed at an elevated level, an accelerated level, then our non-PRP spending would have been lower, such that the total capital available to the state of Kentucky would have remained constant.
Okay. That's all.
Anything further?
No questions.
No further
May
questions.
this witness be excused?
You may.
You may be excused, sir. Thank you. It's obvious we're not going to get finished this evening, so let's go into recess until 9 o'clock in the morning, and we'll finish up.